Certainly something that we're going to be keeping a very, very close eye on. And you mentioned the key companies there. What the energy sector does actually kind of maybe have the bulk of the moves today. Remember, yesterday, as Lizzie was mentioning, Europe was closed, so a catch-up trade baked into the indices as well, especially when it comes to some of the banking story. I've got my eye on BBVA, among others. Does the trade story actually show up on a day that has been sandwiched between a bank holiday in Europe and, of course, a weekend here in the UK, and I should say around the world as well? Let's talk about the open. It is here now. We are seeing green on the screen right off the bat from the FTSE 100, virtually flat at the moment, but edging into the green. Let's see whether that catch-up trade Lizzie was talking about actually manifests when it comes to the actual opens across Europe. We're looking at a FTSE 100 trading at circa 85.45 at the moment. There's the stock 600, and there are those monumental moves. You can see the periphery outperforming right out of the gate. IBEX higher by about 1%. The stock 600 as a whole higher by 0.6%. Tom, Lizzie, may take a minute for the CAC, and there's the CAC higher by 1.5%. That is a massive move to the upside. The catch-up trade already showing up. How is this shaking up on an individual basis, Lizzie?
Well, if you look at some of those individual stock movers, then we have Shell currently up 2.5%. As you say, they've stuck with their payouts and their spending plans despite the drop in the oil prices. And then as we look to the sectoral breakdown, you've got energy about, a quarter of the way down the basket, 7 position. So it's 2 sectors in negative territory, but the rest in the positive, led by basic resources, up 2.2%. And if we go back to some of those single stocks, you mentioned, Tom, NatWest saying their customers are resilient amid all of this uncertainty, and those shares also up 3.5%. Standard Chartered, you spoke to their CFO, they had earnings as well, they're up 2.1%, their profit beating. Danske Bank reporting, we'll speak to them later, but they kept their full year net income forecast, and those shares up 3.2%. So a lot of green on the screen for some of these earning reporters.
Yeah, NatWest coming through, of course, with pre-tax income in terms of the top line for the latest earnings, up 38%, still seeing resilience. Net interest income as well, a positive for NatWest in a different rate environment versus Standard Chartered. Standard Chartered seeing a slightly different picture. UBS guiding for softer, earlier this week, guiding for softer net interest income through the week. Again, across your sectors, as Lizzie was saying, top line, basic resources outperforming, up 2.5%, followed by industrials and banks. On the downside, utilities, real estate and media seeing a little bit of softness and otherwise very bright picture for European equities.
Yeah, broad gains across the board. I think I'm really kind of struck by how you're seeing the energy sector and the tech sector kind of leading the rally here. Those are usually two sectors that kind of move in terms of opposite directions. This morning, it seems healthcare certainly on the back foot. It's a crucial time, of course, as we see. It is very much a catch-up trade. You are likely to see a little bit of low volume, a little less liquidity as well. Let's getting in a true expert here when it comes to these markets. Ronald Temple, Chief Market Strategist over at Lazard, joining us around the table. Thank you for coming to visit us.
Pleasure.
We appreciate your trips to London. Green on the screen, as Tom and Lizzie were just outlining there, which means I have to put on my bearish hat, and as I must. Ron, walk us through where the red flag in this market is. If we're talking about recession calls from all the Wall Street banks, we saw the contraction in GDP this week, at least for that one quarter. Where is the concern for the next leg lower when it comes to equities? Is it buyback suspension? Is it widespread layoffs? Two things we haven't yet seen while we've seen a contraction in GDP.
Right. I think point number one is it's just too early to see the effects of the trade war in macro data or earnings. I think a lot of people have basically gotten relief from seeing, when you looked at the GDP number this week in the U.S., final sales to private domestic purchasers were up 3%. So it was a good number. So I would look past that 30 basis point decline in GDP. But the reality is that's GDP for the first quarter before these tariffs really went into place. And looking for companies to give guidance, I think, is a misplaced idea as well, because a lot of the companies don't know what to give guidance on. They don't know where the tariffs are going to end up. And so it's impossible for them to look into their crystal ball and tell you what to expect. So what I'm thinking is you need to just step back for a moment, ignore the day-to-day headlines about whether China might be preparing to negotiate, and focus on the fact that on January 19th, the weighted average tariff on imports of goods into the United States was 2.7%. Today, it is 10 times that level at 28%. That is a huge shock to trade, and over time, that will translate to higher inflation, higher unemployment, lower GDP growth, and lower corporate profitability. And so I think we have to look ahead and think about second quarter earnings season when companies might be able to give more guidance, and look at the macro data that's going to be coming in June and July, not this week.
But does the macro data even matter, I guess is my point, if it's not met with real contraction in the operations of some of these companies? We've had experts around the table talk about pullbacks in CapEx spending, pullbacks in hiring, pullbacks in buybacks or guidance, for example. And to your point, I hear you on the buybacks and the guidance bit. No one really has a crystal ball. But the actual contraction that people are talking about in terms of corporate specifically, that doesn't seem to be coming as quickly as perhaps anticipated 3 months ago.
No, and I think it's going to take time. Again, imagine you're a company that imports inputs from China, and about 40% of all U.S. imports are inputs into other goods. You knew there were going to be tariffs on China. The president campaigned on this for the last year, talking about 60% tariffs. So you probably front-loaded your inventories. You're running down. You're going to deplete that inventory of low-cost inputs, and at some point you're going to have to replace it with much higher cost. I think that's when the rubber hits the road, and you start to see companies deciding, how much can I raise the price to my end customer, and how much headcount do I have to cut to basically try to mitigate some of this pricing pressure? And so I'm thinking you're going to see this in the May employment report that we get in June. I think you're going to see it, we probably, in 2 weeks when we get the next CPI report in the U.S., I think that will be the trough of inflation. Thereafter, I think you see inflation start to reaccelerate. And that's why I mentioned second quarter earnings season is when you're really going to start to see companies having to make tough calls. Now, by the way, between here and there are a lot of headlines, right? We're all waiting for July 9th when the 90-day pause on reciprocal tariffs will end. But I think basically you should keep your eyes fixed on that 28% weighted average tariff. Simple rule of thumb, every 1% increase in the weighted average tariff equates to 10 basis points of core inflation. So right now we have about 250 basis points of extra inflation in the pipeline. Substitution effects will work some of that down, right? Imagine there's a 100% tariff on textiles from China and a 10% tariff on Bangladesh. You find a way to shift to Bangladesh. Over time, that 28 will probably come down to 20, but it's still a lot of extra inflation.
So what I'm hearing from you is that stagflation is on the cards,
yes,
which would leave the Fed with its hands tied. How confident can we be in the Fed put then?
I am 100% with you on that comment. Stagflation is basically my base case scenario right now. Even in the best case outcome, where we have a 10% universal tariff on all trade counterparties except for China, which is maybe at 20%, and you have sectoral tariffs, steel, aluminum, autos at 25%, you basically end up with core CPI at the end of this year around 4%, and growth probably closer to 1.5%. So not a great outcome. And the market is saying, as of this morning, 90 basis points of Fed rate cuts by the end of the year. I think it's zero. So I think there's too much optimism around the Fed. I think the Fed is going to have a very hard time basically cutting rates when inflation is accelerating that much. And so I think that's part of the risk to the market as well, beyond the buybacks and the guidance.
Wow. So how much of a correction in equities are you seeing if, and I know there's so much uncertainty, all of your assumptions come true? In
the best case, we're where we are today at the end of the year. But I worry that in the middle, I mean, I have 3 scenarios I really track. In the middle scenario, I think easily 10 to 15% downside. In the bad scenario, there could be 25 to 30% downside.
Ron, Pretty started by saying she needed to wear the bear cap.
I know. Now I'm like, now I have to like.
I think I just grabbed your hat. Sorry, but yeah.
You're pulling it firmly over your eyes.
Well, and again, I'm just trying to say these are the fundamentals of the operating backdrop right now. So it's great that we had the pause to delay until July 9th. We need more than a pause. We need these tariffs to come back down.
Let me give you a counter then. The markets, the Trump administration has proven to be vulnerable to the markets. They're going to adjust around that. We know there's sensitivity. We know there is discontent within the Trump administration about how the tariff policy has been unfolded, unlike other parts of the policy administration. The Fed, they're going to go soft on labor. They're going to have to make a move. they're going to have to cut because the labour market is going to start to soften, as you say. Some kind of traction is going to come through on the deal front. Earnings per share, earnings across the board in terms of the numbers that come through so far, up about 13%. There's a resilience across US corporates. There's a risk that with all the cash sitting on the sidelines, you take this bearish view and you're sitting on the sidelines and some of these deals come through, you get caught short.
I recognize the risk. By the way, I think you just sketched out the sentiment I see in the market, which is a fear of missing out. I mean, I literally have clients asking me, have I already missed the opportunity to put money to work? Is it all over? I'm like, no, the news hasn't even really started to show up. And so I think what you're pointing out is you absolutely don't want to step out of markets altogether. You need to be selective on your investments. I think valuations matter. The U.S. is not the only market. I think what a lot of global investors are realizing is the gap in valuation between the S&P 500, which was at 22, 23 times, now we're at 20 to 21, versus Europe at 14 times, Japan at 14, EM at an even lower multiple. There are choices in the market where you might be able to get better opportunities. So I think part one is identifying where you want to be invested. Part two, though, is recognizing at some points the market gets overextended, excuse me, and you want to take some money off the table.
Where do you go in Europe then? Where are you finding margin resilience in that trade tariff scenario in Europe?
You know, I think Europe actually has some really... I've never been a big fan of having a Europe allocation because there are certain parts of Europe, certain sectors where you get great companies and other sectors, let's be honest, where you don't have a lot of choices. And so I think in Europe, you've got some of the best consumer companies in the world. You've got some of the best industrial companies in the world. The UK has some great opportunities. So again, it's going to be a mixed bag in there, but I think that's where the security selection really comes into play, and it's company by company.
All right, outfit change. Back to my bull cap here. The argument against all of this doom and gloom, basically, is that the system has way more liquidity in it than it ever has, even with the sell-offs, even with foreign buying coming down. It actually has too much liquidity that could arguably diminish the need for a Fed put at the end of the day. That's what moved the market post-COVID with the help of the Fed. Doesn't need the Fed this time around because there's so much still in the front end of the curve in money markets, et cetera. Could the extra liquidity in the system function or help the market function kind of like a floating device?
Well, forgive me for this. I want to go back to something Tom said before I answer that, because back to the administration's sensitivity to markets. I think the administration proved it's sensitive to the bond market, not the equity market, right? A lot of us were discussing a Fed put, a Trump put, all these different puts. The reality is when we had that combination of the equity market selling off and the bond market and the dollar, that's when the administration pulled back. And because of that sensitivity, I think my worst case scenario is unlikely. I just plotted out those three scenarios. So I don't think the 25 to 30% downside is what we're going to see. I think what we're going to see is an administration that basically watches what the markets are doing and periodically pulls back or offers the good news to rein us back in from this negativity. So I think they've done a pretty good job of it so far, by the way, considering how much tariffs have gone up, that the S&P is only down 9% from the all-time high. Not about outcome. Yes, there's also a lot of liquidity in the market. And very importantly, even in my bearish case scenario, recession is not a slam dunk. I think you're debating recession if the weighted average tariff ends up being somewhere around the current levels. My concern, though, is in recession, earnings are not up 10%, they're down. And so that's part of where the downside comes from, is earnings risk and PE multiple compression risk. Luckily, entering this year, the U.S. economy was so strong, the corporate balance sheets were so strong, consumer balance sheets were strong. I think that's unlikely. So, again, I don't want to sound doom and gloom. I know I took your hat away. I want to give your hat back. You can be the bear. But I think people need to be more realistic about what the environment is for companies and recognize you're not going to hear the bad news this week. It's going to happen over the next several months.
Can I just come back to Europe? I'm still processing that you don't see any Fed cuts this year, but the market's fully pricing in 4 Bank of England rate cuts this year. So if you have that situation, and by the way, inflation might be sticky, right? So I wonder if that's realistic for you, but where would it leave the pound?
Actually, I'm expecting 4 rate cuts from the BOE. I think the BOE will deliver on those expectations. I think the ECB
How does the BOE cut 4 times if the Fed's on hold through the year?
Because the BOE
We're
has
so closely linked.
I think what you're going to see is declining inflation in the UK. But again, keep in mind,
because of imports?
The UK did not put a 25% tariff on everything they import, right? The UK has declining inflation. It's not necessarily mechanically attached to the US. And I think when you look at the UK and the Eurozone, you're going to see weaker growth because of what the US is doing in terms of raising tariffs on their exports to the US. That gives them more latitude. I mean, by the way, let's zoom back out for a minute. The Eurozone has had better success on a nice, smooth decline in inflation relative to the U.S. The UK clearly has had a stickier service inflation that's been more worrisome. What we're seeing more recently in the UK is easing in the labor market tightness, easing in that service inflation in the last couple of months, better than expected data there. I think that's going to continue. In the Eurozone, I think the pressure from U.S. trade policy is going to accelerate the decline in inflation, giving the ECB more latitude to cut. And so this has basically been my set of expectations since the beginning of the year, is no Fed rate cuts and more rate cuts from non-U.S. central banks than people expected. P.S. I had expected that to translate into a stronger U.S. dollar. That clearly did not happen, but I think you actually could see another leg up in the dollar as these divergences are magnified.
Ron Temple, Chief Market Strategist at Lazard, walking us through, I feel like, a bull case and the bear case. We covered a lot with you, every possible scenario. We thank you so much for joining us around the table this morning. As we're about 15 minutes into the trading session here in Europe, let's take a quick look at the core six, basically the mega cap companies that tend to move this market the most. And this is, I think, a great example of a risk-on kind of day, even if it is amid some light liquidity, a little bit of a catch-up trade, given Europe was off yesterday as well. Gains across the board. LVMH higher by 1%, despite a cut over at Barclays to equal weight as well, and a price target cut as well. Nestle, which is, of course, that favorite consumer staple, a defensive play, if you will, actually down on the day. Novo Nordisk, again, which is traditionally tends to, or at least in the last couple of weeks, has taken quite the leg lower, higher by 1.7%. Even Schneider Electric and ASML catching some of the positivity in the tech bid, despite the somewhat negative earnings from Apple and Amazon. So that is a picture of the core six.
Kind of underscores what Ron Temple was telling us about picking your points within the European market, doesn't it? Coming up, NatWest and Standard Chartered shares up at the start of the European Open after reporting positive results. We're going to wrap up this week's UK bank earnings. Top line has been positive. Stay with us. This is Bloomberg.
Africa, a region rife with potential for growth and opportunities, but not without its challenges. Bloomberg highlights the biggest stories, interviewing key players, and reporting on the issues impacting the region. Join us as we get to the heart of African business, politics, and economics, and ask the question, what's next? I'm Jennifer Zabasaja, and this is Next Africa. New episodes every month, only on Bloomberg.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg.
U.S. tech is influencing global markets.
Technology is driving business across Europe.
Companies in Asia are betting on tech.
Jumpstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action. We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets.
With the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling. Join us on Bloomberg Open Interest. Every trading day, only on Bloomberg.
Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern, only on Bloomberg. Context changes everything. From our studios in New York and San Francisco, our expert hosts have the data and analysis from the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. Live every weekday, only on Bloomberg Television. Context changes everything.
bringing you up-to-the-minute financial news whenever and wherever it happens. I'm Michael McKee at the Federal Reserve, and this is Bloomberg.
Standard Chartered shares up this morning after the lender reported first quarter profit that beat estimates. There you can see the gain of 1.2%, driven by its wealth and financial markets units, the volatility benefiting that part of the business. The lender has stuck as well to a plan to return at least $8 billion to shareholders from 2024 to 2026. The company's CFO, Diego Di Giorgio, spoke to me earlier about those numbers.
Are doing a lot of things in the short term. There is a lot of tactical activity. There is a lot of repositioning. There is a lot of taking care of exposures, whether it's to rates, to currencies, to commodities, as you mentioned before. And therefore, that activity is very high in the current volatile environment. And then the clients are evaluating what to do strategically going forward. And for that, we will have to see how the current uncertainty evolves and hopefully continues to abate for them to decide to put in place more strategic activity.
Does that pace of activity, is that likely to be sustained?
So the pace is high now. This is an environment that changes every day. So it's clear that there is a question. But the long-term drivers of it remain very intact, and particularly in the wealth management business. Our type of wealth management, while we are active all across the wealth management spectrum, we are particularly focused on affluent customers. And affluent customers are really long-term savers. They have bancassurance products with us, mortgages, some funds, and we see that they are shifting toward more defensive products, but they remain active.
You're helping your clients. The volatility is a benefit. They come to you for that assistance. How do you compete? How do you balance that versus the competition of possibly a slowdown in trade volumes as a result of the uncertainty? Does one offset the other?
So, first of all, let's put into perspective that what we are really is we are a giant connector bank between our fast-growing regions in Asia, the Middle East, and Africa, and the rest of the world. Trade is important as an activity, but it's less than 5% of the revenues of the bank overall. So, what we are really focused on is on, as you say, making sure that our clients continue to adjust either their financial lives, if they are wealth management clients, or really continue to diversify their supply chains, an activity that they have been doing for years, but that has clearly accelerated.
How much cross-border revenue, though, do you think is potentially at risk as you look out?
So we have, in our results for this quarter, we've tried to be helpful to our investors and to our shareholders in explaining a little bit how our exposure across the network works. The reality is that our network is so diversified. The 175 years of investments and the 53 countries we operate in mean that the shifts are really shifts in direction, but the overall growth of the fastest regions of the world remains a structural trend that remains very powerful.
Are you seeing money flows moving? Are you seeing money flows moving in a substantial way out of the US to other jurisdictions?
Very interesting. We have asked ourselves this question and we've looked. We don't see evidence of a real asset reallocation away from the US or away from the dollar. We are seeing it mostly, as I said, in the nature of the investments. The investments in the short term are becoming more defensive.
Okay, Standard Chartered's Group CFO, Diego Di Giorgio, speaking to me earlier on the back of those earnings that, of course, came through the beat and the stock up so far in the session. Let's get more on the UK bank earnings, bringing the analysis as well in terms of what we've been seeing with NatWest, Lloyds earlier this week, Standard Chartered, of course, reporting this morning. Very pleased to say Tom Metcalf, Bloomberg's managing editor of EMEA Finance and Investing, joins us now. What were the standouts then in today's earnings for you and the team, Tom?
Yeah, look, I think for Standard Chartered is that wealth bit of their business, and I think one of the stats was something like 13 billion of new inflows this quarter for their wealthy clients. And as you could hear the CFO saying there, that's been a very important sort of driver of what's a pretty strong quarter. And then I'd actually pick up something he said in that interview with you is, you know, this elevated trading activity. He's saying that's still happening because that's the biggest question for any, you know, bank with a big investment banking sort of side is how long can this volatility continue to benefit? And, you know, the UBS CEO saying, gosh, the start of April was absolutely mental, but then it's kind of calmed down a bit. But interesting to hear the CFO say that's sort of still sustaining, which you would think would be good news for as long as that can stay along for those trading banks.
Put that into context in some of the other earnings we got this week.
Yeah, I think it's a part of a piece of what we saw with Barclays, with Deutsche. The trading floors are absolutely kind of absolutely chocker in terms of business and volume, and that's really helpful. The question is, how long does it last for? But broadly speaking, sort of with NatWest again today, it's been a strong first quarter for all these banks. It's this fascinating sort of push and pull of, hey, look, we can reaffirm our guidance. In the case of NatWest, they actually said we think we'll probably hit the upper range of our guidance in 2025. But then you just have this massive unknown of, it's still too early to know how the sort of tariffs play out. How does the sort of those trade flows change? So it's just really difficult, to put too much stock into what has, broadly speaking, been a pretty positive quarter.
Tom, you've got more change at the top of HSBC. The AGM today with Mark Tucker, but we heard yesterday he's going to retire. He's had 8 years in the chair, 4 CEOs, 2 major restructurings. How do they replace him? What do we expect out of the AGM? Yeah, it was a fascinating day yesterday. He really is, for me, sort of the defining figure for HSBC over his tenure. And it'll be interesting to see what they look for. He was the first outsider as a chairman of HSBC. Do they continue with that? And, of course, whoever they pick, they've got a new CEO in line. So it'll be an interesting role to fill. But they're saying they're going to fill it by the end of the year. So that, to me, suggests a big role like that. They've got a few candidates in mind. And, if you're asking from my sense of things, I think they'll go for another outsider. Okay, interesting call. You're looking at HSBC shares this morning, up 1.3% in London, but up 12% over his tenure. So we look ahead to that AGM. Bloomberg's Tom Metcalf, we thank you. Let's check on some of the individual stocks that are on the move at the open. Just focusing in on some of the other banks that have been reporting this morning. So you've got ING shares up 4%. It topped its estimates. It's issued a fresh share buyback. But at the same time, it's pushed out its capital goal because of the tariff uncertainty. So interesting to see that the shares are up so much. And then Danske Bank reporting this morning as well. Those shares up more than 3%. It kept its full-year net income forecast. And in general, the first quarter beating estimates. So a positive read on the market on Danske Bank. But they're not the only ones reporting this morning, Kriti.
No, not at all. There are plenty of earnings that we are keeping an eye on in terms of the energy sector later in the States as well. But right here in Europe, Shell, of course, higher by 2.8%. Their adjusted profit beating estimates, though, even though some of their margins are seeing a little bit of pressure. They're also launching a $3.5 billion share buyback. So that's always going to kind of inject a little bit of optimism into the stock as well. Something you're seeing in the likes of Schneider Electric and Siemens Energy as well.
On the tech front, this also may be partly a catch-up story to the US tech earnings earlier in the week. Of course, Apple and Amazon have muddied the picture a little bit, but European tech is performing very strongly so far in the session, particularly in terms of semiconductors, and a number of those names listed in the Netherlands. So BE Semiconductor is leading the gains, up 4.4%, but of course ASML as well, those makers of the lithography machines that go into the foundries of TSMC and others, currently up 2.6%. So a decent session for tech. There's the other potential catalyst, which is the reporting around a potential carve-out for NVIDIA chips being sold into the UAE, and of course discussions may be starting between the US and China. So a number of those potential catalysts feeding in, it seems, to some upside for tech this morning in Europe.
Yeah, trade optimism adding to the green on the screen that we are seeing this morning. But coming up on the programme, the European Union is set to present its own trade proposal to the US negotiators. So we'll dive into that next. This is Bloomberg.
It on the China show.
President Trump has called Wednesday Liberation Day, and that seems like liberation from the rules-based order on trade.
We're seeing a lot of orders being canceled, particularly on product being sourced out of China. There's a threat to seeing a shortage of certain products because, look, China's our #1 supplier of footwear. When I got this job 15 years ago, it was 88% of our volume to the U.S. It's now 56% of our volume. But the fact of the matter is, most of that volume is for price-conscious consumers here in the States.
One of the things you see here when you talk to suppliers and buyers is that this essentially gives Asia and Africa to Chinese supply chains an influence, because now as American firms have to focus more on the home market, the companies and organizations with the money to invest in new areas, that will be mostly Chinese money.
Don't miss the China Show live every weekday.
It's the world's second largest economy with a growing influence in global affairs. Bloomberg The China Show brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China.
We need to do more to engage the market more.
We're risk on. I think we caught a little sweet spot.
Massive savings right now.
It's already a different game.
Bloomberg The China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
Is this a negotiation or the new rules of the game?
It could be either.
It is up to the president how he wants to negotiate.
The higher the tariff, the faster they come.
A 90-day pause is not an eradication.
The trade negotiations are moving quickly.
There will be deals cut.
Trust Bloomberg for all the context and clarity you need as the tariff and global economy story evolves.
This year's bear case, very quickly, becoming the base case.
Nobody covers tariffs like Bloomberg. Context changes everything.
What is going to be the consequence for U.S. markets?
We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
This is the opening trade. Happy Friday, everyone. We are 30 minutes into today's session, and you are seeing a bright picture again. Set for 8 straight days of gains, if things hold, of course, across European equities, potentially 9 straight days of gains for the US. The earnings optimism there, certainly as well, the rhetoric around trade, and at least in terms of the needle moving on some of these conversations seeming to play into the upside that we're seeing across the equity markets. So the benchmark here in Europe currently up 0.9%. I'm squinting at the screen. The DAX in Germany up 1.4%. And in terms of what's happening here in the UK, the FTSE 100 as well, benefiting from the outside coming through from the likes of NatWest in the banking space. Energy also performing well. Basic resources giving a lift to the FTSE 100, currently up 0.8%.
Let's talk about what we might expect in the next coming weeks. Of course, the current state of play and tariffs very much in focus and driving some of the optimism, as Tom pointed out. The EU planning to share a paper with the United States next week, setting out a package of proposals to kickstart trade negotiations with Donald Trump's administration. Now, joining us now, Bloomberg's Kevin Whitelaw on sabbatical, hiatus, or visiting from Brussels, whatever you might want to call it. Walk us through kind of what that relationship may look like. We've previously heard that natural gas has been a key piece of this conversation. I think Ursula von der Leyen had used the phrase that they're knocking on a door that is swung wide open already. Walk us through what else the EU can offer that Donald Trump would want.
I mean, the EU is in the process of trying to figure out what that actually is. And I think the problem is they know there's a handful of things they could offer, and it's not clear the U.S. is interested. So that may come with, this sort of what they've called zero for zero tariffs, reducing all tariffs to zero. But so far, they talked about that with the U.S. in previous years. They talked about that with Trump 1. That wasn't really enough. Trump has talked a lot about non-tariff barriers, and so there may be some room on a couple of those, but a lot of those, like the value-added tax, are simply non-negotiable for the EU. So they are putting together a package. They're trying to come up with something that looks impressive, and it's just not clear whether or not it's going to make any difference for what Trump's actually looking for.
Well, so if that 10% is a minimum tariff, what happens if there is no deal?
Well, if there's no deal, it goes back up to 20% at some point. That's sort of what Trump has set in motion. The EU obviously had imposed some of its own retaliation, paused that. So at some point, there's either going to be some kind of a deal or it goes back. But there is a growing sense in the EU that we're looking at 10% is the minimum. That's not going to be negotiated away. And it's not really clear that these various sectoral tariffs, the car tariffs, the steel tariffs, the aluminum tariffs, it's not clear those are going to be able to be negotiated away either. So there's already a new normal. The EU is going to have to respond to that in some fashion. And then, of course, that could trigger another Trump reaction. So even if there's a deal, it's not really clear how much it's going to mitigate for the tariff side.
Kevin, is the domestic pressure on Trump more acute when it comes to the China story? Because there's a very direct link between the shelves in Walmart and Costco versus Europe and a BMW or a luxury handbag.
Well, I think the pressure is right now steeper because of China, in part because of the kinds of products, but also just because the tariffs are so incredibly high. So you're looking at something that's making trade simply unsustainable, and that's going to lead to massive shortages, as opposed to just cost increases that may take a little while to be noticed. But it is going to still take a little while, but not very long, for some of those things to be noticed. And what's really not clear then is what kind of pressure that's going to put on Trump. But once Americans go into stores, see shelves empty, see prices on things that they simply can't afford, that is going to put pressure on Trump, in large part because it's going to put pressure on Republicans in Congress. They're all going to be seeking re-election, relatively soon, and everyone's going to know who to blame for those shortages and those price increases.
Back to school shopping seems to be the key piece where that may show up. You're already seeing a lot of the shippers talk about these imports that they bring in for not just back to school shopping in August, but of course the holiday shopping and holiday season at the end of the year as well. All of that shipping is halted, and you can see that in some of the cargo routes as well. Walk us through just how much kind of the domestic concerns outside of some of the tariff and the price increases could move Donald Trump's position.
Well, I mean, ultimately, again, it's going to be that thing where when Americans want to go and whether it's get their school supplies, get toys for their kids, get whatever these products are, there's going to be products that people need, hairbrushes, I don't know, whatever it's going to be. There's going to be points where these things simply get too expensive or just aren't available because nobody can do it. And again, there's nobody else to blame. Who can Trump deflect? And he can't blame.
So the Trump administration, to that argument, would argue that a decline in oil prices, for example, would offset some of the pressures you see in other places. To what extent is that a viable argument?
I mean, to the degree that Trump owes his victory in the election, in part to the fact that prices were increasing on eggs and other products in the U.S., the fact that we were lower in some areas didn't make a difference, right? That Americans are looking at the prices that they're spending in their pocketbook. They're looking at the things that they're spending every day. That's what they're going to care about. And they haven't seen the kind of price relief that Donald Trump had promised, and in fact, they're going to see the opposite. And in some ways, I think the shortages may be even more psychologically damaging to Trump than even the prices, because that's going to sort of bring people back to those COVID days where we're scrambling to try to find toilet paper somewhere.
Well, Kevin, you're joining us from Brussels this morning, or on a visit from Brussels this morning, and I'm curious about the European Union's maybe if they're kind of gearing up for this negotiation and this battle with the United States. Has that changed their position when it comes to their approach to China? Just a couple of months ago, they were so tough on the EU kind of cars and overcapacity conversation, and it feels like the narrative has shifted a little bit.
Yeah, I mean, I think that there's at least some willingness to understand that inside the EU that they have to be working on trade relationships with other partners, and so you're seeing that a lot of outreach, in particular to places in whether it's the Mercosur countries in Latin America, whether it's India, whether it's countries in those kinds of just elsewhere. The problem is the EU is a rules-based trading system, and that's now what they actually see as their greatest strength, particularly as Trump tries to tear up the trade rule book and just sort of throw things out. The EU's marketing pitches were a predictable rules-based trading system. That doesn't go quite so well with China, with the way that they have been carrying out some of the trade and some of their practices with subsidies and everything else. So yes, there's an openness to it, but there's an enormous skepticism that there's going to be some massive renaissance in trading relationships with China, because I think the EU is saying we can go the other way from Trump and really show people why they should do business with us.
It's interesting because where you're talking about this warming of relations between the EU and China, actually from the UK's perspective on China, you've seen Rachel Reeves echoing the Trumpian view on China and criticising the trade imbalances. So you've got to see how that EU-UK relationship plans out when you've got the US and China to factor in as well. Kevin Whitelaw, we thank you for your analysis en route from Brussels to Washington. But let's go to Washington next. Since Donald Trump returned to the White House, Elon Musk's been an absolute scene stealer, gutting government agencies and sparking litigation too. But Doge hasn't fully lived up to its billing, while Tesla has become collateral damage. That's the topic of our weekly doc.
The marriage of money and power is nothing new. But the arrangement between billionaire Elon Musk and President Donald Trump is like no other in the history of U.S. politics.
Come on up here, Elon.
They're buddies. That's probably a good description, at least how Elon Musk sees it.
Donald Trump needs his fall guy, but he also needs the bulldogs, and sometimes they're the same person.
It's been a crazy 100 days.
You look around the U.S. government right now and you see friends and allies of Elon Musk in all these various departments, in all these various top leadership roles.
Trump has been able to get Elon Musk to help propel through all the changes that were spelled out in Project 2025, a blueprint for reshaping the government.
In Doge's mind, they've been wildly successful. And on the flip side, there is a cost to laying off federal workers, to fighting all of this litigation in court.
Musk is known for his uncanny ability to play a long game, but he may not have expected so much public blowback.
So Tesla's sales really dropped. Their first quarter sales were 13% lower than the quarter a year ago.
Starting in May, my time allocation to Doge will drop significantly.
As Musk pivots, the struggles surrounding Doge's actions continue, while many Americans are reeling from a tumultuous 100 days.
Musk isn't really leaving the Trump administration.
It's not like Doge is ending. I mean, Doge is a project that's supposed to continue until July 2026.
One thing we've learned over this last 100 days is that there is going to be a huge cost to Elon Musk for doing the things he's doing. He has basically taken his personal brand and tarnished it. And that's what happens when you put yourself front and center of some extremely controversial and often unpopular policies.
Of course, you can catch that full documentary from our very own Bloomberg Originals team. It will be available online on the Bloomberg terminal. Really fascinating reporting from our team across the United States. But of course, it is that key risk that you were seeing, not just in the tariff uncertainty, but the domestic politics as well, that are scaring a little bit of corporates, of course, locally in the U.S., locally in Europe, but as high as the Nordics as well. That has been one line that's come out of Danske Bank this morning, despite a slew of positive earnings. The shares are, of course, higher at the start of European trading to the tune of about 3%. As I said, those market jitters, a lot of it emanating from Washington, D.C., has impacted Denmark's largest lender in their first quarter. Let's go now to an exclusive interview with the CEO of Danske Bank itself. Carsten Eggeris joins the program this morning. Carsten, a pleasure to have you. Thank you so much for making the time for us. Just walk us through these numbers here and put into context about how sustainable these numbers are in the face of some of that geopolitical risk.
Thanks a lot. Good morning. Thanks for having me. Look, first of all, we're pleased with the first quarter. We see year-on-year good activity across our markets and across the Nordic economies more generally. And I think, as you asked, sort of, how does that play out in the context of market jitters and concerns about trade war? I think importantly to say that the Nordic economies are standing strong. And if you look at Denmark, we saw close to 4% growth in 2024. We continue to believe that we'll see more than 3% growth in Denmark as we look into 25, despite downwards revisions. And, if you look at the trade relationship with the U.S., which of course is important, when you look at direct trade, which is really encompassed by potential tariffs, it's relatively manageable. It's around 2% of GDP. So yes, of course, customers are concerned navigating difficult environment with this restructuring of global trade. But at the same time, it's a trend that has, of course, been underway for some time and that companies have been able to navigate in. Some customers clearly harder hit than others. But I think the other thing I would add in there is some optimism around Europe, increasing optimism about Europe, right? Both normalization of inflation, lower interest rates, reallocation, which we've also seen from some of our customers from U.S. equities into European equities, and also a sense that there is increased focus on Europe, on growth, more spending, all of which will offset some of the uncertainties around the restructuring of trade.
Well, Carsten, is that increased exposure to Europe from the average international investor enough? Is the margin of that enough, or the volume of that enough to offset declining interest rates, as you put it, when it comes to the profitability of your bank?
Yeah, I think there are several things in play. First of all, we do believe that as inflation normalizes, interest rates come down, that will increase the likelihood of investments, of spending. Cheaper financing costs, I think, is generally a good thing for our customers and our clients. But also the commitment from European governments to spend more on infrastructure, on the green transition, on defense, those kind of things will also help underpin activity. Clearly, the restructuring of global trade will also cause and necessitate corporate clients to think about and accelerate regionalization, how they think about production. So a lot of the things that are going on should also increase investments and activity. At the same time, of course, keeping in mind that some clients are hit harder than others, and there will be profit downgrades from Nordic clients as well, and we've certainly seen that in the past few days.
Carsten, tie that then. Good morning, Tom here in the studio. Tie that then to the credit picture. What is credit quality looking like right now? What is your outlook for that credit quality in the quarters ahead? And are you comfortable with provisions as they're currently set?
Yeah, so we continue to see a very strong credit quality and very low levels of delinquencies, very limited deterioration in credit exposure. Keep in mind, and particularly in Denmark, which is more than half of our business, unemployment is at record lows. And again, the economy has been strong. So right now, we're not seeing any evidence of credit deterioration. No doubt there will be some downgrades in terms of rating migration as some companies downgrade and therefore EBITDA reduces, and that plays into some of the credit migrations. But overall, we feel comfortable. We guided to $1 billion of credit losses when we came out with our year-end results in February. And in fact, we haven't changed those outlooks. And although we see some revisions of slightly slower growth across the Nordics, we don't believe that will have a material impact on credit quality as we look forward, given what we know today.
Carsten, good morning. It's Lizzie here. You mentioned some of the increase in European spending. I note that you have lifted restrictions so that you can invest in practically all EU defence firms. And I get that we're in this new era of rearmament, but I just want to clarify, what was unethical about them before but doesn't apply anymore?
Yeah, I think if you take a step back, our primary role is to help our customers and clients, both in terms of helping large defense companies in the Nordics who've been clients of us for a long time, helping them with their business. Clearly, there'll be more activity there, but also to help our clients on the investment side in terms of accessing defense stocks, defense investments. There's no question there's been a huge sentiment change around the defense sector over the last couple of years. And, there is a clear strategy to rearm Europe. There is a clear commitment from European countries to spend more on defense as percentage of GDP. If you look at Denmark, we've committed to spend 25 billion Danish kroner more incrementally in 25 and 26, which takes our spending in Denmark to over 3% of GDP. So our role is to make investments available to our customers and clients. And that is also why we relooked at all the defense companies that you can invest in Europe. And we have increased the universe by somewhere more than 30 companies recently so that, again, our customers can have access to those investments.
And indeed, we've seen a tremendous boost to those names in this era of rearmament. Rheinmetall and Saab, Thales, all in the green this morning. Carsten Egeriis, CEO of Danske Bank, we thank you for your insights after those earnings. But coming up on the programme, a look ahead to the first non-farm payrolls print since the Trump administration's tariff tumult. That's next. This is Bloomberg.
another art museum called the Guggenheim. Now, Louvre's big enough. Why do you need a Guggenheim as well, right next door?
I think it's a great question. I think the beautiful thing about the UAE and Abu Dhabi is we live with over 200 nationalities. And in doing so, they have become a part of the country's and the city's fabric. And we need to celebrate that. So we need to celebrate everybody's identity, everybody's background, everybody's heritage, everybody's history. And what a beautiful way in doing so in these beautiful institutions. These museums are educational institutions and they're community institutions. So we wanted to curate really a story where you come to Saadiyat Cultural District and you, if you allow me to curate the story, you start off at the Natural History Museum. And at the Natural History Museum, you get a glimpse and you get an understanding of how we came to be, how our Earth came to be, how our universe came to be, from a scientific perspective. Once you leave the Natural History Museum, you go to our National Museum, the Sheikh Zayed National Museum. There, you understand the history of this great land, not just the history of the country, but the people of this land that have been a part of this land for over 300,000 years. You get a glimpse of what the past and the present and the future looks like here in the UAE. From there, you maneuver yourself to the Louvre Abu Dhabi, which is a beautiful universal museum. It is universal in its thematic approach. So there, you basically see a part of you on an equal pedestal with the entire world.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia Trade.
This is Wall Street Week. Welcome to Balance of Power.
This is Bloomberg Television. Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
Welcome back to the opening trade. 50 minutes into today's session, we are seeing green across the screen. Outperformance when it comes to the CAC 40, I think, or DAX, excuse me. Eyesight is poor on this Friday, but it's really important to keep an eye on some of these kind of indexes in France, in Germany. A bit of a catch-up trade. It's a lot of the markets that were closed yesterday. The FTSE 100, you can see, is not outperforming to the same extent, but still higher in terms of risk sentiment. Of course, we are looking ahead to U.S. non-farm payrolls due later today. That first since Donald Trump's administration's tariffs kicked in. Let's bring in Bloomberg's Valerie Teitel for more. Val.
That's right, Critty. Happy Payroll Friday. We've got the jobs numbers coming across the tape at 1:30 p.m. London time. Now, I think the risk is that the market overreacts to a weak print and shrugs off a strong one. If we get a strong print today, I think we might not give it too much weight. We might just toss it off as this is some pre-tariff news. But the headline consensus estimate is for 138K jobs added to the U.S. economy. Unemployment rate is expected to stay steady at 4.1%. A lot of economists out there warning that this could be the last strong print before we get some tariff-induced weakness coming in the prints in May and June. But will it keep this equity market on a tear? We have notched now 8 straight days of gains for the S&P 500 index. Futures are looking positive. Over the 9 sessions, we've gained over 9%. And if we do end up in the green today, that would be the longest streak of gains for the U.S. equity market since 2004, a record not seen for 20 years. I don't want to jinx it, but the longest record for the S&P 500 is 14 days. That was seen back in the 70s.
Certainly something we're going to be keeping an eye on. Does the winning streak continue? Bloomberg's Valerie Teitel walking us through some of those markets. We thank you so much, Lizzie.
So it's jobs day. We're looking ahead to the data. Let's get some analysis and a preview with Freya Beamish, chief economist over at TS Lombard, who joins us now. Freya, good to have you. From the data that we've seen so far, are we heading for a recession in the US economy?
It seems strange. All of my sort of technical terms as an economist don't seem quite appropriate. But when I look at the data, my job is to try to dissect the noise from the trend. The word noise seems inappropriate given the scale of disruption that has been rippling through the global economy and markets. But at the moment, when I look at the data, what I see is noise around an economy that is still relatively resilient. Now, when we look at the jobs data, yes, challenger job cut announcements have increased. If we take out the government aspect of that, yes, the private sector is at the sort of the top of the range, but not really consistent with recessionary dynamics. Initial jobless claims have also jumped, but there seems to be some sort of statistical problems there with regards to seasonal adjustment, in particularly with regards to New York. And then looking at the GDP data, yeah, there is obviously a lot of noise in those data, but the domestic demand looks okay. Yes, of course, people are leery of spending, but what do we really expect in this environment? So we're really in it. We're kind of in a major shock. The survey data have deteriorated, but those can sort of turn around quite quickly. And what I'm looking for when I'm trying to assess whether there's going to be a true recession is whether there's anything that can cause the reflexivity to sort of kick in the labor market. Not just thinking about today's print, obviously, but just sort of more broadly. And without the full extent of the tariff shock, there isn't really an area of the labor market that seems to need to correct. And so it's hard to see there being a recession without that sort of full whack of the tariff shock. The only kind of area of the labor market that looks sort of slightly out of shape is there seems to be a little bit more in terms of construction jobs as compared with the health of the housing market. But everything kind of post-COVID bubble, tech, logistics, that's all sort of corrected back down to previous trends. So you really need the tariff shock to be big enough for profits to be contracting by enough for firms to really want to fire people. And at the moment, we've kind of held consistently that we think that the tariffs are going to be broadly negotiated away, and so it's a 1.5% growth story rather than an actual recession with reflexivity kicking in.
Freya, can I zoom in on part of that tariff story then? Because you are holding out hope of a US-China deal. Some of the signals I've seen from Beijing suggest that they're digging in for the long haul. You don't see that. You see a Beijing that is maybe willing to make a deal.
Yeah, people always talk about face in China. I think face is pretty important everywhere. But I think, if I was in Xi Jinping's position right now, going into this year, I would have said that the US held all the cards in terms of the economic bargaining position. And then the US just completely overplayed its hand. So if I was sitting in the Chinese position right now, I would want to let the US the position sort of sweat it out a little bit. But I would also be cognizant of the fact that my own economy is not in great shape. I've got sort of the Chinese economy has a nascent recovery, a very, very timid recovery that is based on rebuilding the confidence of the consumer sector after the housing crash, after the destruction of wealth in China. And what they really need is some form of stability so that can continue. At the moment, they're having to really focus on the renminbi, prevent that from depreciating to antagonize Donald Trump, and that is preventing their recovery from continuing.
Right. Freya Beamish, Chief Economist at TS Lombard. It's all we have time for. Too short as always, but we appreciate your time this morning. That does it for the opening trade. The Pulse is up next. You are seeing equity markets in the green across Europe. We're going to see if that sticks into the weekend. Stick with us. This is Bloomberg.
Listen carefully. Can you hear the rhythm in the markets? Not just in the syncopations triggered by inflation, but in the preludes leading to global elections, in the dissonance that moves the Nikkei, and the rising course conducted by AI. There's music in the markets, and if you want to learn to listen for it, we'll show you how.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Africa, a region rife with potential for growth and opportunities, but not without its challenges. Bloomberg highlights the biggest stories, interviewing key players, and reporting on the issues impacting the region. Join us as we get to the heart of African business, politics, and economics, and ask the question, what's next? I'm Jennifer Zabasaja, and this is Next Africa. New episodes every month, only on Bloomberg.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Onen, only on Bloomberg.
Jumpstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action. We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets.
With the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling. Join us on Bloomberg Open Interest. Every trading day, only on Bloomberg.
Well, global stocks make gains as China hints at possible trade talks with the U.S., but Beijing says unilateral tariffs must be scrapped first. Amazon and Apple disappoint with warnings about the potential impact of U.S. tariffs on their costs. But NatWest and Standard Chartered earnings beat as traders cash in on volatility and customers show resilience. So first of all, happy Friday, everyone. We've made it to Friday. I feel like it's been a month crammed to the last 5 trading days. But the picture overall is traders really trying to assess what we get out of that last important piece of data out of the U.S. today. There's been a bit of a global stocks rally. Certainly that was started in Asia, trying to get momentum after China said that they were evaluating trade talks with the U.S. So there's a bit more optimism out there than there was 24 hours ago. But of course, this rally that we're seeing, S&P futures gaining some 0.4% is facing this test as investors, again, wait for this U.S. jobs report out today, the latest piece of significant data after some pretty disappointing results from Apple, but also Amazon. Now, the picture here across the European markets, again, yesterday was a holiday amongst many asset classes and many of these cities. The CAC 40 in Italy, actually, the CAC 40 in France, it's Friday, I'm a little bit muzzled. The CAC 40 in France gaining some 1.1%. The FTSE MIB in Italy gaining 1%. Now, a couple of market prices that we also need to watch out for. Apple failed to reassure investors about the impact of tariffs, and second quarter China sales were worse than expected. Pre-market down 3% for Apple. Amazon also bracing for a tougher business climate. And then Airbnb, if you look at Amazon, down 2.5%. Airbnb, also one of the main stocks that we're watching. They said that the outlook is pretty weak on demand in the U.S. That stock price down 4.8%. So for the conversations that matter and the insights you need, let's get started.
Newsmakers and market movers. This is The Pulse with Francine Lacqua.
Well, good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London. Now, stocks higher. China says it's assessing this possibility of trade talks with the U.S. Now, Beijing cited senior U.S. officials' willingness to discuss tariffs. And speaking on Fox News, the U.S. Secretary of State, Mark Rubio, says China wants to come to the negotiating table.
Can we reach some sort of short-term accommodation with them? That's what they want. I mean, the Chinese are reaching out. They want to meet. They want to talk.
Trade tensions and geopolitical uncertainty have caused investors to diversify their portfolios and seek havens. We're delighted to be joined now by Giorgio Pradelli, a chief executive of the Swiss wealth manager EFG International, which manages more than 165 billion francs of assets. So, Mr. Pradelli, thank you so much for joining us. It's been a couple of weeks where we saw turmoil, investors trying to understand what they did. I'm sure you picked up a lot of client calls in saying what this all means longer term. First of all, how have clients been behaving?
So first of all, thank you for having me. I'm very pleased to be here. Well, you know, clients, like everybody, have been quite surprised by what has happened at the beginning of April, the reversal a week later. But I would say for the moment, we were also very impressed. Also looking back at 5 years ago or so, clients have remained very composed. They have not panicked. And depending on the asset class, actually, we saw a lot of trading activities. For example, FX, we have seen much more trading activity than before. Other asset classes, a bit more cautious.
What do you worry about the most, actually, in terms of, again, client behavior, if people want to get out of the markets, or just this volatility that could, at the margin, benefit, but also scare some people off?
Well, it's very difficult to judge at the moment. At the moment, this kind of volatility is obviously good for trading activities. For us, obviously, we worried that at some point something is going to break somewhere and then we're going to go fully risk off. But this is not our main scenario. This is not what we see. And actually, markets have rebounded very well. So hopefully this is not going to happen.
Yeah, and again, we always look at the plumbing, actually, in markets to make sure that everything's okay. For the moment, it seems that everything was fine. There's no liquidity concerns. There's nothing that makes you uneasy about the stability of the financial system.
No, this is correct. And, we watch very closely to the, for example, to the Treasury auctions. And lately, the Treasury auctions went very well, actually, with tightened spreads. So, no, we see that at the moment, the market is after the shock. I would say there was a shock. After that shock, the market is stabilizing, and now we will see how it's going to develop. Now, can we exclude that another wave is going to come? Probably not. But for the moment, is so good. For the moment.
There's also positives and negatives if you're sitting in Switzerland. I guess you're seen as a bit of a haven, but then you can also have the currency move on the back for maybe the wrong reasons.
Well, yes. I mean, obviously, for us as a business being based in Switzerland, we are a global boutique, so we are present from Sydney to São Paulo in all the major financial centers. But for us, clearly, private banking is another form of geopolitical risk diversification. At the moment, geopolitical tensions are very high, so obviously we benefit from that trend. On the other hand, we report in Swiss francs, but 50% of our assets under management of our clients are in dollars. So clearly for us, a weak dollar is not good for us. So this is where we see the other impact, which is not positive for us.
Do you think, and this is something that we've been trying to speak to, senior bankers, we asked David Solomon of Goldman Sachs, Bernie Mensah of Bank of America, whether, the geopolitics actually means that you win and lose business depending on where your headquarters. Will European, financial services get a bit more business from people that look at the U.S. and say maybe that's not the right time to bank with them?
Well, that's a very good question. It's very difficult, but what we see is that, for us, for our business, what is important is wealth generation. Mm-hmm. And for the moment, wealth generation is still okay, but also where the wealth is moving. And for us, it's very important to be very close to our clients. And at the moment, we see that actually clients like the safe haven of a Swiss private bank or Switzerland, but in general also of all the other financial centers. We are based here in London, and we see that actually London is doing pretty well in terms of capturing these flows. So we will see how it's going to develop, but for the moment, it's good. So we are quite confident.
Are you eyeing any new parts of the markets? I don't know whether we should be looking out for any new banking licenses in any parts of the world, or even M&A.
No, let's say in terms of our footprint, we are fine as we are. We are present in the major financial centers, as I said, from Australia to Hong Kong, Singapore, London, Luxembourg, Monaco, and Switzerland. And on the other side, we are in Miami, Cayman, and Bahamas. So we are okay in terms of footprint. But, for example, we opened a desk here in London to cater for Asian clients. We have seen that some clients from Asia, they actually like to diversify into Europe. And what we see is that, diversification, which is for us a mantra, a key, is not only about asset classes, but is also about financial centers. So we see that wealthy clients are trying to move their assets. As you know, there were anecdotal evidence some American wealthy clients are coming back to Europe, but, some Europeans are looking at Asia. So at the moment, it's very fluid, and, you need to be close to your clients, and you need to have people that can talk the language of your clients.
Have you seen UK clients, and this is one of the big stories that we're trying to follow here in the UK, have you seen wealthy UK clients actually move out because of some of the tax regimes imposed?
Well, yes, I think that is a fact, and because of the changes, we have seen UK clients moving, and to Dubai, to Switzerland, to Milan, to Jersey, depending on the preference. But what we have seen, on the other hand, is that they still keep a lot of the assets here, the reality is that wealthy clients are global citizens, so they might move a part of the family, they might move their residency, but where they manage money doesn't always overlap.
Are they optimistic about Europe? I think 5-6 months ago, there was so much hope that the U.S. would power ahead, and actually Europe, there was a danger that it was really left behind. And now it feels like if they do the right things, they could catch up.
No, actually, I think even in January when we were in Davos, I think that, we started saying that maybe we should rotate back into Europe. Obviously, we did not expect the 2nd of April, and we did not expect the change in Germany, which I think is I lived in Germany many years. I think it's historic what has happened. So I think Europe will do, I think, pretty well. The continent is pretty resilient, and if really Germany is going to invest all this, almost $1 trillion in infrastructure and other sectors, this for sure will stimulate the activity in the continent.
When you look at U.S. clients, or actually that U.S. base, are they waiting for trade to kind of settle down before they decide where they allocate money? Or no matter what happens, there's been a shift?
No, I think, I don't have real evidence, real data about the behavior of American clients, but I for sure see that there has been a move out of equities, that's clear. Now, for American clients, some clients love to go abroad. Mm-hmm. Other clients are very more domestic oriented. So this is we will see how it's going to develop. But anecdotally, we have heard that clients are coming back to Europe, are coming back to Switzerland, coming back to London. That's for sure also a trend.
Giorgio, you're talking about the footprint, and you were saying that you're pretty happy with the way it is now. Is there anything on the table that you would be looking to buy to add non-organically?
Well, yes. I think, our strategy is primarily an organic growth strategy. Sustainable and profitable growth has been our mantra since 2019, and we have delivered pretty well. Now, obviously, we like also to make M&A. We have excess capital. Our business model is capital light growth model, so we have excess capital. And we made a small acquisition now in February. We would love to add to where we're already present. We have simple criteria. We would like, as I said, to add where we're already present. For us, it's very important the cultural fit, because our culture is quite, entrepreneurial and I would say progressive. And on the other hand, we need obviously to pay the right price in order to achieve a return on investment of 10% over 3 years.
So this would be similar to what you bought with Cité Gestion in Switzerland, or is it also something possible cross-border?
No, also cross-border. We would love to make acquisitions in Asia. We would love to make acquisitions here in London. We would love to make acquisitions where we're already present. Now, at the moment, I must say, everybody talks about consolidation, but there are not many targets around. Now, we try to obviously be very active, and we are scouting the market all the time. But yes, we would love to do that, and we are trying to become much more systematic in the way we look at possible targets.
Why not many targets? Because it feels like actually there could be an opportunity given the market turmoil.
Well, as always, in our capitalistic model, you need a willing buyer and a willing seller. So we are a willing buyer. Not always we find the willing sellers. So, but on the other hand, obviously people know that we are interested. I think we have a good framework. I think that we know how to integrate to create win-win situations also for the companies that join us. So overall, we hope that Cité Gestion is the first of a series of acquisitions.
Wonderful. Thank you so much for joining us today. That was, of course, Giorgio Pradelli, the Chief Executive of Swiss Wealth Manager EFG International. Coming up, we talk tech. Apple and Amazon actually failed to reassure investors about the potential impact of U.S. tariffs. We'll dig into the earnings stories next, and this is Bloomberg.
geopolitical news whenever and wherever it happens. I'm David Gura in Rio de Janeiro, Brazil, and this is Bloomberg.
From our studios in New York and San Francisco, our expert hosts have the data and analysis from the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. Live every weekday, only on Bloomberg Television. Context changes everything. It's the world's second largest economy with a growing influence in global affairs. Bloomberg The China Show brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China.
We need to do more to engage the market more.
We're risk on. I think we caught a little sweet spot.
Massive savings right now.
It's already a different game.
Bloomberg The China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
It's Jobs Day, and Bloomberg has the report under surveillance.
Oh boy, do we have a wow number.
I would look at this as a shock to the economy.
Does it bleed into the labor market?
The hard data isn't bad. The soft data is terrible.
Today, Jonathan, Lisa, Anne-Marie, and Mike will bring you crucial data and expert analysis at terminal speed.
The labor market is still showing the kind of strength it has been showing.
The totality of data is showing that strength.
The April Jobs Report, today on Bloomberg.
The corporate C-suite is very much pulling back. Everybody who was an investment bank attached to their business says that the deals that we thought would happen, the capital markets deals, that's absolutely all slowed down. If you're a corporate, you're thinking through what's my CapEx like, where should I invest, are these tariffs here or not? And so why would you go out and make big decisions around that?
Well, that was Bernie Mensah, president of International at Bank of America, speaking to me yesterday about the impact of U.S. tariffs. Now, Apple and Amazon's latest quarterly reports failed to quell investor concerns about tech and tariffs. Speaking on an earnings call, the Amazon chief executive, Andy Jassy, addressed the current trade uncertainty.
Obviously, none of us knows exactly where tariffs will settle or when. We haven't seen any attenuation of demand yet. To some extent, we've seen some heightened buying in certain categories that may indicate stocking up in advance of any potential tariff impact.
Well, Apple's China sales disappointed. It warned of damage from the trade war. Bloomberg's Charlie Wells is here with the details. Hi, Charlie. What do you have?
Hi, Francine. So what investors had been waiting for was this forward guidance. And when they got it, they didn't like what they saw. Let me give you an example of that. Here's $900 million. On the earnings call yesterday, Tim Cook said that is the amount in the current quarter that Apple could face in higher costs from trade tensions between the United States and China. He also talked about China, and we need to remember how important of a market this is for Apple. We know all about these production woes, but it's also that crucial market for sales, third most important globally, and Apple reported 2.3% in declines in sales in China, which is going to take a significant hit for them. We also need to speak to the issues that Amazon as well has been having as far as China. We know that they get a lot of their supply from China, but we also need to focus in on some of the sales softness that we saw at Amazon. They did post growth of 17% in their cloud unit. That is slower growth than what we saw in prior quarters. We also know that Microsoft had that blowout number yesterday, so some competition here. When you add this all together, you can see how these shares are performing in pre-market. It is definitely not looking positive for them when you take a look at least this early trading. And this is adding to this narrative that we're getting in the Mag 7 of a divergence here between these software companies that markets actually like when they post their earnings and these more hardware, retail-oriented businesses that take something of a hit.
Charlie, thanks so much. Charlie Wells there with the very latest on some of these earnings. Now, we're also joined by Ursa Marchioni, head of investment and portfolio solutions at BlackRock, and Bloomberg's Kevin Waitlist. So Kevin does the politics. which, you need like a full-time job to try and understand exactly what's being said. And Ursula, who has a double-side job because he's trying to understand what the markets are doing. Ursula, look, there's a lot of optimism today that we wait for jobs, but that there's going to be some kind of trade, at least talks between the U.S. and China. I don't know what's priced in the markets right now. They're somewhere in the middle, so it's not worst-case scenario, it's not better scenario. I think it's just difficult to model.
I agree with you, Francine. I think that obviously good day to be on, sunny and upbeat. But if you take a step back, there's definitely a theme of duality in markets at present, which you see playing out in different facets. On the view of the US economy, and so again, soft data and hard data pointing to slightly different pictures. Duality in terms of investors' behavior and positioning towards US assets. And so US dollar treasuries on one side, US equity on the other. And then duality in terms of what we are seeing clients doing in their portfolios. So I think you're pointing in the right direction in the sense that if I start with the first of these three elements, soft data have been weakening. There's been some disappointment. Michigan, PMI, we've seen some softness coming through. I think on the hard data, to your point, we'll see, because the one coming up today with payrolls is really the first one post-Liberation Day. But so far, despite GDP contracting, we know why that is happening. So we feel that the picture is still intact. But one of the two sides has to converge towards the other. Similarly, in terms of assets, we see selling of US treasuries. We've followed the debate, especially towards the long end of the curve. The US dollar is under pressure. US equities continue to be bought. And so we were chatting around repatriation. For sure is happening. European clients are buying more European equities, but we still see a lot of US equity buying, particularly in the US. The domestic investor is buying on the dip. And so I think repatriation is happening, but it's not necessarily great repatriation yet.
Yeah. That's interesting. I mean, there's a lot, and I feel like in the market, maybe there's, a lot of market participants wanting some kind of trade deal. And it's unclear, Kevin, when you listen to what the Trump administration actually says, they haven't really backed down. They're saying that they'll get a deal, but there's no backing down. And then today there's also the de minimis. So if I'm a consumer and I buy something from China, I get taxed and tariffed.
Yeah, that's right. I mean, Trump has talked about these tariffs in so many different ways, for so many different reasons, for so many different objectives, that I think everyone's still trying to sort out exactly what that is going to mean in terms of what he's actually looking for. Yeah. And at some point, it's going to be a question of whether that economic pressure, the market pressure, all of that is going to essentially force him to accept deals that were way, way, way less than some of the things that he suggested he's wanted. And that may become the case with countries like Japan, it may become India, and it may even be the EU, depending on where they go. But there still remains that concern that he is simply looking for things that countries are unable or unwilling to offer. But you are watching the effects start to play out in ways that consumers are going to notice. The de minimis one is interesting because on some level, this is about small packages. This is about ordering things from Amazon or Temu or Shein, and it is about trying to sort of stop what had become, from the Trump perspective, a bit of a loophole for avoiding tariffs. This really is mostly small products, but it is products up to $800. Yeah. And so, there is some ability to try to, I think from the Trump side, constrain that ability for the Chinese sort of to be flooding low-cost goods into the U.S.
And how do you manage that volatility, again, until we figure out exactly what the end goal is of all of this exercise?
Agreed. So I think that as we decode how supply chains will evolve, and are we going to see a hit on margins if companies take the pain or they pass it on to the consumer, and so we're going to see a hit there. I think we have to go back to that duality element that I mentioned. So from a long-term perspective, I'll quote my colleague and friend Simona Paravani, who's the CIO of our solution business within multi-asset. She summarizes by, we know the starting point, but we don't know the destination. We don't know where we're going. And as I speak with CIO in the UK, on the continent, that is clearly the theme that is emerging. So my view is that it is an opportunity to continue to buy on dips on the themes that we have conviction on. So, for example, European banks will be one. Another one would be the AI theme. We've seen it this week through earnings, particularly software and AI adopters. So trying to capture a broader component of the value chain around AI beyond simple tech. So that is clearly an element. But again, Francine, I profoundly believe I pick up a strong desire to redesign benchmarks. So I think that end point that we're going towards will be different. There'll be, less world, more Europe. There'll be less market cap, more equal weight. So that's one element. In the short term, and so that's the other side of the equation, we need to continue to be defensive. And so ideas such as, from a factorial perspective, minimum volatility, quality, high income stocks, great way to buffer potential downturns, and from a sector perspective, utilities and healthcare. So I think these two perspectives need to be very crystal clear in every action that we take in portfolios.
Oh, I want to ask Kevin about the security advisor in a second, but how do you deal with stagflation risks? Because that's kind of, again, it's too soon maybe to worry about it, but it changes everything if it happens.
It changes everything, and we have seen such a pickup in terms of scenario testing that our clients ask us to help them do, and the frequency of requests around what you're describing is clearly, skyrocketing. So I think there's a theme of diversifiers within portfolios. So, strategies along the lines of absolute return, systematic, long, short, as well as more classic ways to diversify. Think about gold, which has obviously done a lot, but as we follow the philosophical discussion around the dollar and what is its future, I think there's still an element there. So you're right, Francine. I think that element of the tail risk, that tail has become fatter, and so we need to pay attention to it. 100% agree with that.
And then again, I don't know what to do with the Trump approval ratings, whether that will change policy. And Mike Waltz got kicked out as national security advisor. So, I mean, Rubio has many jobs, but also, is this because of the approval ratings, or was it really because of the signal leak?
I mean, I do think the Waltz ouster was almost entirely about Signalgate, and I think also the way he reacted to Signalgate by trying to sort of pretend that he hadn't made a mistake and that it was somehow a software glitch, which I think didn't really fly with anyone who's really used iPhones or Signal. So I think that never quite tracked with people, and I think that ultimately that simply became too much of a problem. There also were a couple outside Trump allies who were campaigning against him quite openly, and I think that may have been an influence as well. I think more broadly that approval rating thing is going to become a problem for him. His approval ratings really are low. It's not going to be yet, but at some point Republicans in Congress are going to have to be looking, they're going to start turning their attention toward the midterm elections. They're going to start thinking about their futures. They've got something to worry about there. And it's the same dilemma they've had all along, is Trump can win them primaries, but increasingly may not be able to win them general elections. And so they're going to have to at some point make some difficult decisions about when they want to say no to Donald Trump. And I think that's the thing we'll all be looking for.
Okay, well, thank you both for joining us. Ursula Marchioni, Head of Investment and Portfolio Solutions at BlackRock, and Bloomberg's Kevin Whitelaw. Now, this is Bloomberg. We have, of course, that big jobs data a little bit later on. That's pretty much the finish of a very busy week, so we'll have a market check. This is Bloomberg.
What makes it India's time?
It's us women who are going to transform India. I truly feel that the time for Indian women has come. They're not only breaking glass ceilings, but they are redefining, whether it is in sport, whether it's in medicine, whether it's in creative arts. They are everywhere, and I have so much positive energy that comes back to me when I'm talking to Indian women. And I just think at all these little girls and boys, I don't want to discriminate, who are now in school-going age. Imagine once education, sports, we empower them. What a difference they would make not only to India, but to the planet and the world. And the world needs it now than ever before.
Is this a negotiation or the new rules of the game?
It could be either.
It is up to the president how he wants to negotiate.
The higher the tariff, the faster they come.
A 90-day pause is not an eradication.
The trade negotiations are moving quickly.
There will be deals cut.
Trust Bloomberg for all the context and clarity you need as the tariff and global economy story evolves.
This year's bear case, very quickly, becoming the base case.
Nobody covers tariffs like Bloomberg. Context changes everything.
Our global headquarters in New York, I'm Danny Berger. Welcome to Bloomberg Brief. Let's set your agenda.
Bloomberg Brief delivers the market news, data, and analysis you need live every weekday only on Bloomberg. Context changes everything. It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
Well, good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London, and these are your top stories. Global stocks make gains as China hints at possible trade talks with the U.S., but Beijing says unilateral tariffs must be scrapped first. Amazon and Apple disappoint with warnings about the potential impact of U.S. tariffs on their costs. NatWest and Standard Chartered earnings beat as traders cash in on volatility and customers show resilience. Now, Bloomberg has learned that the EU is planning to share a paper with the U.S. next week, setting out proposals to kickstart trade talks with the Trump administration. Now, on top of tariffs, the continent is also trying to get the U.S. on side when it comes to discussions to end the war in Ukraine. Now, let's discuss all of this with the former Italian Prime Minister Enrico Letta. Mr. Letta, thank you so much for joining us. I mean, first of all, geopolitics is pretty complicated at the moment. It's, it changes by the minute. What's your assessment of the role that Italy has at the center of geopolitics right now? Can it be a help and a bridge between the U.S. and Europe?
This is what the government is trying to do. I think it's not easy for a very simple reason. I think that Europe has to be united today. And if I'm not wrong, it's the only way to convince Trump and not to be I would say, too aggressive against Europe. The only way to convince him is to be united. And the European Union, we are lucky because the rules are allowing us to speak with one voice, the famous single telephone number that Kissinger asked in the past. We have it on trade. And so I think it's very important for Europe to use this single voice on trade that is crucial and fundamental. For the rest, all the efforts to, I would say, to keep the two sides of the Atlantic more united are good. And I think if Italy helps and if the Italian government helps in that direction, I think it can be good. But some degrees of skepticism in the way in which with Trump that can be useful.
What do you see the future of Europe? Again, it feels at times where this could be the moment that Europe stands up, does better, and actually has a real voice, or it could be stuck between this U.S.-China trade war.
In reality, Trump pressure can be a great opportunity for Europe. I'm among those thinking that Trump can be a great federator from abroad, because it is clear that today we have to be united. There's no possibility to be successful fragmented. And the other key point is the fact that the European Commission program, the competitiveness compass that von der Leyen presented 2 months ago, is very much oriented in integrating the European single market, because the most important fact is the single market. The single market is our strength, but in reality, we are united in some part of the single market. We have the same currency, almost all the European countries. But for instance, on finance, on telecom, on energy, we don't have one single market. We have 27 markets. And that is a big, big issue for Europe. This is why, for me, the most important achievement should be passed from 27 to 1 in these fields. So financial markets, telecom, and energy.
Do you see an appetite actually for Europe to become more competitive? And if you look at some of the big changes that we've seen since the start of the year, maybe German defense spending is something that we weren't expected that could really catalyze the region.
I think defense would be an important boost to be more integrated, because you have countries that are not very happy in having European common fiscal capacity, in theory, like Germany or like for instance, the northern countries, or like the Netherlands. When we move to defense, they want to have a European fiscal capacity on defense. They seem to be open on that. And that can be a great leverage, in my view, to find more integration in finding resources. But I am strongly convinced that the true point for Europe, the game changer in Europe, will be the creation of one single market on finance. The fact that the European Commission took the proposal of the Savings and Investments Union, so passing from the unsuccessful Capital Markets Union of the last years to the new Savings and Investments Union, with the idea to mobilize private capitals for the European common goods with one financial market and not 27 financial markets. I think this is the game changer. The Commission presented the proposal, and I think it's a good first step. I know the countries, and many countries, are pushing in that direction. We have to be fast on that.
Do you think Vladimir Putin is playing Donald Trump on this Russia-Ukraine possible peace deal? And where do you see the conflict headed?
Frankly speaking, I would be very happy, and we are all waiting for a ceasefire, for true negotiations, for agreements. But I think my guess is that the present U.S. administration was, until now, a little bit superficial in considering how easy could be to have a peace agreement. Peace agreement is very complicated. And is complicated also for a very simple reason. We have to agree on one point. Are the Ukrainians free to decide where they want to be or not? This is the key point. And this is the key difference between Europe and Donald Trump. Because the feeling is that in the US administration today, there's an attitude that is different, in which it is, I would say, a great conversation between the great leaders that will decide where Ukraine has to be. For us, the Europeans, I think it is in the hands of the Ukrainian people to decide. And this is, in my view, the key difference, the key issue. Then we can have, or they can have, discussions on territories, on borders, but the substance, the core is, do we agree that is in the hands of the Ukrainians to decide where they want to be? In Europe, close to Russia, where? And it is their decision, not our.
Mr. Letta, what do you most worry about, actually, given all of this turmoil? Is it that Europe maybe splinters? Is that, what President Trump is trying to do? Or is it that prime ministers just have too much to deal with, and so maybe don't focus on the single most important thing, which is reconnecting with the voters?
I think your third point is very important. The key problem for Europe is today we are after a long period in which the European Union was obliged to react to crisis. And reacting to crisis is something that Europe can do and is prepared to do. The big problem is that today we need to plan, we need to act, not to react. Because in reality, what I said before about the integration of the single market, something that can't be just a reaction. We have to plan to build up the savings and investments union, to build up one telecom market in Europe, one energy market, and we need to be focused on that. The big risk, as you said correctly, is that tariffs on one side, Ukraine, Russia on the other side, will absorb all the political energies. And in reality, the agenda of the European Union has to be competitiveness and security. And when I say security, I say energy independence, I say the capacity to have a connectivity, unique connectivity, the capacity to be independent in terms of technique. I'm a little bit scared when I listened some weeks ago, Elon Musk addressing Ukrainians saying, if I disconnect Starlinks, you collapse. Because in reality, that could be also the same message for the Europeans. We are dependent on technology, we are dependent on satellites, we are dependent on finance, and we have to be more autonomous and more independent. And this is a plan that Europe has to run.
Mr. Letta, thank you so much for joining us. A lot to unpack there, so I hope you join us again really soon. Enrico Letta, the former Prime Minister of Italy, Jacques Delors Institute President and Dean of IE University. Now, since Donald Trump returned to the White House, Elon Musk has been a scene stealer, gutting government agency and sparking litigation. But Doge has not lived up to its billing, while Tesla has become collateral damage. Well, that's the topic of our weekly doc.
The marriage of money and power is nothing new, but the arrangement between billionaire Elon Musk and President Donald Trump is like no other in the history of U.S. politics.
Come on up here, Elon. They're buddies. That's probably a good description, at least how Elon Musk sees it.
Donald Trump needs his fall guy, but he also needs the bulldogs, and sometimes they're the same person.
It's been a crazy 100 days.
You look around the U.S. government right now and you see friends and allies of Elon Musk in all these various departments, in all these various top leadership roles.
Trump has been able to get Elon Musk to help propel through all the changes that were spelled out in Project 2025, a blueprint for reshaping the government.
In Doge's mind, they've been wildly successful. And on the flip side, there is a cost to laying off federal workers, to fighting all of this litigation in court.
Musk is known for his uncanny ability to play a long game, but he may not have expected so much public blowback.
So Tesla's sales really dropped. Their first quarter sales were 13% lower than the quarter a year ago.
Starting in May, my time allocation to Doge will drop significantly.
As Musk pivots, the struggles surrounding Doge's actions continue, while many Americans are reeling from a tumultuous 100 days.
Musk isn't really leaving the Trump administration.
It's not like Doge is ending. I mean, Doge is a project that's supposed to continue until July 2026.
One thing we've learned over this last 100 days is that there is going to be a huge cost to Elon Musk for doing the things he's doing. He has basically taken his personal brand and tarnished it. And that's what happens when you put yourself front and center of some extremely controversial and often unpopular policies.
Well, you can get more on Elon Musk's relationship with President Trump in the new edition of the Bloomberg Weekend newsletter, which has deeper analysis, but also feature pieces and profiles that provide unique insight into the latest news from around the world. Now, here in the UK, the Prime Minister, Keir Starmer's government, Labour Party, has lost a parliamentary by-election to Reform UK Party, led by Nigel Farage. Labour went into the election defending a majority of more than 14,000, but they lost a seat near Liverpool by just 6 votes, making it one of the tightest margins in British electoral history. And Australians vote in a national election tomorrow that's been dominated by the cost of living concerns, but hasn't escaped the shadow of the Trump trade war. The Conservative opposition leader Peter Dutton began the campaign with a healthy lead, but as Paul Allen reports, more recent polls suggest that Labour's Anthony Albanese could become the first Australian leader in more than 20 years to win back-to-back elections.
Saturday is election day in Australia, and already more than 3 million of the country's 18 million voters have cast an early ballot. For those still undecided, this election's boiling down to one key issue.
Is anyone feeling that you're better off today than you were 3 years ago?
Cost of living and runaway real estate prices are top of the domestic agenda. It's a battleground where both opposition leader Peter Dutton and Prime Minister Anthony Albanese seem comfortable. Trade and foreign policy, though, have left both leaders squirming after President Trump imposed a shock 10% blanket tariff on all Australian imports. Dutton initially copied some Trump policies, including spending cuts styled on Elon Musk's so-called Department of Government Efficiency and ending work from home for civil servants. He's since dumped those ideas and has been distancing himself from the US president.
We trust the United States, and I don't know the president. I've not met him. The Prime Minister obviously has been able to.
So you're not willing to say you trust Donald Trump?
I don't know Donald Trump is my point.
On the same debate stage, Albanese also swiftly moved on from the issue of trust in Trump.
I have no reason not to. I've had a couple of discussions with him.
Do you trust China's president, Xi Jinping?
I have no reason not to either. China's our major trading partner. 1 in 4 Australian jobs depends upon trade. It is in Australia's national interest to have a good economic relationship with China.
Australia has already made a $500 million down payment to the United States under the AUKUS Defence Pact, which will see Australia receive nuclear submarines. Neither major party wants to risk sinking that deal by alienating President Trump, nor risk creating a fresh round of trade tension with China by getting too close to him. Unlike the price of eggs, those issues are too fragile to be on the ballot this Saturday. Paul Allen, Bloomberg, Sydney.
Coming up, emerging markets have outperformed during President Trump's first 100 days in office. We'll discuss the outlook with PIMCO's Yakov Arnopoldin. This is Bloomberg.
Listen carefully. Can you hear the rhythm in the markets? Not just in the syncopations triggered by inflation, but in the preludes leading to global elections, in the dissonance that moves the Nikkei, and the rising course conducted by AI. There's music in the markets, and if you want to learn to listen for it, we'll show you how.
US tech is influencing global markets.
Technology is driving business across Europe.
Companies in Asia are betting on tech.
Africa, a region rife with potential for growth and opportunities, but not without its challenges. Bloomberg highlights the biggest stories, interviewing key players, and reporting on the issues impacting the region. Join us as we get to the heart of African business, politics, and economics, and ask the question, what's next? I'm Jennifer Zabasaja, and this is Next Africa.
New episodes every month, only on Bloomberg.
Welcome back, everyone. It's been another bumper day of bank earnings. I feel like we say that every day. Beats from both NatWest and Standard Chartered. Now, NatWest has pointed to improving earnings this year as the bank's customers proved resilient to the unfolding strains of the global economy. Standard Chartered saw the bank's wealth and financial markets units driving profit, while the bank's chief financial officer, Diego Di Giorgi, spoke to us earlier about the impact.
We don't see evidence of a real asset reallocation away from the US or away from the dollar. We are seeing it mostly, as I said, in the nature of the investments. The investments in the short term are becoming more defensive.
Let's bring in Tom Metcalf, Bloomberg's managing editor for EMEA Finance and Investing. So what stood out to you, Tom, and welcome back to the Pulse.
Thank you very much. Yeah, I think on Standard Chartered, it was this big wealth inflow they saw, how strong that unit is performing. I think the CFO brought that up on the TV show. And broadly speaking, it's been a funny quarter because banks like Standard Chartered saying they're doing very well, saying they're not seeing too many sort of ructions from all the tariff turmoil. But at the same time, obviously, that's in the back of everyone's mind. And pretty much every bank we've been covering has had a pretty strong quarter, pretty benign at least. But obviously, when you look at the share price today, for example, Standard Chartered actually down slightly. And I think that's just the sense that, you know, everyone's in wait and see still. And maybe the second quarter will give a bit more clarity on, you know, exactly how to position yourself around bank stocks.
Yeah, early days. But again, for the moment, okay, Tom, thank you so much for of course, all of the work that you and your team have done in earnings season. Now, emerging market traders are shifting their attention to the path of the global economy and the U.S. dollar after assets from across the developing world posted unexpected gains at the start of Trump's administration. So let's discuss the outlook with Yakov Arnopolin, emerging markets portfolio manager at PIMCO. Yakov, so good to speak to you. I mean, there's been quite a lot of you know, different market reaction from the emerging markets. Is it still the difference between the ones that did the structural work and the ones that haven't?
Yeah, well, good morning. Thanks for having me on. Obviously, there's always a lot of moving pieces in EM, but ultimately we've had a very distinct reaction because naturally even the tariff rates imposed on Liberation Day on the various emerging markets have been quite distinct. LATAM on the lower side, closer to 10%. Now, Asia, obviously, much harder hit. But we have to recognize this is not growth positive for emerging markets, far from it. Yep. And yet, to us, equities here are far more exposed and far more vulnerable than fixed income. Look, also it's interesting, EM currencies, EMFX, has actually been bolstered by the weaker dollar, right? So to the extent we've had EMFX stable or even stronger, that means less of an inflationary pass-through, so less concern for central banks. Very much.
So actually, you know, for the moment, I guess it depends the level where dollar settles, and no one likes volatility. But if it stays around these levels, or even continues to weaker a little bit, who benefits the most?
Look, if you're an EM central bank and you recognize tariffs will certainly be a growth shock and potentially a demand shock, if we look at places like Mexico, Colombia, Brazil, the growth backdrop is challenging. But the good thing here is that stronger currencies, stable currencies, allow them, as I was saying, no inflationary pass-through, so they can actually cut rates, introduce anti-cyclical measures to bolster growth as much as possible.
Yakov, when you look at some of the regions that you cover, does it depend on whether you're trading with China? Actually, is that the big difference? That if you're exposed to China, then maybe you're going through a tougher time. But it feels also that the Chinese economy is stronger, so some of the, for example, the Asian countries could benefit from that indirectly.
It certainly matters. I think again, it's about figuring out the supply chains and where is the direct hit going to be. To us, again, Asian effects may be more vulnerable on the back of that because the tariff shock has been greater. Therefore, more reason to weaken the effects to accommodate the tariffs. Having said that, fairly concerned about Europe. So to the extent the U.S.-China standoff continues, and there are fewer of Chinese exports going to the U.S., where will they go? Well, they'll probably go to Europe, meaning more of a disinflationary impact towards Europe. So if you look at our positioning, we've been quite constructive on the back of that on CE3, so Eastern European local bonds, places like Hungary, Czech, Poland.
What about Brazil and Colombia, for example? I know there are some of the countries that you're looking at with the idea, again, if they have stronger currencies, that it means that they can cushion the impact from inflation.
Yeah, look, that's where front ends of local curves make a lot of sense. Yep. In Mexico as well, when we look at the currency, people are quite surprised. The Mexican peso is stronger against the dollar than it was going into the U.S. election. People say, well, why has EM been so resilient? And it comes down to the fact that people just don't own the asset class. It's so underallocated. We've had years and years of outflows as investors moved capital out of EM into the U.S. So now, again, why the resilience? Because no one really needs to sell it. No one needs to sell the asset class. And if anything, we're actually witnessing more European, US, Canadian pension plans thinking about allocations and likely shifting more towards EM hard currency and certainly far more towards EM local.
What about Mexico? What did you do with Mexico?
Look, I have to say, President Sheinbaum has dealt with the Trump administration very, very deftly. Yeah. So they're constructive on credit, sovereign credit, quasi-sovereign credit. Local fixed income makes sense, again, because of this low growth backdrop, and fairly constructive on the currency. So I'd say that probably is a country, while it was expected to be in the U.S. crosshairs, because of how well they've navigated this environment, and actually been one of the EM beneficiaries.
Yeah, I guess the problem with figures such as President Sheinbaum is that you don't know how long the friendliness lasts. Sure. So for the moment, she's been very able. She's been able to, tactily, I guess, negotiate. But the Trump administration can turn around.
Absolutely, have to be cognizant of that. This is where I feel people forget just how much remittances, in other words, money sent by the diaspora back home to relatives back home, have been supportive of some of these emerging market stories and how countercyclical they are. Because in times of stress, in times of uncertainty, people actually send more money back home. So we saw it during Trump 1. We're seeing a spike in remittances now with Trump 2. So back to Mexico, 3.5% of GDP in remittances, something like $65 billion, highest ever. Then in Washington, D.C. last week, I saw the finance minister of Mexico, Guatemala, Pakistan, exactly the same. So sky-high remittances on record, same for Guatemala and Pakistan, which again are supporting these currencies, supporting the home countries, supporting the current accounts, and actually creating stability in times of instability.
What surprised you the most in the last 3 months?
Look, I think it's as always, sometimes it's more the idiosyncratic stories, because to me, when I think about EM sovereign credit, that's probably going to be fairly resilient despite all this tariff headlines. But we look at idiosyncratic stories, looking at the elections in Romania this week. There'll be elections in Cote d'Ivoire, Ivory Coast later in the year, and a very positive resolution in Ecuador. So the market-friendly candidate, Noboa, was reelected. More IMF engagement, and in the meantime, you have bonds trading high double digits, well, high teens rather. So a lot of interesting opportunities, and I think people, if you kind of parse through everything that's going on, certainly a few gems emerge.
Jakob, when you look at, I guess, the modeling is extremely difficult. Mm-hmm. Do you actually look a lot more at the oil complex and the energy complex to decide what you do or how you forecast some of these emerging market countries?
Inevitably. And that's also a question mark of how long do low oil prices last, and do they go lower from here or stay at these already somewhat depressed levels? So there, one place where we've been very, very involved, that certainly has been buoyed by low oil prices, is Turkey. And another, I mentioned Pakistan already. Again, very sad to see this, the tragic terrorist attack and the current standoff, the saber rattling, which we very much hope comes to an end very soon. But Pakistan has a huge benefit. Sri Lanka, huge benefit from lower oil prices. So to the extent the India-Pakistan standoff hopefully abates, that's a place where you can have really solid returns on their fixed income, and the country has been growing out of the crisis of the past couple of years.
Jakob, thank you so much, as always, for joining us. That's Jakob Arnopolen, Emerging Markets Portfolio Manager at PIMCO. Now, don't forget the new edition of the Bloomberg Weekend Newsletter, which I think you can get from today. It has analysis, feature pieces, profiles that really provide some unique insights into the latest news from around the world. Up next, Bloomberg Brief. Of course, today is also U.S. jobs. Look, investors may be betting that the Fed will accelerate the interest rate cuts to head off an economic slowdown, but will we get confirmation of that today?
Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern. Only on Bloomberg. Context changes everything.
What would it mean for India to host the Olympics?
Linda, I don't think it's my dream alone. I think it's a dream of 1.4 billion Indians to see the Olympics being held in India. I think once sport takes over, the transformation will be seen, not only in the lives of the youths, but in the economy of our country. India is one of the biggest centers for digital usage, and 1/3 of the viewership of the Olympic channel comes from India. So India as a sporting market is huge.
Countries which have hosted the Olympics have always grappled with the issue of infrastructure, for instance. Building it is one thing, maintaining it is another. How can India do it differently if it were to host the Olympics?
So I think we're talking about innovation and sustainability. And I think the same holds for holding the Olympics. What if you look at a sustainable model? What if you look at refurbishing old stadiums, reusing what we have? So I think the move has to be a sustainable move.
Jumpstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action. We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets.
With the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling. Join us on Bloomberg Open Interest. Every trading day, only on Bloomberg.
What is going to be the consequence for U.S. markets? We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
Good morning from our global headquarters in New York. I'm Danny Berger. Welcome to Bloomberg Brief. Let's set your agenda. Healthy but moderating, it's jobs day in America. Economists expect it to be the last report before tariffs start to bite. The stalemate thaws. China says it's evaluating the U.S.'s overtures on trade talks, and futures push higher. But tech renews tariff fears. Apple and Amazon failed to ease concerns, bracing for the tough road ahead. Now, even though Apple and Amazon are lower in the pre-market, we are still in the green this morning. In fact, we are on track for a 9th straight day of gains. We've already put 8 of them in this morning. We're higher by about 1/4 of a point. It's the best 8 days since 2020. You can see NASDAQ futures underperforming, little change because of Amazon and Apple earnings. When it comes to this bond market, it was yields higher as much as 10 basis points for the front end. We come off of that a bit this morning. Perhaps it was the ISMs yesterday. Look, it wasn't pretty, but it wasn't as bad as expected. Lower by 1.5 basis points. Your 10-year yield at 4.19, lower by 2 basis points. We're gearing up for jobs day, 8:30 a.m. The expectation is 138,000 jobs. All right, let's head over now to Valerie Teitel, who's got you some stocks to watch. Good morning, Val.
Good morning, Danny. Happy Friday. Happy Jobs Day Friday. Let's check in on how those Mag 7 stocks are doing after they reported late last night. Amazon and Apple both to the downside. These could be the first of the Mag 7s to actually fall after their earnings release for this current quarter. Amazon giving a disappointing forecast, and Apple upsetting on their China revenue. And also, investors did not like that they might lose nearly $1 billion in the current quarter due to tariffs that did not assuage investors' fears. Let's stay in the tech sector and move on to the digital payments company Block. Take a look at this movement, Danny. They are losing 1/5 of their value, down 22%. They gave a profit forecast that disappointed investors, and they're suffering from some downgrades from across the street. Let's end on the stocks to watch this morning. We have oil majors reporting this morning. Chevron and Exxon are the ones to watch. Will their production plans be changed at all due to the recent plunge in oil prices? Keep an eye on their buyback plans as well.
Valerie, really appreciate it, and we'll catch up with you later in the hour. That is Bloomberg's Valerie Teitel. Also in this hour, we'll be speaking to Sam Linton-Brown of BNP Paribas, Citi's Veronica Clark, and Joel Kulina of Wedbush Securities. Now, markets have staged a stunning comeback since April 2nd, so-called Liberation Day announcement. We're now just about 1% away from that level, actually 0.5% away from that level. And it's been the classic rally that we so have come to expect to experience. Big tech and cyclicals outperforming defensives. Joining us now is Sam Linton-Brown, head of global macro strategy at BNP Paribas. Sam, always fantastic to see you. Happy Friday to you. Do you think that this quite remarkable turnaround, this risk-on rally, can sustain itself?
Good morning. Thank you for having me, and happy Friday.
We think positioning has really played a major role in the moves that we've seen. The proprietary quantitative positioning indicators that we run at BNP Paribas signals that a broad range of investors got sort of too short US stocks. So we think what we're seeing is more fundamentally a technical positioning squeeze. So the question then I suppose one should ask is, well, when do you fade it? Where do you fade it? Here I'd point to the currency market. We think that the squeeze that we've already had in euro dollar lower, the sort of retracement, that's a fade. That's a fade.
So is the more telling signal then from what the bond market and what oil is telling you? Because I'd say it feels like cross-asset-wise, we're quite disjointed at the moment. Stocks have this remarkable 8-day rally, but we're still looking at WTI below $60 a barrel. You're looking at 10-year yields that are still something like 4.2%. Is that the better indicator that seems to be telling you something about the dire situation of growth?
At a time where there's so many cross currents, as you say, different markets seem to price in different backdrops. And again, I think it really points to how important positioning is at driving these markets at the moment. If you look at stocks over the month, as you just pointed out, the S&P is effectively flat. So that's saying sort of no panic. In contrast, if you look at the energy market or if you look at the currency market, energy is significantly lower, the dollar is significantly weaker than it was at the time of the Liberation Day announcements. I think for the bond market, that's where the pricing here is very difficult for the market to really grapple with, because you have, in some respects, a bimodal distribution. There's a scenario where tariffs get rolled back, US growth slows, but not to the point of recession. Inflation is high because of tariffs, and the Fed actually don't cut rates. They leave policy on hold, they leave policy stable. That's one scenario. The other scenario, though, is one in which tariffs don't get rolled back. US growth slows significantly, we enter recession, and then the Fed cut a lot. And I think that when you mention 10-year Treasury yields at 4.20, we're caught between those two scenarios.
So what do you need to wait for that to happen? This is an administration that has used uncertainty to their advantage, they say, for negotiations. Will we really get more certainty? How does this narrative resolve itself?
I think for the bond market, what we've learned over the past month that's important is the US administration appears to have a pain threshold in treasuries. If we go back 6 weeks ago, the market was probably more focused on a pain threshold in stocks. That proved to be wrong. If you like, sort of the strike on any S&P put from the administration was quite low. But what we've seen is on bonds, it might actually not be very far away from where we currently are. I say that because we had the 90-day pause of reciprocal tariffs that followed 3 days of a significant sell-off in the Treasury market, 60 bips in 3 days from the 7th to the 9th of April. I also say it because we saw that the dial back of the more hawkish language towards China and towards Powell last week, Monday, came following 30-year Treasury yields getting up towards that 5% level. So I think the market takes some comfort, if you like, and perhaps that's contributing to the squeeze we're seeing in stocks, that the administration seems bond sensitive.
So then how big of a concern is it to hear from Japan's finance minister just overnight, Sam, saying that the country's massive holdings of U.S. Treasury, which is the biggest of any foreign entity, could be used in negotiations? How big of a threat would that be for the bond market if you do get the Japanese starting to sell their bonds as some sort of negotiating tactic with the U.S.?
I think that's unlikely. There's been a lot of focus in the market recently on whether or not reserve managers have been liquidating treasuries. There's really no data to suggest that's happening in any of an accelerated fashion versus history. I think for global investors, less on the reserve side, more on the institutional side, the question is less about liquidation of treasuries. It's more about, will the marginal dollar over the next decade be allocated to the US in as significant a portion as it has over the previous decade? And our view is no. We think that we're going to see more money allocated in particular to Europe. The Trump sort of inspired or at least accelerated shift in Europe towards more spending on energy, on infrastructure, on defense, that's really here to stay. And that's going to significantly increase bond supply in Europe and support growth over the next 5 years. That should lead to some capital reallocation and is constructive in the medium term for Eurodollar to go up.
Hey, Sam, before we let you go, I just want to get your thoughts for 3.5 hours' time when we get the U.S. jobs report. What's the bigger risk for this market? One that surprises with strength or weakness?
I think for the market, the bigger risk is weakness, because as you alluded to in the opening remarks, the consensus in the market is that we're going to get a pretty solid print today, 138K median consensus according to Bloomberg. Our view is 135K, not too different. That's in the middle of the range at the moment between the break-even level of payrolls that we think is between 100 and 150. So this is data that should mean the unemployment rate is stable. I think if we were to see a quicker deterioration in some of the tariff-impacted industries than economists are expecting today, then that could lead to the market pricing in a much quicker pace of Fed rate cuts, could lead to some of the strength we've been seeing in U.S. stocks challenged, could lead to the dollar resuming its weakening trend, in particular versus euro and also the other low-yielding currencies in Asia.
We'll see what happens with almost already 4 quarter points cuts priced in so far this year. Sam, thank you so much for joining us this morning. Enjoy the rest of your Friday and your weekend. Sam Linton-Brown at BNP Paribas. Let's get you some other top stories now that are trending on the terminal this morning. Online retail platform Temu is changing its business model in the wake of Trump's tariffs. It's moving away from cheap Chinese imports, and instead it's recruiting U.S. merchants to sell their goods to American consumers. Temu says prices for Americans will be unchanged. And Japanese Finance Minister Katsunobu Kato says the country's U.S. Treasury holdings could be a negotiating card in trade talks with Washington. He did qualify. Whether or not we use that card is a different decision. Japan holds the largest stockpile of U.S. debt held by any foreign nation. President Trump says that he will nominate National Security Advisor Mike Waltz as the next U.S. ambassador to the UN. The move sidelines Waltz, a top aide who drew criticism for inadvertently adding a journalist to a Signal group chat where officials discussed sensitive military plans. Marco Rubio will serve as interim National Security Advisor while keeping his job as Secretary of State. Coming up, China weighs the possibility of talks with the U.S. More on the thaw in the trade standoff. That's coming up next. Stick around on your Bloomberg Brief.
To Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg.
Asia is at the forefront of some of the world's biggest stories.
And we're here, where the action starts in Sydney.
And in Tokyo, get ahead as the global trading day begins.
The Asia Trade, weekdays only on Bloomberg.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm David Gura in Rio de Janeiro, Brazil, and this is Bloomberg.
Jumpstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action. We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets.
With the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling. Join us on Bloomberg Open Interest. Every trading day, only on Bloomberg.
It's Jobs Day, and Bloomberg has the report under surveillance.
Oh boy, do we have a wow number.
I would look at this as a shock to the economy.
Does it bleed into the labor market?
The hard data isn't bad. The soft data is terrible.
Today, Jonathan, Lisa, Anne-Marie, and Mike will bring you crucial data and expert analysis at terminal speed.
The labor market is still showing the kind of strength it has been showing.
The totality of data is showing that strength.
The April jobs report, today on Bloomberg.
Can we reach some sort of short-term accommodation with them? That's what they want. I mean, the Chinese are reaching out. They want to meet. They want to talk.
U.S. Secretary of State Marco Rubio speaking on Fox News. It comes as China's Commerce Ministry said overnight that it is evaluating the possibility of trade talks with the U.S., saying, quote, the U.S. has recently sent messages to China through relevant parties, hoping to start talks with China. China is currently evaluating this. Here with the latest is Bloomberg managing editor Kevin Whitelaw. So, Kevin, at least for the markets, we celebrate the thinking of talking, of maybe talking about the U.S. Where exactly do we stand with China in American negotiations?
Well, it really seems to be that both sides want to pretend the other one's the one that's trying to start the conversation here. But in this case, I do think that obviously the Trump administration is the one that had put all these, enormously punitive tariffs on first, and they kind of went back and forth. So I do think the Chinese up to now have kind of felt that it's up to the Trump administration to begin those conversations. For the Trump side, they're now trying to have conversations with multiple countries, dozens of countries in some ways, and it's just not clear they have the capacity to do it, in part because ultimately there's only one decision maker when it comes to any tariff deal, and that's the president himself.
Yeah, it's such a problem, and it even goes to show countries like Japan making headlines about getting closer to a trade deal. But Kevin, this was supposed to be the first country where we got some sort of agreement, wasn't it?
It was certainly, they seem to be at the front of the line. But I think the deeper problem still is that, Donald Trump has articulated several different philosophies and strategies behind these tariffs. And one of those has been, boosting U.S. revenues and to be able to reduce or even eliminate the income tax. Well, if that's the actual idea behind this, and he's been bragging about some of the revenues, you can't negotiate tariffs away. There won't be any deals. But obviously, I think when you're looking at some of the economic impacts, and I think the U.S. consumers are going to first see them related to goods from China, that's going to start playing out over the coming weeks and months, whether with shortages of certain products, whether it's with price increases. That's going to be an enormous problem as people start to say, wait a second, this isn't what we voted for.
Speaking of economic impacts, on one hand you have tariffs, on other there's this idea that some of the fiscal excesses will be reined in when we get a budget. We had a proposal from the Trump administration for a 2026 budget. Kevin, what did it look like?
Well, this is obviously very, very deep cuts to domestic spending and a very, very significant boost to defense spending. This is kind of what had been telegraphed. I think actually the defense spending boost is maybe bigger than people had expected in the budget. But what I would say is this. Presidential budgets have never once been passed without massive changes to them. It's just never happened. So this really is a starting point for the conversation. This is going to be extremely complicated to get a budget through Congress. You're going to be dealing with a House where the Republicans have an incredibly slim majority and a Senate where they need to have 60 votes to pass a spending bill. And that means Democrats have to go along with it. There's just no way Democrats are going to sign off on the kind of spending cuts on the domestic side that the president is proposing. So, this is really going to be an extremely complicated set of challenges they have going ahead.
Kevin, thank you so much for your time this morning. Bloomberg's Kevin Whitelaw there. Now let's turn to U.S. earnings, and about 2/3 of companies on the S&P 500 have released results, including some of the big ones. Amazon and Apple were out yesterday after the bell. Apple's analyst call did fail, though, to soothe investor concerns about the cost of tariffs. CEO Tim Cook spoke about the importance of diversifying their supply chain.
What we learned some time ago was that having everything in one location had too much risk with it.
Here with the results is Bloomberg's Charlie Wells. Charlie, so Apple disappointing.
Danny, this was the thud in tech earnings that everyone was worried about, and it certainly reverberated throughout a lot of this pre-market trading. And I think the issue here was this forward guidance that came through that was very negative. So Tim Cook talking on that earnings call about $900 million in increased costs in the current quarter that they could face thanks to these trade tensions between the United States and China. And we have to focus on China too. We heard him right there talking about diversifying the supply chain, but you also have to think about sales, right? Sales in China in that earnings report were down 2.3%, and this is a crucial market for this company, so pressure there as well, not sending great reverberations this morning.
Well, it's the difference between them and the other tech giants. When you sell a software, perhaps you can be a little bit more immune. Amazon also fits into the category that it goes beyond software, that they have real impact from tariffs. What did we hear from them, Charlie?
Yeah, so look, they had a pretty solid, report, but it is that issue of retail that we've been talking about. So much of that supply comes from China. They have been under pressure there. But we also have to think, if we're talking software, you need to look at some of these numbers as far as the growth in Amazon Web Services. They grew in the quarter, but it was 17%. That is down from prior quarters. Contrast that with Microsoft. Their cloud unit had blowout numbers, and this just speaks to some of the pressures that Amazon, of course, they're diversified across so many business lines, but they face a lot of pressures, not just on the retail front, but also on the software side. So they're also seeing some pressure in pre-market trading.
All right, Charlie, thank you so much. Yep, both Apple and Amazon are trading lower in the pre-market. Amazon down as much as 2%. I will say, though, NASDAQ futures still holding it together. They are higher by 0.2%, so there's still a lot of optimism in this market around China and a possible deal and talks going higher. That seems to be what's lifting us up this morning. Now, coming up, we're going to take a look at what else is making headlines around the world. That includes President Trump's order to defund NPR and PBS. We're just talking there with Kevin about the new budget plans and the cutback expected from the Trump administration. We'll talk about the public broadcasters and your other front pages this morning. You're watching Bloomberg Brief.
What makes it India's time?
It's us women who are going to transform India. I truly feel that the time for Indian women has come. They're not only breaking glass ceilings, but they are redefining, whether it is in sport, whether it's in medicine, whether it's in creative arts. They are everywhere, and I have so much positive energy that comes back to me when I'm talking to Indian women. And I just think at all these little girls and boys, I don't want to discriminate, who are now in school-going age. Imagine once education, sports, we empower them. What a difference they would make not only to India, but to the planet and the world. And the world needs it now than ever before.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Is this a negotiation or the new rules of the game?
It could be either.
It is up to the president how he wants to negotiate.
The higher the tariff, the faster they come.
A 90-day pause is not an eradication.
The trade negotiations are moving quickly. There will be deals cut.
Trust Bloomberg for all the context and clarity you need as the tariff and global economy story evolves.
This year's bear case, very quickly, becoming the base case.
Nobody covers tariffs like Bloomberg. Context changes everything. Earnings season is here.
Earnings season begins. Is corporate America in a good place?
Wall Street is bracing.
Bloomberg is first to break the numbers.
We got Delta, Constellation Brands.
The wave of big tech earnings.
We've seen a re-rating of earnings estimates.
I got to pay special attention to all this.
With the smartest insights.
Given the degree of uncertainty, you haven't really cut earnings estimates that much.
Anyone who says they have certainty on where the growth outlook is going, where earnings are going, is probably exaggerating.
Continuing coverage on Bloomberg.
Welcome back to your Bloomberg Brief. I'm Danny Berger in New York. Let's take a look at what's on the front pages this morning and what's making headlines around the world. Now, first up, the New York Times starts with the U.S. ending a China tariff loophole. Now, this is a loophole that had allowed American shoppers to buy cheap goods from China without paying tariffs for imports less than $800, the so-called de minimis rule. Ending the loophole is expected to help U.S. manufacturers that have struggled to compete with low-cost Chinese products. We've heard from the likes of Temu, for example, trying to turn to more U.S. vendors in order to get around those tariffs. Now, next up, President Trump has signed an executive order to end federal funding for NPR and PBS. This coming from the Wall Street Journal. That order stops direct funding to the maximum extent allowed by the law and bars future allocation. He said that government funding of news media is not only outdated but unnecessary, but corrosive to the appearance of journalistic independence. Now, finally, on the FT, France and Poland set to sign a wide-ranging treaty covering defense and economic matters to deepen their military ties. It, of course, comes in the face of Russia's aggression and uncertainty over U.S. security guarantees. The pact will be signed by French President Emmanuel Macron and Polish Prime Minister Donald Tusk on May 9th. By the way, speaking of that, we heard from Der Spiegel, the German outlook, saying that the U.S. envoy told NATO allies that Trump may skip the NATO summit and he may not attend if the 5% spending target is not in agreement and not on reach. Perhaps what part of the reason we're seeing those agreements between the French and the Polish. All right, a quick check on your markets this morning. We are looking at S&P 500 futures moving higher. A disjointed market, though. Looking at S&P basically gaining back all of the ground it lost, save for 1% since April 2nd. But your 10-year yield's still at 4.2%. We're still pricing in something like 4 quarter points, something that would seem to suggest that we're in for a bout of economic weakness, one that isn't reflected in the S&P 500. Bank of America's Michael Hartnett writing this morning that markets are pricing for a more tariff-friendly stance, but it is payrolls that hold the key. If they are weak, that's when things will crumble. Now, coming up, U.S. employers are forecast to have added 138,000 jobs in April. We got just in about 3 hours' time, we'll get your U.S. payrolls report. We're going to catch up with Citi's Veronica Clark to talk about what she's expecting. This is Bloomberg.
another art museum called the Guggenheim. Now, Louvre's big enough. Why do you need a Guggenheim as well, right next door?
I think it's a great question. I think the beautiful thing about the UAE and Abu Dhabi is we live with over 200 nationalities. And in doing so, they have become a part of the country's and the city's fabric. And we need to celebrate that. So we need to celebrate everybody's identity, everybody's background, everybody's heritage, everybody's history. And what a beautiful way in doing so in these beautiful institutions. These museums are educational institutions and they're community institutions. So we wanted to curate really a story where you come to Saadiyat Cultural District and you, if you allow me to curate the story, you start off at the Natural History Museum. And at the Natural History Museum, you get a glimpse and you get an understanding of how we came to be, how our Earth came to be, how our universe came to be, from a scientific perspective. Once you leave the Natural History Museum, you go to our National Museum, the Sheikh Zayed National Museum. There, you understand the history of this great land, not just the history of the country, but the people of this land that have been a part of this land for over 300,000 years. You get a glimpse of what the past and the present and the future looks like here in the UAE. From there, you maneuver yourself to the Louvre Abu Dhabi, which is a beautiful universal museum. It is universal in its thematic approach. So there, you basically see a part of you on an equal pedestal with the entire world.
What is going to be the consequence for U.S. markets?
We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg.
From our global headquarters in New York City, welcome to Bloomberg Brief. I'm Danny Berger. Let's set your agenda. Healthy but moderating, it's Jobs Day in America. Economists expect it to be the last report before tariffs start to bite. The stalemate thaws. China says it's evaluating the U.S.'s overtures on trade talks. The statement pushes futures higher. But tech renews tariff fears. Apple and Amazon fail to ease concerns, bracing for a tough road ahead. Now, even though the tech giants are dropping in the pre-market, we're higher across the indices in the future session. Your NASDAQ 100 is underperforming because of that, but we've had 8 sessions of gains, more than 8.5%. That's the biggest gain for 8 days since 2020. Does today make it 9? A lot of the tariff moves unwinding. For your bond market, it was yields pushing higher yesterday, but again, that eases somewhat this morning. We're lower by more than 1 basis point across the curve. We're at 420 on your 10-year yield. Let's get some stocks to watch this morning. With that is Bloomberg's Valerie Teitel. Good morning, Val.
Good morning, Danny. Let's start with a check on those Mag 7 stocks and how they're acting after earnings. We got Amazon to the downside, losing over 2%. They gave a tepid forecast and also showed a slowdown when it came to their cloud business sales on Amazon Web Services. So a bit of disappointment when it comes to Amazon and how they're bracing for the tariff battle ahead. Let's move on to Apple. A little bit of the same story there. Shares are falling in the pre-market. Tim Cook warned about a $900 million hit to their bottom line on tariff costs for the current quarter. They also had a soft number when it came to their China revenue. So we're down nearly 3% now on Apple shares. Let's end with the leisure sector. Airbnb on the downside. They're warning about a booking slowdown of the ahead, perhaps maybe some sentiment about consumer spending slowing down. We're seeing Airbnb shares fall around 4.5% in the pre-market.
Valerie, thank you so much for your roundup and your work this week. Bloomberg's Valerie Teitel. So those are the individual stocks, and we're going to get the data in just about 3 hours. April's jobs report. Economists forecasting 138,000 jobs added. Bloomberg's Michael McKee joins us now. So, Mike, 138, what else are we expecting?
Not a whole lot. Michael Hartnett was saying that the jobs numbers are going to be the decisive figures for the Fed, but not this month. We're expecting 138,000, as you mentioned, and unemployment unchanged at 4.2%, because basically all the tariff stuff came out just at about the same time that the survey week was being held for the April payrolls report. So companies probably didn't have a lot of time to adjust. We're not going to see much difference in terms of average hourly earnings, and average weekly hours aren't expected to change. But this is a number to keep in mind as we go forward, because companies are probably more likely to cut back on hours before they start cutting back on people. And if you see that, it would be a sign of a slowdown. Now, the good news for the, I don't know what, I guess for the administration, if the number comes in stronger than expected, it wouldn't be a total surprise because 6 out of the last 12 months, including the last couple months, we have seen the payrolls number come in stronger than anticipated, or right there, and it's a little bit unusual, but it is at least a trend that is in favor of a stronger economy and shows that we were fairly strong coming into this year.
So if we don't get the bite of tariffs in this report, because as you say, the survey was done right when Liberation Day was happening, what does that mean for May and June? What happens to those numbers?
Well, we're anticipating we're going to see a reaction in May and June. The question is, how fast do maybe people let people go? What we do see is in the Indeed.com job posting listings, a continued drop. When Donald Trump started in office, the kind of green line there, we saw Indeed job postings start to fall. And the red line there is where the Liberation Day was. And then the survey week is outlined in white. And you can see since then, we've seen a rapid decrease in job postings. So companies are pulling back from hiring. Does that mean that they then start getting rid of people? That's going to be the big question for May and June. Remember Chris Waller telling us last week that he thought that it would be July, the June figures, before we actually had data that showed the economy slowing.
July also happens to be the 90-day tariff pause deadline, too, so it will be an eventful month. Mike, thank you so much for joining, for starting your jobs day with us, Bloomberg's Michael McKee. Now, Veronica Clark, U.S. economist at Citi, also looking ahead to today's report in about 3 hours' time, writing, we see a risk for employment data is tilted to the downside, first from reduced hiring, and then likely from rising layoffs the longer large tariffs last. She joins us now. Veronica, great to see you. Thank you so much for joining.
Good morning. Thank you for having me.
So what is kind of the timeline for what we're going to see in this jobs report and what actually shows up later down the road?
I do agree that, if this is a strong one, a boring one, which I think most people are kind of expecting, then it does seem a little bit stale because it's not going to reflect those hiring or firing decisions that were made after the April 2nd tariff announcement. But it is still an important one, I think, because this is a time of year when businesses start to hire a lot of workers. In April especially, it's usually something like 800,000 workers that get hired non-seasonally adjusted, right, in April. And we do know that there was some demand slowing down already, expectations of softer travel demand, those discretionary services. Leisure hospitality is a sector that hires a lot this month. So maybe we do start to see some slowing even before the actual post-tariff impact.
So what is the figure that would indicate to you that it is a slowing that will eventually translate into layoffs?
Yeah, really it's those details of hiring. So if we're seeing that gradual increase in the unemployment rate, that's just, people who are, if you are laid off, you're not finding work. That's what continuing jobless claims tell us. Some of the details of where, if there is weaker employment, is it in sectors that are supposed to be hiring, like leisure hospitality, like construction? And then, that hours worked number will be an interesting one. If you're reducing the number of hours that people are working, that's an easy way to reduce labor costs before then having to lay people off. We're not really seeing the signs of those layoffs yet, but you would maybe watch for it starting really in a month or so.
Well, it's interesting because as Mike pointed out, you heard from Fed Governor Chris Waller saying that July was the time that you might start to see things show up. So are you saying that we'll likely get those figures before July, that his timeline is a bit off?
Yeah, I think the tricky issue is that what we know from uncertainty, from all the expectations of softer demand, is that businesses are going to reduce hiring. And it kind of goes back to those seasonal dynamics where this is a time of year when businesses usually start to hire a lot of workers. You get new students entering the labor force, graduating. This is actually the time of year when we've seen the unemployment rate rise for the last 2 years, and this has already been a labor market where hiring has been pretty soft. So yeah, I think you might start to see it even before those July numbers.
So what are the figures then that you think likely will cause concern among the Fed that are weak enough to force their hand in terms of cutting?
Yeah, so we've had some guidance even from Governor Waller. It really is the unemployment rate that's the most important statistic. And Governor Waller was saying maybe it's the speed of the increase in the unemployment rate. If we see it going up, 0.2 in a month or 0.3, of course it was a 0.2 increase that got them to cut 50 in September last year. So that could be part of it. But even if we're seeing, if for instance, if we see the unemployment rate today at 4.3%, maybe next month it's 4.4, it's enough of an increase. And then maybe if we see it in data like initial jobless claims, if those start to rise, I think that's enough for them to be cutting.
Well, it is a Fed, though, much like companies that have been frozen because of tariffs and trying to figure out where they are. So presumably you need something that is big enough to get them to cut. But if that is the case and what you're laying out, is it almost too late at that point if we do have a very reactionary Fed now?
Yeah, it's a really tricky position for them. Yeah, because I do think maybe they got a little bit of grief for cutting as much as they did last year, and they were trying to be preemptive, but maybe they didn't need to be. Does that make them overcorrect this time? I think ultimately, if you are starting to see that signs of weakening in the labor market, we still have a Fed that thinks rates are well above neutral, that are restrictive. Yes, we will probably have the price pressures from tariffs, but a lot of the inflation adjacent data, things like home prices or wages, those are still slowing. Yeah. This seems like a very different inflation than we experienced a couple years ago. I would think they would at least want rates to be closer to neutral still.
I wonder what you've been making of what we've heard from corporate America so far, because it almost seems like a continuation of the soft data being worse than the hard.
Yeah.
Because, for example, you have the big tech companies still spending in CapEx in a huge way. Mm-hmm. You heard from Capital One, Visa, all the credit card providers saying consumers are still spending.
Yeah.
And kind of unknowingness for the future. It still looks strong, Veronica.
It does. It does. The hard data, I think, even especially the activity, the spending data could look strong for another couple months. And we saw the hints of this even in Q1 GDP. We had a big increase in private final domestic demand. But even that, it looks like it might be tariff related. We had consumers spending on cars. We got that in March, and even April data yesterday. Car sales were still pretty strong. There was the biggest increase in business equipment investment in information equipment since 1955. Seems like some tariff front loading potentially. You're trying to invest in those goods before you can't get them anymore. So I think we might still see that maybe in April, maybe even May data where there's this front loading activity. But then eventually, if the shipments aren't coming here, then you get that drop off later.
So the pull forward has happened. I also wonder whether you assume that faced with higher prices because of tariffs, whether companies take it on themselves, i.e. we get margin compression, or whether they pass it on to consumers and we get something that looks like a more inflationary environment.
Yeah, it will depend, of course, on the goods, what the elasticity of demand is. I err more on the side of thinking that companies will absorb more of this. There has already been signs over the last year that it has been more difficult to raise prices. We had things like shipping costs actually coming up in 2024, and you didn't really see that passed on. And it's not so clear now, too, that we have a delay of tariffs on certain countries. The tariff on China is just so high that we're going to maybe experience shortages, and so it's not so much that you're passing on a tariff cost, but there still would be price pressure from shortages or trying to find more expensive substitutes. But maybe that takes a bit longer, and it's a bit harder to forecast that.
Well, the volume at the ports has dropped off really significantly. How concerned are you that we get something that looks like a 2020 COVID shock in terms of a supply shock?
Yeah, it's we're watching that port data too, but we're not super familiar with it. It's not the data that we watch usually, and there's probably still going to be some front loading from certain countries, right. And maybe you would just have then some weird dynamics in certain sectors where we have plenty of shirts maybe, but we don't have bolts and screws. I don't know. So yeah, but you would be worried the longer this lasts that you're getting into those shortage kind of issues after inventories are drawn down.
Yeah, I feel like it's one of those things maybe to be concerned when one, we're either paying attention to the plumbing of the treasury market, or two, all of a sudden looking at port data.
Oh yes, I watch that daily LA port data every day.
Yeah, it's a sign within itself. Veronica, thank you so much for joining us.
Thank you.
Really appreciate it. That is Citi's Veronica Clark. And later today, don't miss this conversation. Stephen Mirren, chair of the Council of Economic Advisors, will be joining Bloomberg TV at 9 a.m. time after the jobs data comes at 8:30 a.m. All right, let's get you some of the top stories that are trending on the terminal this morning. China is assessing the possibility of trade talks with the U.S. This after senior U.S. officials expressed willingness to talk to Beijing about tariffs. The statement signals a potential shift in the tariff stalemate between the world's two largest economies. President Donald Trump is asking Congress for deep cuts to domestic agencies while asking for more money for defense. It's part of the prelim outline of his 2026 budget request that's set to be released today. The president's budget calls for $557 billion in non-defense spending next year. That's a cut of $163 billion from current levels. In the meantime, he is also asking for a 13% hike for national security funding. Elsewhere, President Trump says he will nominate National Security Advisor Michael Waltz as the next U.S. ambassador to the UN. That move does sideline Waltz, a top aide who drew criticism for inadvertently adding a journalist to a Signal group chat where officials discussed sensitive military plans. Marco Rubio will serve as interim National Security Advisor while also keeping his job as Secretary of State. Coming up, Apple results renew fears about tariffs. Joel Kalina of Wedbush Securities joins us next on your Bloomberg Brief.
Africa, a region rife with potential for growth and opportunities, but not without its challenges. Bloomberg highlights the biggest stories, interviewing key players, and reporting on the issues impacting the region. Join us as we get to the heart of African business, politics, and economics, and ask the question, what's next? I'm Jennifer Zabasaja, and this is Next Africa. New episodes every month, only on Bloomberg.
But what about the diagnosis? If the diagnosis at the end is worries about growth rates,
yeah.
How do you get from point A to point B? Why do you worry so much about that end goal of better growth?
Because if we can't grow, you're going to have a much more inflated debt to GDP and federal deficit, and that's not good for the economy. Growth is really critical, and I think what's underappreciated is what the inputs are to get to the growth number. And so we talked a little bit about productivity. I hope that we can continue to produce at 2% indefinitely on productivity. I think that would be great. But you got to make sure you have the other levers in place, I think, to buoy that. So if you look back over the last several years, we've had 8 million immigrants come into this country in the last 4 years. And that's helped growth. And by the way, that's deflationary.
Listen carefully. Can you hear the rhythm in the markets? Not just in the syncopations triggered by inflation, but in the preludes leading to global elections, in the dissonance that moves the Nikkei, and the rising course conducted by AI. There's music in the markets, and if you want to learn to listen for it, we'll show you how.
What we learned some time ago was that having everything in one location had too much risk with it.
Apple CEO Tim Cook speaking yesterday on the company's earnings call. Now, Apple's results failed to ease any of those tariff concerns. And those concerns, I should say, sending the stock lower in the pre-market trade this morning, down by just about 2.7%. Joining us now is Joel Kalina, Wedbush Securities Managing Director of TMT Trading. Joel, great to see you. Thanks for joining us this morning. Just give us your first read on Apple results.
Yeah, first read, I think, sentiment was very cautious into the print, which I feel like it has been the past, several years. But they kind of, unfortunately, services, China, both kind of missed the buy-side bogeys. They obviously called out tariffs on the call. I think they pointed to a $900 million potential impact, and some think that's even light if tariffs remain, somewhat elevated levels. And their guide was just kind of squishy. I think they see the rev growth up 3% at the midpoint. The street was at 4.5% growth. Gross margins were below. And I think the same story for Apple narrative is that the bear thesis is intact. There's just really few drivers to kind of expand the multiple from here. Lack of AI presence, really no innovation on the product front, and it's just kind of an unsexy story within the mega cap cohort.
The bear thesis intact. You sound kind of like the opposite of your colleague Dan Ives, who likes to talk about some trouble in house, perhaps, Joel. Look, just on that. Tim Cook, as we heard there, had been saying, look, we're trying to diversify supply chains. They want to get most of their production out of India coming into the U.S. How do you expect that to go underway, Joel? Is that enough? If they do manage to do that in a timely fashion, does it help relieve any of the concerns about tariffs?
100%, and I think Dan would agree with me too. Like that's where Tim Cook has been kind of masterful, managing his relationship with the U.S. government. Trump, especially Trump 1.0, and now again in the second term, they've been very proactive in kind of reshifting their supply chain around to reduce their exposure to their Chinese footprint. So, like again, he's been masterful in doing that, and clearly it's going to help. But time, right? These things also take years to build and to shift things around. It's just not an overnight type of fix. So longer term, yes, but I think with the AI story, still, in my opinion, we'll see what they say next month at the Worldwide Developer Conference. We need to see more innovation, especially in terms of what they want to do in AI. And remember, Apple's taken the path. They're not going to spend massively on AI, CapEx versus all their peers. So that's something people are kind of waiting for them to kind of break through on to really get excited about the story.
I was going to say, Tim Cook even said in their earnings call that they need more time to deliver personalized AI for its features for Siri's Assistant that meets their quality expectations. He needs more time. How willing and how much time is this market going to give Tim Cook, Joel?
Well, I think that the stock is telling you not too much, right? I mean, I still think there's a reason why mutual funds have been underweight the stock for years, and it remains the perennial funding short for the hedge fund community for these very reasons. There's just really a lack of patience, especially what you're seeing, what Meta's doing, and Zuckerberg's been very clear that this 2025 is the most important year for AI, for Meta and the world, in his view at least. And so I think people just want to see a little bit more excitement and energy, and then obviously spending in dollars behind that initiative and focus.
Well, Joel, it's been pretty remarkable, this bounce back we've gotten in equities since April 2nd. And the bounce back has been led by tech. But just given these results, do you expect that tech leadership to become very divided, considering the excitement around Microsoft, Meta, and Alphabet earnings versus what we got yesterday?
Yeah, I think so. It's been a very selective tech rally in the sense where the real buying that I've seen on my platform, has been more towards names that are idio in nature. No secular growth, reduced China tariff exposure. So think Netflix, DoorDash, Melly if you want some Latin American exposure. Video game stocks have been on an absolute tear as well. And then I think even 2 nights ago, Microsoft and Meta, we saw some regrossing in those names last night as well. So. And even the software space, large cap software numbers have been fantastic, even before, Azure numbers, SAP, Pegasystems, ServiceNow sounded great. And I think right now within tech as well, semi is sort of a ground zero for this trade war. So we sort of need that to lift, and maybe you'll see some more excitement around the chips. But, where I've been seeing the buying in the semi space, again, very selective in nature. Think Broadcom, Hocktan, announced that massive buyback just a few weeks ago. It's cheap as well. They're diversified. So again, I think there's still people are waiting for the all clear signal to really dust off that offensive playbook. But in the meantime, keeping it somewhat simplistic, it has worked, right? Like being long mega cap for the last 2 years, people generated nice P&L off of that. And now the past, 2 months, again, look at like Netflix, the video games. You don't really have to get too cute and just try to hit singles and doubles along the way.
But Joel, I thought part of the narrative this year wasn't just the animal spirits being quieted down from tariffs, but was just the fact we got too over our skis in tech exposure, that valuations have gotten too high. Microsoft is now up on the year. Meta's down only 2%. Are we not right back in the same place where we started?
I think the big difference is right now versus where we were, say January 21st or 22nd, is that positioning is just extremely light. I think Goldman Sachs PB had some color out yesterday. Mutual funds are the largest underweight they've been in quite some time. Hedge fund long short books are massively underweight, the Mag 7 as well on a multi-year basis. Positioning is very clean, and that's a tailwind for the group. And I don't think you can sleep on that. Again, You look and remember when tech really kind of got clobbered back in Q4 of 2022. Tech positioning was extremely out of favor, was extremely light. Sentiment was in the dumps, and then the group ended up rallying 19 out of the next 24 months. I'm not saying we're going to see that type of performance ahead, but I think this is looking back historically, positioning as light as it was 2.5 years ago, which is positive for the group.
Hey, Joel, so great to get you on this morning. Please come back and join us again soon. Enjoy your weekend. That's Joel Kalina of Wedbush. Coming up, we're going to wrap up the week with big oil earnings. We also have April's job numbers coming up. Details ahead on your brief.
This is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
Bringing you up-to-the-minute tech news whenever and wherever it happens. I'm Ed Ludlow in Las Vegas, and this is Bloomberg.
U.S. tech is influencing global markets.
Technology is driving business across Europe.
Companies in Asia are betting on tech.
Tune in to Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg.
Let's get you set up for your trading day on this Friday. The main event, we have the jobs report coming out. That's at 8:30 a.m. New York time. The estimate, 138,000. Plus, we'll also get some earnings. Chevron and Exxon, they will report before the bell. Also, over the weekend, Berkshire Hathaway will be holding its meeting in Omaha, Nebraska. That happens on Saturday. We have some earnings that happened post-market yesterday that are moving shares this morning. Apple falling 2.8% this morning. The iPhone maker reported China sales that were disappointing. Also warned about the impact of tariffs. They're just talking to Joel Kalina of Wedbush, saying that the bear case remains intact. Amazon also echoing that concern on tariffs. Those shares down 1.5%. Also saying that the related economic turmoil could crimp consumer spending. We also heard from Airbnb a weak outlook for the second quarter. It also cited the economic uncertainties for softer travel demand in the U.S. So a mixed picture, especially on the look forward for a lot of these companies. And as we head to the end of the hour, you are still looking at S&P 500 futures, though, moving higher on track for a 9th consecutive day of gains. We'll see if Jobs Day keeps that intact. And that's it for your Bloomberg Brief. Surveillance from here.
were asking a question of President Trump, and he didn't quite answer the question, and he asked you a question. So the question he asked you was something like, why are you not banking certain groups? What is the answer? I don't think he gave you a chance to really answer that question, but what is the answer to that question?
Well, first off, the Bank of America has 70 million consumer customers and millions of small businesses all over the country, all over the world. And so we bank everybody. But the real question was about overregulation, frankly. And so as you look, what's happened is because the interpretations of AML, anti-money laundering, BSA, Bank Secrecy Act, KYC, know your customer's customer. You know, there's a lot of burden upon the banking system to both report suspicious activity reports and do a lot of analysis. And we have to close accounts, so we can't tell people why we did it. And often we're told by authorities to close accounts. That creates confusion. Another area comes up in this discussion is in the crypto area where the regulator said you can't bank crypto operating companies, employees of crypto companies, et cetera. We are allowed to do, we bank everybody, but the operating company, they said that's a high-risk activity. Ask us for authority, and guess what? You would have never gotten the authority. So that came up as an issue. So at the end of the day, it's about getting these regulations right.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia trade.
This is Wall Street Week. Welcome to Balance of Power.
This is Bloomberg Television. Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
The risks are on the downside, but it's a bit early to look for the real negative numbers in payroll.
You've got labor market conditions down, maybe even negative payroll prints in the next couple of months.
There's seasonal factors weighing on the print. It makes sense for it to be below 100.
We're going to still look quite robust, but we expect that then to come off in the second half.
The unemployment picture is still going to hang in there.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Let's get you to the weekend. Live from New York City this morning. Good morning for our audience worldwide. Bloomberg Surveillance starts right now. Coming into Friday is the US and China position for trade talks.
Can we reach some sort of short-term accommodation with them? That's what they want. I mean, the Chinese are reaching out. They want to meet. They want to talk.
The US says China wants to talk. China says the US wants to talk. For big tech, trade talks can't come soon enough. Apple expecting $900 million in higher costs for this quarter. Amazon bracing for a tougher business climate. Economists hoping tensions don't spill over to the labor market. Looking for another month of solid job gains, preparing for downside risk in the month to come.
Perfectly framed at a time where we are seeing the concepts of a negotiation, the concepts of a coming together of the U.S. and China, concepts of a rally that has already gone on for 8 days. The big question, and this is what you're getting at with the jobs report, how much of the economic damage has been done? Will we see any of it this month? Is it too late to really put the toothpaste back in the tube and avoid some of that damage coming down the road?
One quote from the Chinese Commerce Ministry this morning. The U.S. has recently sent messages to China through relevant parties, hoping to start talks with China. China is currently evaluating this.
This is a very bullish signal, and this is the most honest China has been in terms of where potentially these talks may land. It's very much on brand for the CCP to retaliate, stimulate, and then negotiate. And we are potentially at the start of that negotiating frame when it comes to China. The big question is, does this mean we could potentially see some in-person meeting, a phone call? Is it in earnest a proper thaw to the stalemate?
This is why it's almost impossible to set policy at the Federal Reserve next Wednesday. What do you do? The rules of the games could change. 2 weeks out, 3 weeks out, a month out. The data could change too. They're stuck between a rock and a hard place.
Which is the reason why people say they'll do nothing, and they'll say as little as possible, and they'll try to get off the stage without addressing anything, particularly the political questions that are going to be coming fast and furious as more people in the administration invoke Jay Powell's ghost. So there is this question right now, how quickly will we see the data start to sour? Most people agree we will not see it yet, and because of that, without that hard data really deteriorating, the Fed can stay on hold. The Fed can wait. What the market does with that, what the president does with that, two different things.
The estimate for the payrolls report, 138K. This market up for 8 straight. Looking to make it day 9. Equity futures up by 0.4%. Coming up this hour, in just a moment, we'll catch up with Priya Misra of JP Morgan as China and the US position for trade talks. Tom Forday of Maxim Group on Apple's latest tariff warning, and Sarah House of Wells Fargo as we count you down to the payrolls report. We begin this hour with stocks looking for the first 9-day winning streak in 21 years. Priya Misra of JP Morgan writing, we need credible trade deals soon and some progress on China if we are to reverse the downward slide in the economy. Priya joins us now for more. Priya, good morning.
Good morning.
Will we capture that downward slide in the economy in this morning's data?
So I think when we're looking at initial claims, when we're looking at layoff announcements, we haven't yet seen it. And I think, remember, April 2nd was just a month ago. So I think companies have been frozen into sort of this uncertainty. And so, you know, we're thinking, you know, something in that 100 to 150,000. But my issue is that if we get a weaker number, the market's not priced for it. No market is priced for it. The hope is that everybody's frozen in this 90-day period while the trade deals are done. Trade deals are difficult. Even to get an agreement in principle with a lot of them, particularly China, that now is thinking about potentially talking. So I think the economic data, the soft data is telling you it's weaker. I don't know if we see it today. If we see any slowdown, and what I'm going to be watching is the details of that report, because if you look at ADP, now ADP is not a great predictor of payrolls, but their healthcare and education, that was actually pretty weak. That's been the strongest part of the labor market. If you see that downshifting, I think the market's going to get worried that that damage is done. And my concern is the damage is trade, the damage is also uncertainty. The Treasury Secretary has said it's strategic uncertainty. So is that uncertainty going away? I'm not so sure. Hopefully everybody's talking to each other, but to remove uncertainty, we need deals very soon.
Are you confident bonds rally on a bad number?
I do think, yes. I think a couple of weeks ago, we were nervous around this, you know, what was happening with bonds. I think there was this clear deleveraging from the hedge fund community. I think there was also demand for liquidity. Treasuries are still the most liquid asset class in the world. So I think when you get these massive moves in markets, sometimes the treasury market, you know, results in these odd moves. The reason people got nervous is if the end goal of tariffs, and I would argue we still don't know what the end goal of tariffs is, but if it is to remove the trade deficit, the rest of the world doesn't need to hold those treasuries. Is it a negotiating tool? And so I think that concern is why that stock-bond correlation weighed on treasuries. But I think if you get a weak number, it's fairly clear. The Fed reaction function is clear. They'll cut, they may not cut. I don't think they're doing anything next week or even June. But if the economy is slowing, they're going to respond. And I think that asymmetry from the Fed is what is going to bring at least the 0 to 10-year part of the Treasury curve lower in yield. So you get a weak number. I think the Treasury market's going to say that endpoint of 2.9% on Fed funds, after all the cuts, that's way too high. That's close to neutral. The Fed will have to go into accommodative territory.
Over the past month, what we've seen is a distortion in the market that a lot of people are trying to figure out how to reconcile. This idea that short-term bonds are pricing in something of a deterioration in the economic conditions, while risk assets have just signaled the all clear, everything's back to normal, we're all good, let's go to the races. Who's right?
That's a good point. I think the risk asset complex is just happy that there's some hope of deals, and that's what's getting priced in. And I think the risk market is saying that, you know, this damage is not yet done. If we get deals, then we can go back to where we were on Jan 20th. I think the rates market's telling you, the front end of the curve is telling you that there's some slowing. I would argue even the front end of the Treasury curve is not pricing in a recession. The long end is pricing in this fear that there may not be as much demand for treasuries. Plus, what's happening on the tax bill? We haven't been talking much about the tax bill because we haven't got any details. I actually think it's going to take all year for them to try and get this tax bill done. Does that mean much higher deficits? Is that stimulus? So the long end is sort of stuck in terms of supply and demand. And I think those concerns will remain with us. But, you know, back to your question, I think the risk asset complex is a little too optimistic. This hope that if they're talking, they're going to get trade deals right away. What's the effective tariff rate? If the end game is 10% with the rest of the world and, I don't know, pick some high number, 50, 60% on China, that's a very high effective tariff rate. And that means that companies have to rework supply chains. They're not thinking about CapEx at that point. They're not really hiring people. They're reworking supply chains because you've got the manufacturing superpower of the world that we've tariffed at this high rate. So I think in that scenario, the economy slows down, maybe not recession, but you're looking below trend growth. The Fed, once they feel confident that the unemployment rate's actually rising, they start to cut. So I think the rates market, I would argue, is a little more correct than the risk asset complex that's saying we're going to get the tax deal stimulus, which I would argue there may not be a lot of stimulus, and we're going to get all these trade deals, and we can put, I love your quote, can you put the toothpaste back in the tube? You really can't.
I stole that from a lot of people who are saying that, but I am curious about going forward, what you would have to see in the deal that we're seeing get crafted in Congress with respect to the budget to make you concerned about treasuries, to make you concerned about supply in a material way, given that there could really be quite a bit of deficit spending.
Right. So I think on the long end, that's really what we're focused on. Apart from, is there any sense of treasury holdings from the rest of the world being used as a negotiating chip? We're looking at that tax front. Now, I would argue, look at the president's budget last night. They're talking about spending cuts. I think the administration understands that there is a constraint. It's a market constraint because interest rates will rise. The Fed really can't control the long end of the curve. You can get them to cut rates, but it's going to be hard for term premium to go down. They understand that, which is why I think trying to get stimulus, I think we'll get TCJA extension. We might get a few other things. What would make me concerned to your question about long end rates going much higher is if you get deficit finance tax cuts. So no spending cuts, and we're going to cut the corporate tax rate. We're going to cut tax on Social Security. If you're going to get clear deficit finance tax cuts, okay, then the long end should be much higher, because think about supply demand. We're struggling with the demand side, and then supply is going to be a lot higher. I don't think they have the political will to get that done. I don't think that the market will let them get these deficit finance.
Well, why don't you add a record $1 trillion in national security spending that the president is going to float today in his skinny budget? Is there any political will for that? And can the bond market handle that?
I think if it happens without the spending cut, the bond market's going to price it in. And, is that a much higher 10-year rate, which then becomes self-limiting? So the president has said before, the Treasury Secretary and the president, they care about the 10-year. The 10-year is going to not like if it's just without the spending cut. So I would say I'm looking at the defense increase along with the spending cuts. I actually think it's going to be hard to get both of them done. But if just one happens without the other, and Doge has been a disappointment in terms of how much they've been able to cut, the bond market's going to react. That's going to impact risk assets, going to impact the economy, and I think it'll force the administration to come back.
That's on the appropriation side. When it comes to reconciliation, the taxes, what's your base case? Is it just the extension of TCJA, or do you at least get one extra that the president promised on the campaign trail he would deliver?
So I think you can get a couple of extras, small extras. So that would be, maybe tips and overtime. I think we start getting into Social Security, you're looking at $2 trillion over 10 years. That's much harder to do. Now, if we were talking about Medicaid cuts actually going through, I would say maybe you can get a few more things. That's going to be politically very hard to get done. So I don't think you're going to get a whole lot of spending cuts, and that's going to mean it's TCJA plus perhaps tips and overtime.
Bond yields a little bit lower this morning. We're down by a basis point. The 10-year maturity 4.20. Priya Misra of JP Morgan will be sticking with us as we count you down to the payrolls report. 138K is the median estimate in our survey. With an update on stories elsewhere, with your Bloomberg brief, here's Yahara Hackett. Say, Yahara.
Hi, John. China says it's assessing the possibility of trade talks with the U.S. It's the first sign since Donald Trump hiked tariffs last month that negotiations could begin between the two sides. Still, as a condition to negotiations, the ministry asked the U.S. to show sincerity towards China by canceling tariffs on its goods. And you guys were just talking about this. The White House is set to release the first budget proposal of President Trump's second term. The so-called skinny budget will call for $557 billion in non-defense spending. That's a nearly 23% drop from current levels. National security spending, meanwhile, would rise to just over $1 trillion, which is a 13% increase. And Michael Waltz is leaving his post as President Trump's national security advisor after he admitted to adding a journalist to a sensitive Signal group chat. President Trump says he will nominate Waltz to be the next U.S. ambassador to the UN, while Marco Rubio will serve as interim national security advisor while keeping his job as Secretary of State. That's your Bloomberg brief. John?
I think I'm up to speed. Yahara, thank you. More from Yahara later on this hour. Up next on the program, the U.S. and China position for trade talks.
You'll be seeing the results pretty soon, sooner than most people think. because that's what other countries have been doing to us, just so you understand. They were tariffing the hell out of us, and all we're doing is we're doing it to them, but we're doing it much better.
That conversation up next with Bloomberg's Mike Shepard in just a moment from New York City this morning on this Payrolls Friday. Good morning.
Brings you breaking news 24 hours a day. Powered by more than 3,000 journalists and analysts in more than 100 bureaus across the globe. Bloomberg Television. Context changes everything.
Jumpstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action. We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets.
With the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling. Join us on Bloomberg Open Interest. Every trading day, only on Bloomberg.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Onen, only on Bloomberg.
Two names to watch in a pre-market: Amazon, Apple. Amazon bracing for a slowdown of the U.S. economy. That name trading just a little bit softer. Apple, higher tariffs is going to cost the company $900 million this quarter alone. That stock is down by 3%. It could be worse. Equity futures are just about positive. The why, the hopes for talks between the U.S. and China. That's under surveillance this morning. The U.S. and China positioning for trade talks.
You'll be seeing the results pretty soon, sooner than most people think, because that's what other countries have been doing to us, just so you understand. They were tariffing the hell out of us. We couldn't sell cars in Europe. We couldn't sell cars in China. We couldn't sell cars in Japan or anywhere else. We couldn't do anything. And all we're doing is we're doing it to them, but we're doing it much better.
So here's the latest this morning. The U.S. says China wants talks, just as China's Commerce Ministry states it's the U.S. reaching out to them. Both sides looking to position ahead of potential trade negotiations. Bloomberg's Mike Shepard joins us now from Washington, D.C. with more. Shep, the potential for trade talks, just what is going on here between these two nations?
Well, John, we're really seeing the strongest overture yet from Beijing to Washington, that they are receptive to the idea of these negotiations that many on Wall Street and on Main Street, many businesses have been waiting to see get started. We're starting to see the pain felt not only here in the U.S., but in China as well. In China, we saw earlier this week the manufacturing index there shrink for the first time since December 2023, and that's got to be concerning for officials all the way up to President Xi Jinping. So this step we saw overnight from China really suggests that they are just waiting to get that phone call, waiting to have that conversation, that first step toward actually beginning a negotiation. They are looking for a point person who can lead these talks with Donald Trump's blessing. They want to be sure that they are not whipsawed by any cross currents in trade in the trade policy team with Trump, because there are people of diverging views. You know, Scott Bessent would be much more inclined to do a deal with China than, say, Peter Navarro would be. So this is kind of what we're seeing now. President Donald Trump doesn't have anything on his agenda today except for an event this evening in Mar-a-Lago, so ample time for him to make a phone call. There's been a lot of discussion about whether some sort of conversation might happen at a high level. That will really be the next step, and that would set the stage for actual negotiations to start taking place.
Shep, I want to pick up on your point about Peter Navarro versus, say, Scott Bessent, this idea of a cast of rivals in the cabinet. Who do you think Trump would appoint to potentially run this negotiation?
Well, it's a great question, Anne-Marie, and it's unclear who would really have his ear. We do see, though, Scott Bessent doing a lot more of the talking these days publicly when it comes to these deals. For instance, he was out there earlier this week talking about South Korea and the kind of progress that they have been making there. Likewise, we heard Jameson Greer talking as well about, that is the U.S. Trade Representative, talking about progress perhaps with Japan and India, too. So we are seeing moves made on fronts with those Asian trading partners that are being led by others, or at least led in conversation here by others, especially Scott Bessent. Now, the interesting thing when you talk about those Asian trading partners, that sends a signal to China, too. These are competitors to China with the U.S., and China is looking at this and seeing them making progress with the U.S., and Beijing doesn't want to get left too far behind with respect to its neighbors.
Hey, Shep, appreciate the update. Michael Shepard there down in Washington, D.C. To extend the conversation, Priya Misra of J.P. Morgan still with us. Priya, let's get to the approach for trade negotiations. The Treasury Secretary, Scott Bessent, spoke yesterday and talked about revisiting the purchase agreements with China back in 2020. A report in the FT in the last 24 hours that Europe might take that approach as well, offering some kind of purchase agreement with the United States. Are you and the team thinking about that just in terms of what a trade deal could look like in the next several months?
We are, absolutely. I think everything's on the table. You know, can they be buying more U.S. products? Can they invest in the U.S.? What can they do with China? Is one of them, I mean, one of the things, it's an important question. What was the aim of the tariffs? Is it to ring fence China? Is it to have zero trade deficit? I think that's less likely. Is it to have fair trade deal? If it is to ring fence China, and you know, we've been calling, I think economists and the market's been calling, and policymakers have been calling for this China rebalancing for a while. How are we getting to it? I think April 2nd was really tricky because we were alienating the whole world. If part of the deal, so to your point, yes, maybe they can buy more U.S. products, but I'm still looking at what's the end point. Is that going to be a 10% tariff still? Is there a chance that that actually goes down to zero, that we can work with the rest of the world? And I think then you can have this sense of that rebalancing being forced onto China. So I would say all of this, Treasury holdings, everything has to be on the table in the trade negotiations, which is why I think it's very hard to get that done quickly. I think that uncertainty is something we have to just get used to.
There's the direct threat of some of our counterparties selling their Treasury holdings, but there also is this feeling that if trade volumes go down, there is less of an incentive for the rest of the world to hold U.S. dollar-denominated assets, including treasuries. And I think it's notable that U.S. government bond funds saw $4.4 billion of outflows in the past week, while European bond funds saw inflows. It highlights this divergence. Do you expect that to continue on the basis that less trade with the U.S. is less of a reason to buy treasuries?
So lots to unpack there. I would say if you have a trade deficit, you sort of, if you have a high fiscal deficit, which we do, you sort of need that trade deficit to finance. We essentially spend more than we tax. So I think that, and I don't think that the fiscal deficit is going down. So I think the trade deficit will have to stay. Just economics would argue that the trade deficit is going to remain. I think who it's with is the question. Maybe it's with certain other parties. Maybe we get a purchase agreement and we can reduce that a little bit. But I think your fear is very real, that if the trade deficit is somewhat lower, the rest of the world doesn't need to hold as much treasuries. I think the hope has been that for the treasury market, that there is no alternative. Well, if you're forcing, Europe to actually spend $1 trillion more, they're going to have to borrow. You start to build that alternative. But I would say the starting point was everybody was in the U.S. I think we're still seeing rebalancing. I think it's too early to say that, sort of this is an en masse shift away from U.S. assets into the rest of the world. At the margin, if people were 80%, 90% invested in the U.S., I think that this is what we're seeing is that number going down.
On the margins, does that make you unwilling to buy 10-year Treasury yields at 4.2% just because there's going to be an extra term premium? There's going to be an extra cost associated with U.S. Treasuries not necessarily being as desirable or necessary for the rest of the world.
I think that's fair. So I do think term premium is going to be higher. We like curve steepeners. We've been adding to steepeners in this move. But here's the issue. If the economy is slowing down and uncertainty persists with us, I think the economy is going to slow down much more. I would buy 10-year treasuries at 4.20 because if the Fed's cutting rates to 2%, 1%, where's the 10-year? It's not at 4.2, it's much lower. But we have to get used to this higher term premium. It's something the Treasury is going to have to contend with. Our funding cost is going to be higher, particularly as they plan this tax bill. They're going to have to be ready to pay more. So it's that additional cost that will be higher. And I think in the rebound, so hopefully we don't go into a recession and we get these trade deals a year from now, the economy is much stronger. At that point, that 10-year is going to be much higher. But the here and now is if the economy is slowing, you're supposed to be long treasuries. I would say even the 10-year, just realizing that that curve is going to be steeper.
You keep saying even the 10-year, the 30-year doesn't get a mention. What's happening right at the back end of the curve?
I think there's even more term premium there. So, when I think about term premium, it increases exponentially down the curve. So I don't know about really buying the 30-year. That's just a lot. That's a risk asset for you. And I don't love, we're de-risking. So I don't love.
You consider the very long bond to be a risk asset?
I do. Given our deficit concerns, given this concern around our treasury holdings on the negotiating table with our trade partners, the flip side of a trade deficit is a capital account surplus. They're buying treasuries because we have a trade deficit with them. So the very long end, I think, is a bit of a risk asset. And duration we saw in April wasn't very helpful. Over the year it has been.
Just quickly, you kept alluding to this, the idea of Treasury holdings being on the negotiating table, maybe a reference in part to Japan talking about how they're a huge holder of Treasuries, just FYI, just when you want to negotiate with us. Do you realistically think this could be a threat to sell Treasury holdings by counterparts?
I don't think so. I think it's a bit of a nuclear option. But I think this part of negotiation where the U.S. doesn't hold all the cards. The rest of the world needs the American consumer. I get that. But we need their supply as well. And we need them to buy U.S. assets, and we need them to hold the dollar as a reserve currency. So I think this is all part of negotiation. You're going to hear a lot of these headlines. But I think it also tells you Japan wasn't selling treasuries. And now we have data of April to show that central bank treasury holdings did not go down. So that fear in April, I think it was deleveraging, and then the market freaked out a little bit. But I think we're going to hear a lot of these conversations in the next few months as they negotiate.
Priya, it's good to see you, as always. Priya Misra there of JP Morgan Asset Management on this Payrolls Friday. The estimate in our survey, the number we're looking for is 138K. The previous number was 228K. Also looking at a couple of moves in the pre-market. The number one, Apple. Apple lower in the pre-market. Up next on the program, we'll catch up with Tom Forte of Maxim Group on Apple's new tariff warning. It could cost the company $900 million. This quarter alone. As for Amazon bracing for a slowdown in the economy. This is unlike what we saw the day before. These are the two tech names that could be very exposed to the trade story. More broadly, the trade story, some optimism this morning, the potential for talks between the US and China, helping equities gain. Equity futures up by 0.4%. From New York City, this is Bloomberg.
the President of the United States does say he wants to keep a more mutually beneficial trade balance with these countries. What does a country like Egypt and Kenya and some of these others have to provide that won't completely dent their own GDP?
No, it's tough. I mean, there is the commodity side. There is the. I think it's less about bringing it to the table and more trying to take advantage of the hit elsewhere. So China exports 30% of all the textile exports to America come from China. In 2023, it's something like $40 billion. And whatever the tariff rate ends up being on China is going to be a lot higher than it is on Africa. So there might be scope for African countries to say, well, let's move those textile factories.
Is this a negotiation or the new rules of the game?
It could be either.
It is up to the president how he wants to negotiate.
The higher the tariff, the faster they come.
A 90-day pause is not an eradication.
The trade negotiations are moving quickly.
There will be deals cut.
Trust Bloomberg for all the context and clarity you need as the tariff and global economy story evolves.
This year's bear case, very quickly, becoming the base case.
Nobody covers tariffs like Bloomberg. Context changes everything.
8 days of gains on the S&P 500. Equity futures up again. It could be day 9. If we make it day 9, it's the longest daily winning streak going back 21 years. Equity futures on the NASDAQ up by 0.4%. Two very important movers on the NASDAQ we'll get to right now. 3 hours away from the opening bell with your morning movers. Here's Danny Berger. Hey, Danny.
Hey, John. Yeah, we'll kick it off with Apple finally getting some of the contours of the tariff hit that they will take, and that is $900 million in the June quarter. The concern of what that guidance means, sending shares lower by some 3%. Tim Cook really trying to outline in the call, we're trying to diversify our supply chain this quarter. Most of the iPhones will be coming from India. Still, that fear is alive and present about what higher costs mean from them. And China sales were weak too. So again, shares down 3%. We also heard from Amazon, one of the other big tech companies, to report earnings. A decent quarter, but a weak guide. Andy Jassy, the CEO, on the call saying, look, the weakness hasn't showed up in orders yet. However, it might be some of the pull forward. It also didn't help from Amazon that AWS slightly underperformed after we saw some pretty solid results coming from Microsoft's cloud unit. So those shares down 1 1/3%. The final earnings that we got for you this morning after the bell, we heard from Airbnb, the worst performer pre-market on the S&P 500, down 4.7%, seeing softness to come in bookings, a decrease in the growth of which will come from the uncertainty. Again, what we hear time and time again from companies, and we've heard from a lot of airlines and other travel companies, they said that on their platform, the weakness hasn't really shown up yet, but they are seeing things, for example, like Canadians opting to go to Mexico instead of the U.S., saying that the American demand for travel really came from internally. John.
Danny, thank you. Appreciate the update. More from Danny later on this morning. On our radar this morning, one of our top stories, China's Commerce Ministry evaluating the possibility of U.S. trade talks. The ministry urging the U.S. to show sincerity towards China and scrap unilateral tariffs.
This is the clearest signal yet that China is ready to come to the table, ready to at least have a phone call, maybe at the highest levels between Donald Trump and Xi Jinping. What's so important about this statement is where it came from, China's Commerce Ministry. It wasn't some blog post, it wasn't CCTV. This is now an official statement from China that they are currently evaluating this, meaning we're ready to maybe get on the phone. This is the third step in how the CCP operates. Retaliate, stimulate, negotiate. We are at the negotiation stand.
We're thinking about timelines and approach. Let's talk about approach. This from Japan. The finance minister saying the country's U.S. Treasury holdings could be used as leverage in trade talks. This is Japan's chief negotiator, is in Washington for a second round of discussions. So basically what we're hearing, Bramo, is that the bond market might be a tool in all of this.
And Prime Minister just shrugged it off and said, look, the bond market's not responding, so they're not taking this seriously. Nonetheless, what it does show is some of the biggest counterparties to the United States are looking around for their tools to show their leverage and how to get to the table by saying, look, you think you hold all the cards, but we hold your assets and we could liquidate them. This as a threat raises a real question of the interconnectedness of the global economy and how far different parties are willing to go to break it apart.
I think everyone views this and says, look, Japan knows this could really hurt their own economy. The issue is, what if other countries start doing this? What if every other country's, most notably China, look at Japan and say, oh, that veiled threat, that actually worked, and they all start doing that? They are hitting at something that this administration cares a lot about, the bond market.
I'm not sure if China would like the currency move that comes with that move. Would China like to do that at this point, given they need a market for some of the things they sell?
You know, China is a much more complicated one. And as you were talking about the idea of a deal, it's unclear what the ultimate goal of such a deal is. You've got China saying that they want a long-standing kind of agreement. And you have, meanwhile, Marco Rubio saying, actually, this is going to be some sort of short-term bridge to gap the uncertainty and the supply disruptions. Whether China is willing to go massively into completely diverging from the U.S., well, we'll have to see what the contours of this kind of negotiation look like.
That's the latest on the trade front. This is the latest down in Washington, D.C. On the personnel front, the president planning to nominate the former National Security Advisor Michael Waltz to be the next U.S. ambassador to the UN. Secretary of State Marco Rubio will serve as interim National Security Advisor while keeping his current role, and his current role has several roles now.
He has a lot of hats. He is Secretary of State, he's interim National Security Advisor, he's acting administrator of U.S. aid, he's also the acting archivist of the United States. Here is the thing when it comes to Marco Rubio. It's the first official since Henry Kissinger to wear both these hats. So it's not actually something we haven't seen before. At the same time, there is a process underway. The president hasn't decided who he's going to serve as National Security Advisor. When it comes to Mike Waltz, though, I think a lot of people were not surprised because the president has been growing increasingly frustrated after what happened with Signalgate. But this is an individual who served his country, and now he's going to be at the post at the UN. The issue with the UN is he needs to go now in front of the Senate. How complicated are those questions going to be when he goes for his hearing?
It's fair to say there's going to be quite a hearing later on this year in Washington. Equity futures on the S&P, if you're just joining us, welcome to the program. We're positive by 0.5%, a lift off the back of the prospect of trade talks between the US and China. But two soft notes for you. Amazon one, Apple the other. The latest of the Mag 7 to report earnings. Both companies disappointing investors with warnings on tariffs and trade. Tom Fawley of Maxim Group joins us now for more. Tom, when you look at these figures, particularly from Apple overnight, what stands out to you as something to be concerned about?
Yeah, so basically, Jonathan, the analysis here is when it comes to tariffs, how much can a company pass on to its suppliers? How much of the burden will the company have to bear itself? Apple informed us that's $900 million in the June quarter. And then to what extent can they pass off, can they increase prices for a consumer, which we believe Apple can, but they suggested they're still reviewing. So that 900 million data point was very interesting, and it does show that there's a pretty significant impact to the cost for Apple from these tariffs.
Tom, there was an interesting note from Tim Cook, the Apple CEO, to the press. He said, "We don't believe we saw any kind of significant pull ahead due to tariffs in the March quarter." Tom, did he say anything about this quarter, the current quarter, and whether they're seeing any pull forward there?
Yeah, and the answer is no. So I think that this was one, and it really doesn't matter because the tariff situation is the most important thing.
Tom, can I ask you, can I jump in? How does he know? How does he know the difference between the two?
Real-time sales data in the current quarter on the iPhones and things of that nature. So yes, he should have a sense.
Well, anecdotally, though, Tom, you're seeing lines at Apple. My parents who really aren't tech savvy are going out and they're making sure they get their desktop and laptop before the tariffs come in place. When will we know there's been a proper pull forward?
Yeah, so I think we'll have a better sense, obviously, when they report the June quarter. The thing that was interesting in the strategy is on a near-term basis, they're basically going to assemble items in China to be sold to the rest of the world, and then in Vietnam and India for U.S. consumers.
How long is that process to basically move everything they can out of China into places like India going to take, Tom?
I think that they illustrated that they're much more nimble, or that their supply chain's a lot more diversified than I had expected, to the extent that they have already positioned themselves where essentially every iPhone in the June quarter sold in the U.S. was assembled in India. So I think that they're further ahead of the curve on diversification and or more nimble than I expected, as reflected in that comment about being able to source iPhones sold in the U.S. out of India for the June quarter.
There's some fundamental issues that Apple's been dealing with for quite a while, Tom, like the competitive landscape in China and declining sales, declining margins there. There also has been the broader question about AI development and how far they're falling behind. Are those issues being masked by the larger existential crisis of some sort of trade barrier or having to shift supply lines? Because it doesn't seem like those issues were cleared up.
They aren't cleared up. So the tariff situation is so significant that we're putting a lot of things on the back burner. We're also thinking about litigation as it pertains to the Epic Games, the implications of Google antitrust for Apple. So there's a lot of risks floating around for Apple, But I do think appropriately right now, investors are hyper-focused on the tariff situation.
That said, I mean, it's a similar story for Amazon, where people are looking at, for example, cloud computing, which was their big profit engine, and it actually came in slightly below expectations at a time where you saw real growth from Microsoft. You saw real growth in Alphabet, the Google's parent company. How much is that the existential threat for Amazon at a time where it's clear that any tariffs are going to be eaten in large part through margin?
So absolutely, the pressure on Amazon stock comes, I think, from the potential for a recession and a slowdown in the higher margin businesses such as cloud computing and advertising. And I think that the numbers were good, not great, and the commentary was good, not great in those regards. Otherwise, I think they have a balancing act where they need to support the sellers, which is 60% of the units sold on the platform, and the buyers to make sure both are healthy in this challenging tariff environment.
They've not had a great week, Tom. They were certainly in the crosshairs down in Washington, D.C. They were exploring, reportedly, breaking out the tariffs from the price of whatever's sold. Now, Tom, I just wonder what the strategy is going to be, how they will communicate with consumers based on the backhand they got earlier this week from the White House.
Yeah. So the good news is that the buy box on Amazon is essentially won by the lowest cost provider to the consumer. So I think they realized that potentially showing the impact of tariffs on their haul-related items, so think of that as where they were trying to really compete against Temu. That was a mistake. But the system is naturally set up to go toward or bias the lower-priced item. So I think that that's another way that the marketplace model somewhat insulates Amazon.
Tom, we saw them back off pretty quickly after the White House came out and said that what they were considering was a hostile political act. Do you think this White House is intimidating players like Amazon?
I think intimidating is a strong word. I think that influencing might be a better word. So I think, again, what we're talking about here is a long-term negotiation between China and the U.S. And at the same time, I think when it comes to Amazon and when it comes to Apple, they do have, the president's ear. So I think that the message I got from Apple is they're, employing kind of a near-term basis while hoping and probably working toward some sort of trade agreement between China and the U.S. So I think influence is a better term than intimidation when it comes to the White House and Amazon and Apple.
Is the real intimidating player here Walmart and the fact that they are going to invest in price or eat it at the margins? Are we seeing that essentially as played out by Amazon, where they're expecting sales to stay about the same, but their operating income to go down pretty significantly in the upcoming quarter? Is that the state of play for retailers that really want to compete right now?
Yeah, so I think Walmart puts more pressure on Target, but I do think you're pointing out that the marketplace model for Walmart is much smaller and much less significant than it is for Amazon. So to the extent that Walmart can lean into its suppliers to a greater extent than Amazon can, and then maintain lower prices, I think it is fair to say that they would have a competitive advantage against Amazon, but I see it as a greater competitive advantage against Target.
Hey, Tom, appreciate the update. As always, Tom Forty there of Maxim Group. How does he know? How does Tim Cook know the difference between front-loading and something else? Andy Jassy of Amazon said we've seen heightened buying in certain categories that may indicate stocking up. Tim Cook said this: we don't believe we saw any kind of significant pull ahead due to tariffs in the March quarter. And then you heard from Tom Forty pushing back that, this is what they're saying over Apple. I'd love to know how he knows the difference between a genuine purchase of an iPhone and someone worried about the tariffs that are still to come.
The call with Tim Cook reminded me of Fed Chair Jay Powell taking the helm at a press conference for the Federal Reserve, where he wanted to convey as little as possible in terms of his bias as to where things were headed. We have no idea what this is going to mean past June. We have no visibility. Look, we're just conducting our business. We are just a bystander who are doing our job, and not get into anything that could potentially put him in the crosshairs. And that is what that felt like. So how much guidance you can actually get from that, I don't know. I don't know what you do with that, but I can't imagine that you can really say that given what Lori Calvasina and so many other people have said.
Apple is down in the pre-market by about 3%. Equity futures doing okay, up a third of 1% on the Nasdaq. On the S&P, higher by 0.4. With an update on stories elsewhere this morning. With your Bloomberg brief, here's Yahara Hacker. Say, Yahara.
Hi, John. A check on the latest earning. We have Chevron reported better than expected first quarter earnings, but said it will slash buybacks this quarter after oil prices tumbled amid the trade war. Brent crude is down 17% year to date. Tariffs are also expected to increase the cost of steel and other materials needed for production. Those shares are down 2.5%. But its rival Exxon, those shares are up slightly, about 0.3% in early trading after the company beat expectations thanks to higher production from its low-cost projects in Guyana and the Permian Basin. Exxon also bought back nearly $5 billion worth of shares in the first quarter, despite the recent drop in crude prices. It's planning to bring on 10 new projects this year. And TikTok owner ByteDance is being fined $600 million by the European Union for illegally sending user data to China. Ireland's Data Protection Commission, the company's main regulator in Europe, said TikTok infringed the bloc's rulebook with the data transfers and gave it 6 months to suspend all illegal transfers. That's your Bloomberg Brief. John?
Yahira, thank you. Appreciate it. More from Yahira in the next hour. Up next on the program, the pressure building on the Fed to cut.
We are seeing that 2-year rates are now below Fed funds rates. So that's a market signal that they think the Fed should be cutting.
We'll get into that in just a moment with Sarah House of Wells Fargo. She joins us next on this Payrolls Friday. The estimate in our survey here at Bloomberg, we're looking for 138K from New York City. This is Bloomberg.
You missed it on the China show.
President Trump has called Wednesday Liberation Day, and that seems like liberation from the rules-based order on trade.
We're seeing a lot of orders being canceled, particularly on product being sourced out of China. There's a threat to seeing a shortage of certain products because, look, China's our #1 supplier of footwear. When I got this job 15 years ago, it was 88% of our volume to the U.S. It's now 56% of our volume. But the fact of the matter is, most of that volume is for price-conscious consumers here in the States.
One of the things you see here when you talk to suppliers and buyers is that this essentially gives Asia and Africa to Chinese supply chains an influence, because now as American firms have to focus more on the home market, the companies and organizations with the money to invest in new areas, that will be mostly Chinese money.
Don't miss the China Show live every weekday.
Africa, a region rife with potential for growth and opportunities, but not without its challenges. Bloomberg highlights the biggest stories, interviewing key players, and reporting on the issues impacting the region. Join us as we get to the heart of African business, politics, and economics, and ask the question, what's next? I'm Jennifer Zabasaja, and this is Next Africa.
New episodes every month, only on Bloomberg.
Our global headquarters in New York, I'm Danny Berger. Welcome to Bloomberg Brief. Let's set your agenda.
Bloomberg Brief delivers the market news, data, and analysis you need live every weekday only on Bloomberg. Context changes everything. Earnings season is here.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
Higher for 8 straight on the S&P, a gain over that period of almost 9%. on the S&P 500. Equity futures this morning on this payrolls Friday, positive by 0.4%. The big question for this bond market: is it too early to expect some weakness at 8:30 Eastern Time on payrolls? This is what Andrew Honhorst of Citi had to say. The hard data are for the most part holding up, and the front loading of purchases could mean another month of solid data for April. What about May? Anna Wong of Bloomberg Economics. The fallout should be very visible in the May report. Will we see it today, or do you need to wait another month? Yields are lower by a single basis point, the 10-year, 420.58. Under surveillance this morning, pressure building on the Fed to cut.
There's been a substantial decrease in the 10-year since the beginning of the year, but especially since January 20th. And President Trump and I are targeting that point on the curve. We are seeing that 2-year rates are now below Fed funds rates. So that's a market signal that they think the Fed should be cutting.
So here's the latest this morning. No change expected when the Fed meets next week. The why? Investors expect another robust jobs report this morning. Sarah House of Wells Fargo looking for 150,000 jobs to be added, writing, while trade policy abruptly changed throughout the month, we suspect employers resorted to wait-and-see mode. Sarah joins us now for more. Sarah, welcome to the program. Why is today too soon to expect that weakness, if we see any, to show up?
Thanks, Jonathan. So what really comes down to is just the intersection of the data calendar and timing of the survey week. So the survey week was as early as possible, and it did capture even part of the pre-Liberation Day announcement. And I think just in those, even in that first week and a half or so after that is within the survey week, there was a lot of questions over, does this stick? Is this really happening? And I just don't think employers really changed course that quickly in the wake of that news.
So, Sarah, are there any details underpinning some of the headline number that could shed light on how quickly deterioration really is? Or is this really just going to be almost an irrelevant number as long as it's strong enough to not be relevant?
No, I think you're spot on, Lisa, that the industry details are going to be really important today because they're going to shed some light on, well, are we beginning to see weakness, or are you from these policy changes, or are employers pulling through? So maybe you still get a decent headline number, but is it being driven by more of the services side, which is more immune to what's happening on the trade side? Or do you see areas like manufacturing, transportation, warehousing still holding up, which suggests that these policies aren't quickly adjusting employers' plans for their headcount.
On the flip side, as Priya Misra was saying, it's likely that if it is a weak number, a surprisingly weak number, you'll see a pretty big reaction in markets. I'm just wondering, what would get your attention that could be carried out to May, to June, to July, that is an early indicator of just how quickly there could be some sort of economic pain?
Yeah, I think something, sub 100 would really be more of a jarring that, okay, we're starting to see that weakening now. I think, somewhere between 100, 150, like we're looking for. I think, that's in some ways just consistent with that moderating trend in employment that we're expecting as growth does ease, but not necessarily falling out of bed and being an issue for the unemployment rate. So I think that's the sort of number that would capture my attention.
Sarah, if we look at policy in Washington, D.C., and we are to see deals come through in the next during this 90-day reprieve, is that a signal to corporate America to put the pedal to the metal when it comes to hiring?
I think it's a signal that would be, okay, just hang on as long as you can. Maybe you'll get some relief. I don't think that's necessarily consistent with a re-acceleration in hiring. I think there's still some weakness to come in the economy just from all the uncertainty and the stop-start policy. And so I think we're in for a moderation either way. In some ways, it's just the degree of that moderation. But I think that would at least be helpful with, okay, hold the line as long as you can, and seeing that more gradual deceleration in hiring that has to do more with what we're seeing on the supply side of the labor market and not just on the demand side.
I'm glad you mentioned stop policy. The Treasury Secretary has talked about strategic uncertainty. If that lasts, strategic uncertainty for 4 years, what does corporate America do when it comes to hiring overall, writ large?
Yeah, I think you do see a downshift in the pace that would be otherwise. So businesses will adjust, they will go on, but it's going to be at a more tepid or more restrained pace, as I think it does inject more caution into the outlook.
Sarah, help us with Wednesday. The Federal Reserve gets together on Tuesday, presents the outcome of that meeting on Wednesday. We'll get a news conference with Chairman Powell. You heard there from the Treasury Secretary, Scott Bessent, that he's looking at the bond market, the front end of the curve, and he sees a 2-year trading below Fed funds. And he says because that's a market signal that they think the Fed should be cutting. Is that how you see things?
So we don't think they should be cutting just yet, and I think just given the information that we've heard from Fed officials is that I think they're going to be waiting to see more until you actually see the weakness in the jobs market. So it's much harder to cut preemptively in this trade environment than it was in 2019, given where inflation is. And so I think while the bond market is signaling that cuts are coming, it doesn't necessarily mean that it's going to be as soon as May or potentially even as soon as June, depending on how you see the hard data in the labor market hang in or not.
Well, give me the timeline for that. Give us an idea of things. We had a question from a Bloomberg subscriber earlier on this hour who was looking at market pricing. But if you look away from market pricing, we've got economists on Wall Street right now at 0 cuts for the year. Mike Gapen, Morgan Stanley, at 125 basis points of cuts for the year. I can think of Andrew Hoddenhorst over at Citi. Sarah, how do you think about the timeline when we finally cut one way or the other?
Yeah, so we're more on the extreme side. So we're looking for 125 basis point cuts of easing this year. And I think when we're looking at timing, it's when that labor market data starts to break, which while we think we'll get a decent print today, I think we could see more pronounced weakness as soon as the May numbers. And so I think June is certainly a possibility. And even if maybe it ends up being July, I think there's also the possibility, if you are really seeing the labor market weakening, that we're not going in 25 basis point clips. You could see that move to 50 basis points. So I think timing is probably somewhere this summer, and depending on how weak the labor market gets, it could move pretty fast.
Sarah, thank you. Sarah House there of Wells Fargo. All of this, of course, to some extent dependent on trade talks as well. Trade deals are incredibly complex and difficult, and there appears to be just a little bit of tension between Japan and the United States. The latest reporting from Japanese media citing Japanese government officials, the United States reluctant to give Japan auto steel tariff exemptions and also reluctant to exempt Japan from a 10% reciprocal tariff.
This means that this is a very tough negotiation, because you recently heard from the Japanese Prime Minister saying that U.S. auto tariffs are, quote, absolutely unacceptable. So if you see the U.S. being reluctant to give in to something Japan really wants, it means that these negotiations are going to be very intense. At the same time, you have to remember, Japanese main negotiator is in Washington, D.C. right now, and they were hoping for these talks to speed up and then to clinch a deal, Jonathan, by next month.
This is part of the negotiation. I want to be very clear about that, but a lot of people thought that Japan was at the front of the line.
Which highlights how maybe just getting talks isn't enough to really alleviate the pressure right now in markets, that actually some of these tariffs will be wholesale removed. And that's the distinction, I think, that needs to increasingly be made. How much do talks alone soften the field enough to walk back some of the potential damage that was extrapolated out from the tariff regime after April 2nd versus a real tariff regime that people have to grapple with in a new way?
The self-imposed clock, I stress self-imposed clock, is ticking, and we're running out of time. Equity futures on the S&P, positive by 0.4%. Up next, Mohammed Al-Aaron of Queen's College, Cambridge, Ed Mills of Raymond James, AJ Rajajaksha of Barclays, and Sarah Wolf of Morgan Stanley. The second hour of Bloomberg Surveillance, up next.
Listen carefully. Can you hear the rhythm in the markets? Not just in the syncopations triggered by inflation, but in the preludes leading to global elections, in the dissonance that moves the Nikkei, and the rising course conducted by AI. There's music in the markets, and if you want to learn to listen for it, we'll show you how.
In 2000, post-Napster, generally everybody wrote off the recorded music industry, including the investment community. And I didn't mind that chapter, because then I got left alone. And actually, I think out of that period, we started to create better art, because the pressure wasn't on from the technology to be the most powerful chapter. And then iTunes came in, and iTunes, to Apple's credit, did have a boutique taste mentality about the store, which meant that I think they understood. I can tell you from that period that the artists that came through were of a very high quality, because it was encouraged to be boutique. Now, ironically, this chapter has made us more money times 5 than the iTunes chapter and the post-Napster chapter. But an algorithm tells you what you want, not what you might like. And there's a difference between what you want, but with streaming, the downside is you have incredible penetration, and we have hundreds of millions of people around the world. And so that has been very lucrative as a business.
Good morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
Asia is at the forefront of some of the world's biggest stories.
And we're here, where the action starts in Sydney.
And in Tokyo, get ahead as the global trading day begins.
The Asia Trade, weekdays only on Bloomberg.
Tune in to Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg.
It's just very difficult to gauge what the impact of the tariffs is going to be.
You could see a lot of volatility as they try to figure out what sticks.
The aggressiveness of the tariffs on Liberation Day created that change in perception and sentiment.
Markets are delivering a pretty stark warning.
There's clearly hesitation and a pause until we get clarity.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
The second hour of Bloomberg Surveillance starts right now on an 8-day winning streak on the S&P 500, the longest of the year so far, and potentially, if we make it day 9, the longest in some 21 years. Equity futures positive by 0.5% on the S&P, a lift this morning off the back of optimism, the potential for trade talks between the US and China. Elsewhere in the equity market, two movers to watch. Meta and Microsoft yesterday, better than expected. Apple and Amazon this morning, worse than expected. Apple down by 3%, Amazon down by 1%. Lisa, they need a trade deal. They need a trade deal fast.
Which really consolidates the entire idea, I think, for today, which is this question of, will the data that we've gotten so far reflect the pain from the uncertainty having to do with the tariffs that have been proposed? And then on the flip side, how realistic is a deal to come together in the shape for the next couple of months that can actually undo some of the economic damage that is already in the works?
And it depends what country you're talking about. When it comes from China, clearest signal yet that China is ready to sit down, potentially have a negotiation or the start of a process from the Commerce Ministry directly. So this is from the CCP saying China's currently evaluating this, that the fact that the U.S. recently sent messages to China through relevant parties. At the same time, what did we just hear about from Japan? The U.S. is reluctant to exempt Japan from 10% reciprocal tariffs. The U.S. is reluctant to exempt Japan when it comes to things like steel and aluminum and autos, something that the Prime Minister said that is absolutely unacceptable.
The next stop, the data, 90 minutes away. Payrolls in our survey, the estimate 138K, the previous number 228, and a chorus on Wall Street of people who believe it is too early to expect to see any potential weakness in these numbers this morning.
So why do they matter? And we're going to spend the next couple of hours trying to figure out why these numbers matter, leading up in the hour and a half ahead of this number, and then afterwards, how much can we read in? Do we understand potentially the hesitance to hire in particular industries? Can we see and extrapolate out any kind of weakness into next month? Or can we just completely shrug this off and say, actually, watch the tea leaves coming out of Washington, D.C., because that is more important.
Downside risk is something we've heard repeatedly going into this print. 8:30 Eastern time, it's just around the corner. Equities at the moment nicely positive, up by 0.5%. We'll see if that sticks. Up next on this program, we'll catch up with Mohamed Al-Erin on hopes that China and the US bring down the temperature. Ed Mills of Raymond James with President Trump's budget proposal set to be released, and Sarah Wolf of Morgan Stanley counting down to the April payrolls report. We begin this hour with stocks high. The S&P 500 looking to post a 9-day winning streak, the first since 2004. Joining us around a table for the next 2 hours, I'm pleased to say, Mohamed Al-Erin of Queen's College, Cambridge. Mohamed, good morning.
Good morning, John.
What's your approach to this data this morning at 8:30?
So I think it does matter because it'll tell us what is the momentum of the economy. It's a little bit like when I wake up in the morning and look at my Aura scores. There's a score for resilience. How is your resilience doing? And it will indicate how strong the resilience of the economy is, because resilience is important to absorb shocks, and we will be absorbing the shocks of the tariff announcement, whatever happens next.
So starting points matter. What's your assessment of where we are based on the economic information you've had and the earnings you've heard?
We're slowing. We have a bit of a stagflationary smell around the place, but there's momentum in this economy. This economy is still relatively strong, and we'll see what's ahead.
What's the cutoff for a lack of resilience that makes you more concerned about the amount of time that this economy has before it flips over in the face of ongoing uncertainty?
So you've got to get really granular for the answer to that question. You've got to look at different levels of household income and how strong is their resilience. You've got to look at different level of corporate balance sheet strength and how strong is that. So I think overall it's a resilient economy, but it's not resilience for every element of the economy. That's why the micro data is as important as the macro data. That is why listening, as you know, to corporate calls is so important.
What's been your takeaway so far from corporate calls? We've seen the greatest number of just complete withdrawals from any type of guidance going back to the COVID pandemic. We've heard a real kind of varied view, and we've seen the weakest growth in earnings, the weakest upside surprise since 2019. What's your main takeaway?
My main takeaway is management matters. So I look at McDonald's versus Yum. If you look at Yum, there's absolutely no sign of anything going wrong. If you look at the Taco Bell results, they're strong, they're up 9%. They're very well managed company. Look at another company in the same space, McDonald's, and they are down. Compare Airbnb to something else. So what you're starting to get is management really matters in this environment, because they have to navigate through a really tricky landscape.
Help us out with that. What do you think is the optimal strategy at the moment to navigate all the volatility down in Washington, the potential for mismanaging inventory, to make sure you get pricing strategy just right? What do you think the right approach is?
It's that wonderful phrase, beta agnostic. Get as beta agnostic as you can to what's happening in the economy. Come here and be able to look at you and say, you know what, John, I look at these things, but when I run my business, I control my outcomes. And certain companies have been able to do this. You know, it's fascinating for me because the stock market now has basically declared peace in the trade war. The bond market is saying, whoa, maybe so, but there is damage to deal with. And we're seeing these two contrasting views of what's ahead. Even if you believe in peace in the trade war, you have to deal with the consequences of the last few weeks.
Mohamed, this is similar to what Bank of America's Michael Hartnett said today. He said market players are now wagering on, quote, lower tariffs, lower rates, lower taxes. So are we basically back to square one after Trump won the election in November?
So that is where the stock market is inclined to go. The bond market is not there. The bond market is saying, no, we have to navigate a slowdown ahead.
So what is the bond market looking at besides trade? It's also the taxes. We're going to get a skinny budget from the president. Is it all of that? The fact that the deficit is just too high to deal with what they want to get done?
No, the bond market is basically saying that there are consequences to decisions. So even if you can get excited about the destination, the journey has consequences. And what the bond market is pricing in is the consequences of this journey. And even though there are consequences on both sides, it is more inclined to say, I am worried about economic growth. That is what the bond market is telling you right now. They are worried about the slowdown in the economy.
One thing that you're so good at is the other side of this equation, the inflationary side of the consequence and how potentially sticky that could be. And one thing we've been getting the sense of is that companies are not sure how much they can pass along to consumers, and they're looking to play around with it on the margins, just see what they can achieve. Based on your understandings and your conversations, what are you hearing in terms of the tolerance of accepting price hikes at a time where companies are remaining nimble and have the experience of the pandemic.
So it's the complete opposite of the pandemic. The average company during the pandemic was able to pass on price increases. Why? Because the consumer had money. They had received all sorts of transfers from the government, and they had money. They were able to do it, but at the same time, their business didn't allow them to adjust prices that quickly. They've learned. So today, they would be able to adjust prices by pressing a button. They don't have to change the price on every tag. They don't have the flexibility to change prices, because they've learned, is much higher. But there's uncertainty as to what will the consumer accept. And that's the reason why they're very timid in how they're approaching this. All it will take is a few companies to increase prices and it sticks, and then others will have no choice but to follow. That's what it takes. So you've got to look at this tipping point.
Which is what we saw from Ford, that they're waiting on increasing their prices until they see what their competitors do to figure out what kind of competitive advantage they have. Given this, does it make sense for the Fed to just walk back into the bushes and disappear? Or is it, this idea that Scott Bessent...
That was the
Simpsons meme.
Okay. Just making sure.
That was 100%
That's what I pictured.
I was trying to do. Thank you. Yes, that was Homer Simpson, which somehow I just compared to the Fed chair. Please excuse me, but I am curious.
Good morning, Mr. Powell. There we go.
I apologize, but we all kind of want to be that person sometimes. Or is this really a chance to step up and respond to what we heard from the Treasury Secretary, Scott Bessent?
So let me quote you from an hour ago. And I wrote it down, okay? They want to get off the stage without addressing anything. That's exactly what you said an hour ago, and I think that captures this perfectly. They will do nothing on rates. They will try to navigate a pretty tricky press conference. And their desire, whether they're able to do it or not is a different question, but their desire is to get out of this without making any news.
Do the optics make it more difficult for them? The pressure they're getting from the White House over the past few weeks, does that make them dig in just that little bit more?
I think so. I think Chair Powell has clearly signaled that he wants to be remembered not for the mistake of 21-22. He wants to be remembered for defending the integrity and independence of the Federal Reserve. That's what he has signaled, and I think he will continue down that path.
The Treasury Secretary did ask a good question. Lisa alluded to it. Let's talk about it. When he came out and said the front end of the curve, the two-year yield is trading below Fed funds and the market is telling the Fed they should be cutting, how would you respond to that?
I had three reactions. Unusual, politically tricky, and analytically tricky. Unusual because a Treasury Secretary doesn't comment usually on what the Fed should do and what the front end of the curve means for the Fed. So that's really unusual. It's a little bit like the chair of the Fed commenting on the dollar. They don't do that. They respect each other's lane. So this was unusual. Politically risky because they may get cuts for the wrong reasons. Remember the difference between good news cuts and bad news cuts. Right now, the market is pricing in bad news cuts. So you don't want to say the market is right, we have bad news. So that's politically risky. And then analytically, there's lots of things that go into the two-year. So you can't quite make that jump as cleanly as he has. I understand why he did it, but it is unusual and politically and analytically risky.
Mohammed, a clinic as always. Mohammed's going to be sticking with us. Speaking of cuts, a different kind of cut. Corporate guidance and corporate earnings. So in the last 24 hours, GM cutting its guidance. Harley-Davidson cutting its guidance, pulling its guidance. McDonald's had softer revenue. This is what we just heard from Wendy's, cutting the full-year outlook on the current consumer environment. Lisa, we've now heard that from Wendy's, and we've heard that from McDonald's.
At a time when they've highlighted middle and lower income consumers really pulling back. And the reason why sales numbers declined was not because of the actual amount of food that people were ordering. There were fewer people coming in the door at McDonald's. Wendy's seeing something similar. How much does this portend a larger trend, and how much is this the sector of the economy that has been struggling for the past couple of years and is just doing so more so?
We'll stay on top of that. Equity futures more broadly just about holding up by 0.4%. With an update on stories elsewhere with your Bloomberg Brief, here's Here's Yahara Hacker. Say, Yahara.
Hi, John. Shares of Apple are lower by 3% in the pre-market. The iPhone maker reported disappointing China sales and warned about the impact of tariffs. CEO Tim Cook says President Trump's levies will add $900 million in costs in the current period. He also said Apple plans to source 19 billion chips from the U.S. this year, a supply chain shift meant to lessen its reliance on China. Meanwhile, Japan's finance minister said the country's holdings of U.S. bonds could be a negotiation card in trade talks with Washington. However, he added, whether or not we use that card is a different decision. Japan's chief negotiator, meanwhile, says he aims to achieve a trade agreement with the U.S. in June. And President Trump has signed an executive order to cut federal funding for NPR and PBS. The president has accused both outlets of producing biased coverage and left-wing propaganda. NPR and PBS are only partly funded by U.S. taxpayers and rely heavily on private donations. That's your Bloomberg Brief. John?
Yahara, thank you. More from Yahara later this hour. Up next on the program, the president's budget.
The progress of the one big, beautiful bill. We love that bill. I won't like it if it doesn't pass. Neither will you. It doesn't pass, your taxes are going to go up 68%.
Up next on the program, Ed Mills of Raymond James, alongside Mohammed Al-Arian. Your equity market, positive by 0.5% on the S&P. It's Payrolls Friday. This is Bloomberg.
Politics to the world of business. Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Jumpstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action. We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets.
With the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling. Join us on Bloomberg Open Interest. Every trading day, only on Bloomberg.
What is going to be the consequence for U.S. markets?
We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
Mohammed coming out swinging this morning, threatening to break Anne-Marie's mug in the commercial break. Brutal stuff.
Aggressive. These Met fans, Jonathan, they're so aggressive.
What happens over at Citi Field? Is this what you do?
No, but the fact that she has it staring at me with the Yankees...
That's why I'm using it today. I wanted to subconsciously troll you.
Okay, well, it's working.
Calm down, Mohammed. Got a few more rounds to get through.
Let's go Mets. Come on.
Okay.
I agree.
Equity futures right now in the S&P, up by 0.5%. What a week for economic data. First negative contraction on GDP since 22. Consumer confidence the weakest since May 2020. The ISM, manufacturing, streaking the most in 5 months. We'll get some payrolls data at 8:30 Eastern Time. Under surveillance this morning, the president's budget.
The progress of the one big, beautiful bill. We love that bill. I won't like it if it doesn't pass. Neither will you. It doesn't pass, your taxes are going to go up 68%. These will be the biggest tax cuts in American history, with 100% expensing, which is something that people cannot believe they're getting. We did it in the last one, and we had the most successful economy in my first 4 years that we've ever had in the history of our country.
Here's the latest this morning. President Trump's 2026 budget request set to be released today. The proposal calling for a 23% cut to domestic spending and a 13% hike to defense. Bloomberg's Mike Shepard joins us now from Washington for more. Shep, let's get to this. How important is today on the budget front?
You know, John, today is pretty critical. This is the first step in the painstaking annual spending process. What we're going to see in a few hours is what's called the skinny budget. It's really the outline of the fuller request that he'll be sending to Congress in a couple of weeks. And this is just an outline of the president's priorities, the things that he considers most important and wants Congress to focus on. Now, Congress, of course, has its own set of priorities, and they often diverge and they go their own way when it comes to those spending bills that will be negotiated, haggled over, and may even bring us to the brink of a government shutdown later this year, as we so often see every year. Based on what we know of the request that we're going to be seeing later today, he's calling for raising defense spending up to $1 trillion, roughly, with some money for the Golden Dome Missile Shield project. We're also looking for money for shipbuilding there, but we're also looking for $163 billion in spending cuts to domestic non-defense programs. And that includes at the Environmental Protection Agency, at the Energy Department, a lot of cuts in areas of renewable energy, of course, to foreign aid, which we've seen telegraphed already so publicly, and to diversity, equity, and inclusion programs as well. The one thing we haven't gotten a signal on yet is what is in store for entitlement programs like Medicaid and Social Security. We'll see what the full version says later today. And then likewise on tariffs, what the expectations for revenue are really from that and how that will affect the economy going forward, what their economic assumptions are as well. So, John, a lot to look forward to in the next few hours when we get this, but keep in mind it's only a starting point for Congress, and they often will ignore what the president's priorities are.
It's a guideline, or potentially in the president's own words in the past, concepts of a plan. But already, Mike, as you've said, we already see Congress moving ahead with their own plans, the reconciliation package. How does this all tie together, the skinny budget and the reconciliation plan that Congress is already working on?
Well, they're really two separate processes, but they work very much in tandem here, and here's why. You know, the president is looking to cut taxes by as much as $4.5 trillion based on the latest House version of their bill, tax cut bill, and that would be moved through reconciliation. That's a process that allows them to do it with a simple majority without any Democratic support, and that would get it through both the House and the Senate and then to President Donald Trump's desk. But they have a lot of work to do to make sure it adheres to those reconciliation process guidelines. And the way to do it is use the budget as a blueprint, if you will, as a guide, as a path to find those savings. And the more savings that they can find through the budget and spending process, the more leeway they will have to actually get those tax cuts through. And the president is looking to move fast. Treasury Secretary Scott Bessent has set July 4th as a deadline, and the president is putting pressure on lawmakers to act. They are a little bit wary of trying to meet that deadline. We heard that Senate Majority Leader John Thune express a little bit of reluctance about moving that quickly. And we heard J.P. Morgan's Priya Misra in the earlier hour note that, look, this is a politically fraught process and an economically fraught one as well. And it's probably going to take all year to get it done.
Hey, Shep, appreciate your input. Thanks for the framing. Mike Shepard there of Bloomberg down in Washington, D.C. Mike mentioned what we heard there from Priya Misra. Priya Misra called the 30-year bond a risk asset. A risk asset. What did you make of that when she said it?
I liked it. I thought it captured well the volatility that the 30-year will face in the face of all these competing influences on it.
Ed Mills joins us now of Raymond James. Ed, welcome to the program. I want to get your thoughts on some of the fiscal risks down in Washington, D.C. and how you think things are stacking up.
Yeah, John, so I think the number one goal of this budget today is to get all of us to repeat the point that it cuts or proposed to cut $163 billion. When I look at the Hill and they're working on this reconciliation bill, if they do what they want to do, the final tab of this bill is going to be somewhere between $5 and $7 trillion. We're going to have some cuts, and that might bring it down to $3 to $5 trillion. But let's be clear, that's going to be the single most expensive bill in the history of the United States. And so if I'm the president of the United States and I'm asking Republicans to do that, I probably want to create a narrative through DOGE, through this budget, through tariffs, through the Treasury Secretary, that we're trying to cut government spending, that we're trying to get a new revenue source, and with the Treasury Secretary telling everyone they're concerned about the bond market. So this is a political document as much as a budget today.
They'd like to create a narrative, Ed, but does that narrative become reality?
Well, everything in politics, everything in life is compared to what? And so this is where they're also kind of laying this out, Anne-Marie, where they're saying you have a choice as a congressional Republican. Which one do you want to vote for? The largest tax increase in the United States history or the largest tax cut in the United States history? And if you vote for kind of the largest tax cut, you are supporting the president. And for Republicans, it's increasingly difficult to be opposed to this president. And so, yes, they're creating that narrative, and they're creating a juxtaposition that most Republicans are going to take.
Ed, I totally understand the first level of narrative, but there's a second level of narrative, and that has to do with the composition of the budget, and in particular, the different impact of a significant spending cut and a tax cut. They operate differently. And there is a second narrative that says, you know what, this budget in the short term will tip us closer to a recession. What do you make of that?
Yeah, Mohammed, I think what the narrative I get out of that is that this is an administration who is very clearly focused on cuts on the domestic side of things. And yes, there are fiscal impacts of that. But they're also trying to send the message that they want to increase defense spending. This budget will be the first $1 trillion proposal for annual spending on the defense budget. In the reconciliation bill, they want to add another $150 billion to front end load that. I think what we're seeing is historically in D.C., there's a bit of a balance in discretionary spending between defense and non-defense. And this is a president who's saying, let's skew this more towards defense versus non-defense. How that impacts the ultimate economy to be determined. But I think what Republicans would say is when you add up the kind of domestic R&D tax credit, bonus depreciation, no tax on tips, no tax on Social Security, they would say that's fiscal stimulus and could offset on the kind of private sector what the government might be cutting from this budget.
Ed, appreciate the update, sir. As always, thanks for jumping on. Ed Mills there of Raymond James. The timeline, Lisa, is so aggressive. Independence Day, July 4th, to get all this done.
A lot of people saying virtually impossible given some of the dissent. I'm just struck by the offsets here. The narrative that they're trying to paint, the idea of DOGE cuts and tariff revenues offsetting the increase in spending and whether the bond market's going to buy that, I guess we'll see.
When it comes to the timeline, too, the real date is the X date, when the Treasury comes out and says, we're going to run out of money because they are including the debt ceiling in reconciliation. They have no choice. They have to get this done before that date, and it's not going to be July 4th.
The bond market just about unmoved in the face of all of this. The 10-year back down to 420, 421 this morning, unchanged on the session. The 2-year at the moment at about 369. The payrolls report 1 hour away. Up next on the program, we'll catch up with AJ Rajadhyaksha of Barclays. As tech giants look to boost AI spending, those companies are going to be spending big. Equity futures on the S&P positive by 0.5%. The payrolls report just around the corner. The estimate in our survey, 138K from New York. This is Bloomberg. Is this a negotiation or the new rules of the game?
It could be either.
It is up to the president how he wants to negotiate.
The higher the tariff, the faster they come.
A 90-day pause is not an eradication.
The trade negotiations are moving quickly. There will be deals cut.
Trust Bloomberg for all the context and clarity you need as the tariff and global economy story evolves.
This year's bear case, very quickly, becoming the base case.
Nobody covers tariffs like Bloomberg. Context changes everything.
U.S. tech is influencing global markets.
Technology is driving business across Europe.
Companies in Asia are betting on tech.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
Africa, a region rife with potential for growth and opportunities, but not without its challenges. Bloomberg highlights the biggest stories, interviewing key players, and reporting on the issues impacting the region. Join us as we get to the heart of African business, politics, and economics, and ask the question, what's next? I'm Jennifer Zabasaja, and this is Next Africa.
New episodes every month, only on Bloomberg.
The opening about 2 hours away, the jobs report 60 minutes away, and going into it, equity futures up nicely by 0.4%, up nicely over the previous 8 days. 8 days of gains, a move of almost 9%, just absolutely unbelievable, phenomenal. Absolutely phenomenal. With your morning movers, let's cross over to Danny Berger for more. Hey, Danny.
Hey, John. Apple continues to be one of the biggest movers to the downside in the pre-market trade. Those shares down about 3 1/3%. We got the contours of the tariff hit, about $900 million in the June quarter. At the same time, Tim Cook saying that they would try to get most of their production to come out of India for the current quarter. Still, those fears of weakness sending the stock lower this morning. We're also looking at Chevron. They reported earnings this morning, too. Look, the current quarter, it was really decent. Shares down 2%, though, and you really see the impact of lower oil prices starting to bite. They're going to be reducing their buyback by about 30%. The CFO speaking to Bloomberg saying, look, the oil market has changed, prices have changed, and demand is softening. Hence, we're getting that change to their buyback. Finally, rounding things off with Reddit earnings, a strong set of results for them. Those shares soaring in the pre-market trade, up some 8%. A stronger than expected guidance for the current quarter. Digital advertising looking really good for them. It's been kind of uneven. Snap looked really poor when it came to digital advertising. Meta did better, and Reddit now joining them. So those shares up more than 8%, John.
Danny, thank you. We'll catch up with you a little bit later this morning. Danny Berger there. 3 of the movers to look for later on this morning at the open and bow. The big one to look for at 8:30 Eastern time when we get the jobs report. The estimate in our survey, the median at the moment, 138K. On a radar this morning, President Trump looking to cut domestic spending and boost military and national security funding in his 2026 budget. The record $1 trillion defense budget focusing in part on border security and shipbuilding.
So this really speaks to this idea of moving the industrial base back to the United States. It is a skinny bill. There aren't really details in terms of where the cuts are going to come from, and that is going to be key. How realistic are these cuts going to be perceived by a market that is looking for some offset and maybe might look through some of the DOGE and tariff-related income offsets that have been put out there?
The president looking at a different kind of funding this morning. If Harvard was a stock, Anne-Marie, the latest on Harvard.
The president coming out on Truth Social saying we're going to be taking away Harvard's tax-exempt status. That's what they deserve. What you need to remember, of course, is that universities in the United States, they have a lot of tax exemptions. They basically can file as basically you would a non-governmental organization. This means that they have less to pay out. They can have these huge endowments, and this is something the administration has complained about it. Trump has recently said they act as political entities and doesn't think that they should have this special gateway, basically, of paying less taxes to the U.S. government.
Expect a lot of court cases. They've already been filed. This has already been threatened. This isn't the last word. We've already seen similar types of threats and similar types of responses. Key question is, how do the universities respond? And what it has been is raising money in all sorts of ways through alternative funding to get ahead of any potential cut in the meantime. So people are preparing for this, both from a legal perspective as well as a financial perspective, and there are plenty of different investment firms that are willing to say, hey, okay, I've got a deal for you.
You framed it well. They've punched back. Corporate America said, okay, whatever you say. Harvard's punched back. A very different approach.
Yeah, basically coming out and saying, absolutely not, this is unacceptable, we're going to come back. They also, though, are giving an olive branch with this paper that they put out on anti-Semitism and anti-Islamic sentiment on their campus and said, we need to do better, right? So they came out and they also did take a mea culpa, but at the same time, it seems like this story has not been written yet.
We'll bring you updates on that as we get them, but that's the latest reporting, the latest headline from the president directly. Elsewhere, China assessing the possibility of U.S. trade talks. Its Commerce Ministry saying it has noted the willingness of senior U.S. officials to come to the table. Beijing also urging Washington to show, quote, sincerity.
And we've heard some of that rhetoric before. They really want there to be a point person out of the United States. They also want the president to rein in some of the hot rhetoric that you see from individuals in the cabinet, particularly also the Vice President, J.D. Vance. But this is the clearest signal we have seen yet out of Beijing that they are ready to have maybe this rapprochement with the United States when it comes to tariffs. How long does it take? What is the timeline? Who is going to call who? These are all the questions that are left lingering this morning.
Really interested to see this play out for the earnings for big tech. Just two completely different stories. Meta and Microsoft, everything's okay. Apple and Amazon, not so much. Apple warning that tariffs will increase costs this quarter. The tech giant also seeing worse than expected China sales. Amazon citing the impact of Trump's levies, bracing for tougher business conditions.
This is the gap between software and hardware. This is the gap between the AI trade and the idea of all of companies trying to adapt to a new machine learning reality and the rest of the physical world, which is highly dependent on China, both in terms of production as well as sales. Key questions here. Both Amazon and Apple were facing some headwinds ahead of this. How much of that is getting incorporated into Mohammed's point earlier about management versus the actual underlying business? And then there's this other question of how much does this get taken away with the removal of tariffs? I mean, I look at Amazon, this is margin compression that they're pointing to at this point, not necessarily passing along costs. It's just a really interesting moment for both of these companies.
Can I get to one more tech story?
Please.
If you're a gamer and you haven't slept and you're coming up for air and you just wanted to watch a bit of business TV, you might be disappointed. Okay, the latest from Grand Theft Auto and Take-Two, that's going to be delayed to 2026 from 2025.
That was
like the most important game on the planet.
Okay, all I can say, that was so specific. Like if you were up all night and you decided to tune in to somebody who doesn't like...
Two people care about this. One, if you hold Take-Two.
Okay, fair.
And two, if you're a gamer.
Okay.
I was speaking directly to them.
Yeah, exactly. Are you a gamer, John? I know how you feel about that. You spend your evenings doing that? I know that you're up all night.
I think it should be cut off like 25. Unless it's like the football games.
Oh, and then it's okay?
That's acceptable.
Okay,
that's
good.
all right.
That's great
Because you're with your friends then. You're together.
Oh, give
like
me a break.
Interacting with the real world just a little bit.
Do you feel, John?
Just a touch. All right. Let's stick with tech. Microsoft, Meta, and Amazon all promising to boost AI spend after reporting earnings this week. Ajay Rajayaksha of Barclays writing, investor concerns that AI efficiencies could lead to an oversupply in AI infrastructure with implications across sectors. We believe this overlooks the amount of compute needed to operate these models. Ajay joins us now for more. Ajay, good morning. Good to see you.
Likewise.
What are people getting wrong? Let's start there.
I didn't want to bring this up, but the phrase Jevons paradox. The fact is that if something becomes cheaper, you just use a lot more of it. And the thing is, John, this is not new. Technology has always had costs collapsing. Moore's law has held true in the technological world for 50 straight years. That's what's happening again, and demand is going to go up.
This goes back to the conversation off the back of the DeepSeek revelations earlier on this year. Is that where things started to go in the wrong direction, just in terms of the conversation around this theme?
That is correct. So people did start questioning whether you needed, as much computing power as NVIDIA was priced for, as some of the smaller chip manufacturers were priced for, because DeepSeek was significant. There was a point at which you realized you can come up with cheaper, simpler compute models. But what it missed was that democratizes it. More people can use it, more businesses can use it, and overall demand almost always goes up, not down. And you see it in tech spending, in AI spending. They've not taken a beat. They just keep spending and spending.
Which really goes to the heart of the whipsaw that we've seen in tech stocks so far this year, where at the beginning of the year, people were questioning American exceptionalism after a couple months of American exceptionalism. Then all of a sudden, people were saying it's because of big tech. Their AI trend is actually way overpriced. Right. People have that way wrong. Now we have Microsoft, we have Meta, we have Alphabet. Have we seen a resurgence to this question of how much AI can really drive American exceptionalism?
I think so. I'm not getting those questions anymore, questioning US exceptionalism on the big tech side. The one thing I will say, though, is that the one place where things have changed from 4 months ago is the narrative around China tech has changed. It's not just DeepSeek. Huawei has 5nm and 7nm. BYD has 5-minute charging. Tesla does not have that technology. So there's a narrative building up that there is an alternative. And on the AI side itself, the Chinese are making more strides. They're not as visible because that market is somewhat close to us. But they are making a lot of strides on AI research, and they are still second to the US. But now they are a close second. 4 years ago, I wouldn't have said that.
Ajay, I want to go back to the issue of computing power is not the constraint. In terms of what people were worried about in constraints, from the most to the least, computing power, energy, data, expertise, people.
Yeah.
Okay, expertise, funding.
Sure.
That was the thing.
Yes.
So if you relax computing power,
Yes.
you also relax energy?
No, you don't. And the reason is because even if you relax computing power, the amount of computing power is not going to slow down. And more importantly, the energy demand, I'll give you an example, Mohammed. This seems very weird, but the human brain is extraordinarily energy efficient. It takes 20 watts to do a 10 teraflop computation. It takes 8,000 times that power for NVIDIA's fastest GPUs to do the same computation. And that's what AI is trying to do. It's trying to mimic the human brain. So you're going to have demand for energy go up, up, up. But I agree, critical minerals and human talent are the other two bottlenecks.
But is it a binding constraint, or can we look at not only productivity enhancing shock at the corporate level, but at the level of the economy as a whole?
Historically, it has taken a lot more time than people realize. So, for example, and you'll know this better than me, but the 50s were the golden era of US productivity. But I struggled to come up with a game-changing innovation 10 years before, 20 years before, 30 years before. You had the internal combustion engine, you had electricity, and so on. But what happened in the 50s is, in the 40s, women entered the workplace because of the war, and the GI Bill creates a bunch of educated men. So you finally got to a point where these technologies had been percolating, and now you had a workforce that could take advantage of them. This time should be quicker. But at an economy-wide level, this is not a next-year phenomenon. You're right, it'll show up first in corporate earnings. 3 years later, it'll show up at an economy.
Actionable ideas. So this is great research, really thoughtful stuff. How do you want to put money to work with all this in mind?
Almost every big technology boom, the United States has been the winner over this century. I don't think that changes, even with all of the changes in narrative. We are all obsessed with the global trade war. I realize that there is an reordering of global trade. But below the surface, this trend is the single most important macro trend over the next 5 years.
Jensen Huang spoke to me on the sidelines before he went in to meet with the president. He said China is formidable now when it comes to chips. And he said, they're not behind us. He's like, if they're behind us, they're right behind us.
Absolutely.
Very, very, very close. So why do you think the U.S. is going to win?
The winning part is usually who comes up with the better use cases on a technology. So, for example, the winners from refrigeration were not the refrigeration companies. It was Coca-Cola, believe it or not. Usually you would say an open economy with a lot of startups, with a bigger macro infrastructure is likely to come up. But I'm not prepared to fully bet on one versus the other. The Chinese have made deep strides, and they are pushing at a government-wide level now, yes.
Do you push back against some of the more dire projections for the U.S. economic growth trajectory because of the policy uncertainty and say, you have forgotten about the AI story, you have forgotten about the productivity story that really is going to power a very different backdrop?
Over a 3 to 4 year period, absolutely. But the cyclical for the next 3 to 4 quarters will dominate. I mean, the fact is, if average tariffs go up 25% across the country, and we had 2% to start with, there's no way to look around it. You don't suspend the laws of economics. That is a tax hit on the consumer. And in the near term, the next 2, 3, 4 quarters, that is going to slow down growth. But longer term, this is an absolute tailwind, no question.
Just before you go, payrolls. Do you want to give us a sneak peek of how you're thinking about things?
So the US labor market is about to hit a pretty significant supply shock because the last 3 years, we had a lot of labor coming, some illegal, some temporary humanitarian programs. That's gone to zero. The question in my mind is whether that hits this payroll or not. If that does, payrolls are weaker than markets expect, and the unemployment rate still goes down. And that's something that I don't think markets will like very much. So as long as that doesn't have
to prepare for this summer, do you think?
I don't think so. I think I completely buy the big tech resurgence, but it's astonishing to me, like you said, over the last 8 days, how everyone seems to think that tariffs are completely onto the wayside. The president's taken one left tail risk out of the equation when it comes to the Fed chair, but that's all that's changed, nothing else.
You're not bullish, are you?
Short term, I'm not. Longer term, I am.
Why longer term?
Because I do think that AI's gains on corporate earnings are going to be quicker than people realize, and eventually that lower power most other things.
Exceptionalism, sort of temporary delay. That's what I take away from Barclays this morning.
That's a good way of phrasing it. The idea that in the short term, these tariffs, which are not going away, and I think that he is completely right to say, look, everyone's like saying, yay, it's over. It's not over. It's not as if that's not going to happen, and it's not as if Japan isn't saying that there still is that baseline 10% tariff. But going forward, the productivity, the efficiency that these companies can have is going to be significant.
Ajay, good to see you. As always, thanks for dropping by. It's good to catch up. Ajay Rajayaksha there of Barclays. Let's get you an update on stories elsewhere this morning with your Bloomberg brief. Here's Yahara Hackers. Hey, Yahara.
Hi, John. President Trump said he's taking away Harvard's tax-exempt status in a post on Truth Social. He says, quote, it's what they deserve. Harvard is in the midst of an ongoing fight with the Trump administration, suing for cutting its funding when it refused to make administration-demanded changes to DEI and other policies. Meanwhile, Kohl's fired its CEO for having an undisclosed personal relationship with the vendor and directing millions of dollars of business to her company. He will now reimburse the firm $2.5 million from his signing bonus. The company's chairman, Michael Bender, will serve as interim CEO, and the board is starting a search for a permanent chief executive. And Moet Hennessy plans to shrink its workforce to its 2019 headcount as it faces slow demand and tariff headwinds. The wine and spirits division of LVMH said the reductions will happen through managing natural turnover and not renewing vacant positions. That's your Bloomberg brief. John?
Yahara, thank you. More from Yahara in the next hour. Up next, Biden data.
You probably saw some numbers today, and I have to start off by saying that's Biden. That's not Trump. It's the quarterly numbers. And we came in and I was very against everything that Biden was doing in terms of the economy.
We'll get Sarah Wolf of Morgan Stanley to react to that, I hope, unless she runs away. From New York City this morning. Good morning.
What makes it India's time?
It's us women who are going to transform India. I truly feel that the time for Indian women has come. They're not only breaking glass ceilings, but they are redefining, whether it is in sport, whether it's in medicine, whether it's in creative arts. They are everywhere. And I have so much positive energy that comes back to me when I'm talking to Indian women. And I just think at all these little girls and boys, I don't want to discriminate, who are now in school-going age, imagine once education, sports, we empower them. What a difference they would make not only to India, but to the planet and the world. And the world needs it now than ever before.
Listen carefully. Can you hear the rhythm in the markets? Not just in the syncopations triggered by inflation, but in the preludes leading to global elections, in the dissonance that moves the Nikkei, and the rising course conducted by AI. There's music in the markets, and if you want to learn to listen for it, we'll show you how.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia Trade.
This is Wall Street Week. Welcome to Balance of Power.
This is Bloomberg Television.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm Stephen Engel at the Forbidden City in Beijing, and this is Bloomberg.
Payrolls report just around the corner, 42 minutes away. Equity futures at the moment positive by a third of 1%, up by a quarter on the Nasdaq 100. Under surveillance this morning, Biden data.
You probably saw some numbers today, and I have to start off by saying that's Biden. That's not Trump. It's the quarterly numbers. And we came in, and I was very against everything that Biden was doing in terms of the economy. We took over his mess in so many different ways. When you look at the stock market in this case, it says how bad a situation we inherited.
So here's the latest this morning. The White House playing down weak GDP data just ahead of this morning's payrolls report. Sarah Wolf of Morgan Stanley seeing trouble ahead, writing, we continue to expect a surge in inflation, slowing in employment growth, but little rise in the unemployment rate and a sharp slowing in real spending. Sarah joins us now for more. Sarah, good morning.
Good morning.
Let's get to that. Ultimately, what the president is talking about are his policies eventually showing up in the economic data, which I think is an important question for this morning. Are his policies from April going to show up in the April payrolls report?
I think it's probably too early. We could actually see some upside surprise because there's been a front loading in economic activity ahead of the tariffs, right? So consumer spending accelerated into the end of the quarter, industrial production. And then with the 90-day negotiation period, we're probably seeing some more strength come through in April. So I don't think that we're quite there yet. What we're more likely to see is some of the federal hiring slow down and perhaps some of the ripple effects into federal contractors, and that's where more of the weakness is likely to come through.
What about paralysis? This idea that this survey week was right after April 2nd, was right after Liberation Day, and we heard paralysis from companies that didn't know what to do. How much is that going to factor into just a complete unwillingness to make big decisions like hiring someone?
Well, I think you're making a good point, right? There's two things that are going to impact payrolls, the hiring side and then the layoff side. And right now what we're seeing from businesses is a continued slowdown in the hiring side. And that's where the downside risk, I think, to payrolls comes from. We saw in the JOLTS report that we got earlier this week, job openings came down by quite a bit. So maybe that creates some downside surprise in payrolls. But on the other side, we are not yet seeing the layoffs yet. Businesses are very much in a holding period. They don't know what to do, right? They don't want to lay off their workers and then tariffs get taken off the table and then all of a sudden they don't have workers anymore. But the longer we're in this limbo period, then we will start to see that bleed through of layoffs. And that's where a weak June report, a weak July report is definitely on the table.
Sarah, we tend to focus understandably on the demand side for labor. The guest before you said, don't forget the supply shock. Don't forget what's happening on the supply side. Could we be in a situation whereby it's a negative demand and negative supply shock that results in earnings going up?
100%, especially when we're talking about the immigration story, which has really fallen to the wayside because everybody's focused on tariffs right now. So one of the interesting things that's going to start to happen in the employment reports is that payrolls will slow down, but the unemployment rate may actually move lower because we're losing labor supply as well.